Okay, good morning, friends. Okay, so today we are having our last day of revision. Objective here is to cover the entire AFM again. We have covered it extensively in the revision. Ideally, this is when I'm going to do a revision. Whatever I did earlier was not a proper revision because in revision, ideally, I should only be discussing concepts and the student should have an understanding of the concept for you to grasp it. When I started on day one, most of you would have some knowledge of AFM, little less, little more, whatever it is. But now I feel you have reached a stage where you'll be able to understand whatever I'm going to say because full clarity on concept will be there. Some gaps here and there will be there, which is what you're trying to plug in this revision. And also, whatever I'm doing now, you may watch it again. So, whoever is watching this, it's with one condition that this is for students who are aware of concept. If you're going to use it for first time learning and all, this is not going to obviously work. So this is for those set of students who want to quickly complete an AFM revision. For example, in your 1.5 days before exam, or even if you do the next revision, you want to do mutual fund chapter. Before starting with mutual fund chapter, you will listen to this video, which could be in mutual fund for maybe 20 minutes, 15 minutes, or a 30-minute. I don't know the amount of time. I'm trying to estimate it for the first time. I'm doing it. But objective is that you cover the entire chapter. Bigger chapter may take 1 hour, smaller chapter may take lesser time. But the objective here is that you use this video as a base and then you go ahead and do your preparation later on. Based on most of the requests which came in yesterday, I tried doing one more thing. After every chapter is done, what you need to additionally work in every chapter, I have noted down in the Word document. This is not important questions. This is just the question which can help you in covering maximum concept. It is not going to drill down the number to, because students have said, can you bring it down to 5 per chapter and all? Not possible. This will bring down the numbers to, I think, from 500 plus question, it brings down the number to 150 or 160 or 170. I don't know the number, but it will bring down to that number. Every chapter, what type of questions you have to revise after the chapter is done. This document, I'll share it to you later. So, what you will ideally do for your revision is, see, I normally tell that AFM needs 3 time preparation. First preparation is a regular class, which some of you would have done, some of you would not have done. Base is always the regular class, but time constraints some of you may not have done. The second is what we did over the last 14 days or 12 days. You would have gone through the entire subject. Some places you would have been able to manage what I did, some places you wouldn't have been able to manage. But ideal thing is, I want a student to go through 3 times of learning. First learning is done, second learning was done, the third learning is today, which is 1 day kind of a revision. Now, in case somebody no, I want more clarity on concept, in the YouTube itself there is a 25 hours or 27 hours playlist where every chapter is covered, the concept is covered in depth, no problem solving, only concept is covered, but that runs for 25 plus hours or something. So students said day before exam and all is very difficult for us to go through that. Even if you watch it at a faster pace, you'll not be able to. So somebody who wants more clarity on concept, some area you find it difficult to follow this, you should ideally go through that again, whichever chapter you want to go through. For example, interest rate risk management, some of you have said we have not covered it fully. So in case you want to go through that, you can go through the YouTube revision which is available, where concepts alone are discussed. Problem solving will be very limited in that. Some question, if concept is to be explained with problem, I would have done. So always 3 revisions are needed, or 3 times preparation is needed for any subject. First time preparation, you do it in a regular class with the faculty, or you do self study, that's your wish. But first time you have to learn the subject fully. Second time, in the half time, you have to learn the subject. Third time, another half. And then this is what maybe the fourth time I'm going. Technically, this could be your fourth revision or the third revision, whatever it is. Here, objectives to cover the entire subject in 6 to 8 hours is my target. I don't know what will happen. Will we be able to complete it fully today? I hope I'll be able to complete it, but I don't know because I'm estimating it only for the first time. Looking at your reaction only, I change my pace. If everybody reacts well with the topic, it means you have understood. I proceed forward. If I see some blank faces, I cut down the speed at that place. So it all depends on what is the reaction of the student, and accordingly only I can decide whether the space is okay or not okay. That is why most of my recording happen with student, because unless I see your reaction, I don't understand whether this area needs more discussion, needs lesser discussion. Because from my point of view, I keep saying the subject is very very simple. You keep going through the concept in an easy manner, you will understand everything properly. But obviously at a student end, so many things are there. You learn the subject in different manner, different things are there. ICA material has something different, some concept gaps are there, logic gaps are there, so it becomes little bit pressurizing. The subject also has another challenges. Every other subject, like if you do accounting, there are certain formats, standard formats are there, you know what needs to be done. The problem with subject like costing or FM is you don't know how to proceed with the solution. So because of so many things are there, we have tried to standardize it. But still, question 1 I'll say do 1 plus 2, question 2 I'll say do 2 plus 1. So suddenly student get confused. He said earlier we do 1 plus 2. In accounting, liabilities amount, assets amount, P&L as a format, balance sheet as a format. So you know standard format, so you know how to at least start the solution. This subject becomes difficult because you don't know how to start. Either it can become very bad for you or it can become a very good paper. This is the context with which I'm starting. Objective is to revise this fully. Just give me a minute. Okay. Objective is to revise this over the span of next 6 hours. I want to revise the entire AFM, get full clarity on maximum concepts which we are going to do. I first start with a very simple chapter. Every chapter I will start with the same word, very simple chapter, because it remains simple for me. So I start with mutual funds. That's the chapter we start with. We learned that a mutual fund, what it does is, it is in the job of collecting money from people and investing money on behalf of people. A mutual fund does this because on your own you cannot make any type of investment because the knowledge is not there. So I need some specialized tool or specialized instrument which can take care of my investment. When my health is bad, I go to a doctor. So for protecting my wealth, I go to a mutual fund. A mutual fund will have a sponsor. He is a person who is initiating this mutual fund to be started with and provide some initial capital. There's a trustee. Trustee is, because I give my money to a mutual fund, I want to ensure that the fund performs properly. They don't take away my money and run away and all. So trustee ensures that the MF operates in the best interest of the investor. There's an AMC who takes care of the investment. The asset management company does the investment on behalf of the investor. There's a fund manager, and future you could become a fund manager. Normally a chartered accountant or an MBA becomes a fund manager, and you take care of managing the funds of so many people. Investor or unit holders are people like us who invest money. And an example I had said is AFM fast track batch. I created a mutual fund called AFM March 2025 mutual fund, and this mutual fund has all your contribution. Now mutual fund also need to run its operation. For running the operation, mutual fund has to incur a lot of expenses. These expenses can be of two types. One is called initial expense, and second is a regular expense which a mutual fund is going to incur. So first concept we learn is, what should the mutual fund earn so that it is able to give me the return which I'm targeting. I want a 10% return. If you want a 10% return to be given to you, I should earn 11. I should earn 11 or 12 or 13 so that I can give you 10% return. Otherwise, it is impossible for me to give a 10% return. I have to earn more so that I can give you this return. So the concept says, if I can earn 10, the MF has to earn 10 divided by 1 minus, there will be an initial expense ratio. Let's assume it's 5%, 0.05. Initial expenses one time. You can calculate and tell me the number, okay? 10 divided by 1 minus 0.05. On top of it, I have to recover the annual expense. The annual expense is 1.5. Tell me the answer. 10 divided by 0.95 plus 1.5. 12.03. So the MF has to earn 12.03 so that you as an investor can get 10%. Initial individual return divided by 1 minus initial expense ratio plus the annual expense ratio. Then this formula will not work in case there is an opportunity cost. What is opportunity cost? Is I'm taking class now. Without taking class, if I manage my funds, I lose the opportunity of earning the income from classes, because to manage funds, I need to be active from 9 to 3. That time I have to be active. I have to track market. So doing own investment things good. But when you track the market 9 to 3, it becomes very, very difficult for you to understand this. So what you will do, you are going to incur expense on this. Because of this, there is an opportunity cost which is going to come. What is opportunity cost? Is if you do mutual fund investing, you earn the return which is lower. If you do own investing, you earn a return which is higher, but higher return comes at a cost. That cost is your opportunity cost, loss of tuition income, loss of tuition income. So in case there is something like this, you'll have to do cost benefit analysis to check what is better. Clear? This is the concept 1 and 2. Ideally, at any stage when you're seeing the video again, pause the video at that time. Once one concept is done, there will be one MCQ below the concept in the concept book. Try to solve that concept MCQ, unpause it, keep proceeding forward. Whenever you want to do, that would be ideal in case you have time. You don't have time to solve the MCQ, keep being in the listening mode. If you have time, pause, solve the MCQ, unpause, and then keep proceeding forward. Next, what is the return I generate from investing in a mutual fund? Formula is what I get back minus what I give divided by what I give. Anybody says, what finally people says, what am I getting back? You tell me what is coming back by investing in mutual fund. You are saying invest in mutual fund, invest in mutual fund. What am I getting? Just explain me that. I don't understand anything else. You explain what am I getting back. That is called NAV1. I get back NAV1. I give NAV0 today. I give NAV0 today. I get back NAV1. I give NAV0. Along with that, I may earn dividend, capital gain. What is CG1? Is capital gain which a mutual fund earns on that dividend is paid. Dividend paid out of capital gain. Dividend paid out of dividend. NAV1 minus NAV0 is technically capital appreciation. That is my capital appreciation, or technically my capital gain. My capital gain is NAV1 minus NAV0. D1 is dividend paid out of dividend. CG1 is dividend paid out of capital gain. Practical world, we don't have the CG1 concept and all. Divide by NAV0. If you leave this as it is and do into 100, it's called holding period return. Into 100, it's called holding period return. In case you do along with the 12 by M, 365 by number of days, that will give you the annualized return. That will give you the annualized return. Clear? Again, concept 3 is done. As you proceed, I'll not repeat this. Just 2-3 times I'm repeating. Pause, watch the MCQ, solve the MCQ, and then keep proceeding forward. Next, with this two numbers, I can calculate my period of holding. With the two numbers, I can calculate my period of holding. If you see the formula, annual return is equal to holding period return into 12 by M. If you see here, above formula with 12 by M. So some question will give me annual return, will give me holding period return, and using this logic, I will calculate the time period of investment. The time period of investment is the last date minus all the prior date, and you find out the date in which the investment happened. So period of holding through holding period return and annual return, HPR. The formula is this, but the logic is here. Annual return is equal to holding period return into 12 by M. M is the number of days. M is the number of months which we are trying to calculate. So if I take M to the other side, M by 12 is equal to HPR by AR, and 12 goes to the other side. 12 goes to the other side. That is where the formula is coming. Now, return computation, should I do days calculation or months calculation? This concept is applicable for all chapters. Wherever the question says, it says 1 year consists of 360 days, 365 days, specific wordings are there. Please prefer doing return computation in number of days. Return computation in number of days, interest computation in number of days, futures valuation in number of days, bond valuation in number of days, share valuation in number of days. Whatever you do, use number of days logic. Use number of days logic in case the question specifies 360 or 365. If no such information is there, you can do computation on months basis. It will not make any big difference, but still to ensure I see a solution. If it is days basis, I have a headache. The headache is how do I calculate number of days? Because I invested on March 1, redeemed on March 31. Now number of days can be including March 1, can be excluding March 1, including March 31, excluding March 31. I cannot say a proper answer, because if I invest in March 1, did I invest in the morning or in the evening? March 31, did I redeem it in the morning or in the evening? So depending on that, whether should I include that or should I exclude that will have to be done. So March 1 can be included, can be excluded. March 31 can be included, can be excluded. If it comes in MCQ, no problem, but if it comes as descriptive, you will have some headache which you have to face it in exam situation. Dividend declared by a mutual fund. First of all, dividend is always on face value. Dividend is always on face value. It is never on NAV. It is always on face value. That's the first point you have to remember. Dividend always on face value. Sometimes they may use the word dividend yield. Dividend yield is on my investment. Dividend yield is on my investment value or on my NAV which I paid. Dividend yield is on my investment or the NAV I paid, or technically the current NAV also. It can be current. Dividend yield is on market price. Dividend rate is on face value. Dividend rate is on face value. Now, two things can happen. There can be a dividend payout plan or there can be a dividend reinvestment plan. Payout means I give you money in cash. If I give you money in cash, formula is NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0 into 12 by M into 100. But if I allow you to reinvest it, if I allow you to reinvest it, you are not getting dividend in units from, you are not getting dividend in rupees from me, you are getting dividend in units. How is it calculated? Next concept, I'll explain there. In this case, I'll be giving you extra unit. So for this, you cannot use this formula which I gave. Then what should I do? Closing value, that is what I get back, minus what I give, divide by what I give into 100. What I get back is closing NAV into closing units. What I give is opening NAV into opening units, closing NAV into closing units, opening NAV into opening units, divided by opening NAV into opening units into 100. Now, how do I calculate this reinvestment plan unit? Let's take today date is 110. I am holding 1000 units. I am holding 1000 units. MF is declaring 5% dividend. MF is declaring 5% dividend. This 5% dividend is on face value. On face value. So 1000 into 5% into 10 into 10. What is the number? 500. On this 500, instead of giving me money, you are saying I will reinvest. This reinvestment happens at an NAV of 20. Just assume it is 20. If it is 20, I'll be given extra units. I'll be given extra units. So 500 by 20 is 25. Closing becomes, the cycle continues. Next is again you continue now what? 1025. 1025. It could be 10%. The cycle will keep continuing till the end. Any question when you start with some unit and end with a different number, it means it's a dividend reinvestment. End with a different number, it is a dividend reinvestment. Bonus plan is further simple. In bonus plan, again I start with 110. I'm holding 1000 unit. There will be a bonus ratio. It could be 1:1, 2:1, 0.5:1, 1:2. Let's assume they declare 1:2. 1 unit for every 2. In this case, I'll get 1000 into 1 by 2, 500, and my closing is 1500. Closing is 1500. The cycle will keep continuing. The cycle will keep continuing. We have two types of mutual fund scheme. One which is called open-ended and close-ended. Open-ended means entry and exit at any point of time. If you can enter and exit at any point of time, you are going to buy or sell at the NAV. You are going to buy or sell at the NAV. So NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0. In case of close-ended scheme, the exit and entry happens at a specified time. As per the norms of AMFI, every close-ended scheme will be listed in the stock exchange. It will be listed in the stock exchange. This listing will ensure that I can buy and sell anytime. I cannot enter through the MF. What normally we do is we give money to the MF. MF gives units. Here, I have already purchased the units. I sell it, you buy it. This purchase or sell may happen slightly different from the NAV. May happen at different from the NAV. It can be slightly more, slightly less. So the formula will be adjusted price. It will not be NAV1, adjusted NAV1 minus adjusted NAV0 by adjusted NAV0 plus D1 CG1 will come into 12 by M into 100. Clear? Any doubts on this? Next, taxation impact for doing problems. Cost of acquisition of bonus units. Wherever you have bonus units, you will take it as 0. Securities transaction tax is not deductible expense. It is not a deductible expense for computing capital gain. For computing capital gain, less than 1 year, whatever happens will be short-term capital gain. More than 1 year is long-term capital gain. This effective yield which I calculate, the normal formula we do is NAV1 minus NAV 0 by NAV 0 into 12 by M into 100. But this formula has one headache. The headache is time value of money is ignored here. Whenever you do into 12 by M, you are ignoring the time value of money. If you want to consider time value of money, do IRR approach. Do IRR approach. How will you do IRR approach? You will invest 1 lakh today, get back 5 lakh after 4 years. Year 0, negative 1 lakh. After 4 years, positive whatever number, 5 lakh, okay, 5 lakh. One positive NPV, one negative NPV, and IRR will be calculated. One positive NPV and one negative NPV, IRR will be calculated. Now, a mutual fund charges two things. One is called front end load, and second is called back end load. Front end load is called entry load, abolished in India. Back end load is called exit load, continues to be in India. It continues to be in India. Now, what is front end load is, if you are entering into the mutual fund, NAV is 10, but you have to pay 10 rupee 50 paise. You have to pay 10 rupee 50 paise. Don't remember the formula and all. You are paying extra 50 paise on a base of 10. Extra 50 paise on a base of 10, which is 5%. Extra 50 paise on a base of 10, which is 5%. And when you're exiting, it is 10, but I will give you only 9.8. I'll give you only 9.8. So you are going out with lesser 20 paise. 20 paise on a base of 10. 20 paise on a base of 10. NAV, how do I calculate NAV? NAV is nothing but fair value per unit of mutual fund. Fair value per unit of mutual fund. Fair valuation doesn't go by your accounting concept. What is fair valuation is value all assets at the fair value, value all liabilities in case it is there, value all asset, value all liability, and we follow this formula. If you have asset and liability detail, market value of asset minus value of liability divided by number of units, divide by number of units. How will you value asset? It could be the share prices given, debenture valuation is there, bond valuation, property valuation, everything you have to do the valuation, deduct all liability which is there, and divide by number of units. Some question, you do not give me the asset and liability detail, but what you tell me is, we are starting with 1000 units into 20. This is my starting net worth, 1000 lakh. Let's take it as 1000 lakh into 20. This net worth will go up because of certain reason, will go down because of certain reason. How it can go down? I made a profit, net worth went up. I made a loss, net worth went down. I earned dividend, net worth went up. I paid dividend, net worth went down. Somebody came into the mutual fund, net worth went up. Somebody went out of the mutual fund, net worth came down. So going up, going down will keep happening. You track it fully, divide by opening units plus the new units issued minus the units redeemed, minus the units redeemed. Items increasing net worth, items reducing net worth, and divide by opening units plus new units minus the redemption. Clear? Impact of certain events on the NAV. Some events can impact the NAV. First event is, somebody is coming into the mutual fund. If somebody comes into the mutual fund, least bothered, NAV cannot change. NAV cannot change. We have a problem where they had given the data, you give a check of some 50 lakh rupees, NAV cannot change. When will the NAV change? If the underlying shares go up or go down. So NAV cannot change just because a person is coming in or a person is going out. If you declare dividend in, be it share, be it mutual fund, the share price or the mutual fund NAV will fall by the amount of dividend, will fall by the amount of dividend. Clear? Any doubts? Will fall by the amount of dividend. Total yield of investor. Now we normally calculate return for MFA separately, B separately, C separately. What formula we do? NAV1 minus NAV0 plus D1 plus CG1. Now what if you do total yield is, calculate the profit of mutual fund A. Profit not in percentage, rupee terms. Rupee terms is numerator. Calculate the numerator of mutual fund A, numerator of mutual fund 2, 3, 4, add up all the numerator, add up all the denominator into 100. No 12 by M, because some could be 2 months, some could be 5 months, some could be 8 months, some could be 10 months. If it is all same time period, you can do into 12 by M also. But otherwise 12 by M is difficult to do here, because some mutual fund could be 1 month, some mutual fund could be 3 months, some mutual fund could be 5 months, and some could be 10 months. Exit strategy of underperforming mutual fund. If a question will say that whatever you calculate return of 3 mutual fund, in future same performance will repeat, If same is going to repeat, the lowest return sell it, second lowest sell it, best alone keep it. But there, if you have no exit load, okay, there can be an exit load also. What is exit load is, if I'm exiting out of the mutual fund, so the question will say there's a mutual fund A which earns 10, mutual fund B, which is the best mutual fund, is earning 25. I may still continue with mutual fund A in case there is an exit load. I may, I'm not saying I will continue, I may continue. How will I decide this? In this mutual fund, I have a loss of 15%, but I am already invested in this mutual fund for 300 days. Another 65 days, if I stay patient, I will save the exit load. I will save the exit load if I stay patient for another 65 days. So 15% into 65 by 365 is my loss if I continue with this MF. Is my loss if I continue with the MF. I lose 15% into another 65 days. What is the number you get? Sorry, 2.67. Against this, exit load is only 1%. Incur exit load. Incur exit load. Exit load is 4%. Don't incur exit load. Let this 2.67 loss be there. Let the 2.67 loss be there. No need to incur the exit load because exit load is 4%. Proportionate loss is only 2.67. Tracking of inflows and outflow. This is to calculate closing cash. There are problems where closing cash can be calculated by us by preparing a cash book. By preparing a cash book where I record all receipt, all payment and get the closing cash. If you cannot track it, you can ignore the cash or record it if it's given in the question. If they say cash is so much, record it, else you cannot do anything. There are problems where cash is not given. You'll say I started the MF, I purchased so much, I sold so much, I purchased so much. There I'm able to track it. If you're able to track it, then you have to record the closing cash. You have to end up recording the closing cash. Dividend income of MF on its investment. MF is making investment, and this is not only for in MF, it is for anyone. There are two types of dividend you get. So the dividend is on two types of share. One is original share. I'll get it whenever it is paid. Second is right share or bonus share. Right share or bonus share. Right share or bonus share dividend cannot come to me if both are happening at the same time, or if dividend is declared and then a rights issue happen, or dividend declared rights issue one day only before and record date is not matching. You will get dividend on this only if the rights issue happened with some time gap between the dividend, both at the same time or rights issues later. Then dividend income will not come, not only at this place, at all other places as well. MF normally reports daily NAV. This is the practical world. MF reports daily NAV. If MF is reporting daily NAV, there's nothing like a dividend equalization adjustment. This I had given a video to you. Nothing like a dividend equalization adjustment. What can otherwise happen? Question can say, I'm not declaring daily NAV. I'm not declaring daily NAV. Is this practically feasible? No, practically not feasible. MF has to declare NAV daily. If you don't declare NAV daily basis, I am making a fair estimate of the NAV. How do I make a fair estimate of the NAV? There's an opening NAV, there is an entry load which you have to pay, plus dividend equalization. What is dividend equalization? Is income per unit, which could have been earned in this time gap. I started with April NAV and I want to do June NAV calculation. April to June we earned 2 rupees per unit, 3 rupees per unit, 5 rupees per unit. That is called dividend equalization. You are exiting, you take the opening NAV, I will deduct exit load, but I'll give you this because you are eligible owner of this income. I will give you dividend equalization and tell you to move out. What is dividend equalization? Total income earned divided by number of units. Where is this coming into picture? In case I do not declare dividend on a regular, I do not declare NAV on a daily basis. Now, question may ask something called as income available for distribution. What is income available for distribution? Is calculate the income of the mutual fund. Every month you do the calculation. What is every month? Total income divided by number of units of that month. First month, total income by number of units. Second month, income will change, units will change. Again calculate. Third month, income will change, units will change. Put a total of the month 1 income, month 2 income, month 3 income per unit, and multiply this with the closing units. For example, month 1 denominator can be 300, month 2 denominator can be 305, month 3 denominator can be 295, month 4 can be 290. You have to calculate income per unit every month, add up all the incomes, multiply with the closing units. Whoever has gone out of the mutual fund, he would have taken his income and gone out. Who would have come in, he would have paid for the prior income also. He would have paid for the prior income also. So we do with closing units. Clear? This is the concept. Whatever income available for distribution we calculate, on this dividends will be distributed at some specific rate, which the question will indicate. Question may say dividend is paid out of realized earning. The term realized earning means what the mutual fund has realized, and it can be in two forms. One is dividend, interest, and the second form is realized capital gain. Realized capital gain, and whatever dividend you are distributing will be the income of the investor, and this will impact my closing cash, closing NAV. It will impact my closing cash and closing NAV. Next is valuation of asset. How do I value the asset? Normal principle is a security valuation topic, but here we just do an approximate calculation. What is approximate calculation? I purchased a mutual fund. I purchased shares. I am the mutual fund. Okay. I purchased share when Nifty was 20,000, and I made a purchase of 1 lakh. This is the mutual fund. Okay. Mutual fund purchased 1 lakh rupees of shares. Whatever was the price, whatever 1 lakh is the investment. Nifty on the valuation date is now 24,000. If 20,000 is equal to 1 lakh, 24,000 is question mark. 24,000 is question mark. This is the rule we follow. Amount invested 1 lakh into closing index value divided by index on date of investment. In case of bonds, we learn a concept called current yield. What is current yield? Is interest by current market price. I take the market price to the other side. Interest divided by current yield. Interest in rupees divided by current yield in percentage. This can help in bond valuation. Next comes the most important area called as expense ratio. This, not from an exam point of view, but from practical point of view, expense ratio is going to reduce my return. It is going to reduce the return. So how do I calculate expense ratio? First, I calculate whatever expenses we incur: office expenses, rent, fund management expense, the fund manager salary, everything you add up. After you add up all of this, divide by the number of units, you will get expense per unit. This you can divide by opening NAV, closing NAV, or average NAV, and this will give you the expense ratio. Now, next comes, how do I evaluate the performance of a mutual fund? Whether the mutual fund is performing good or performing bad. How do I evaluate this? Three types of options are there, but first two types of funds are there: undiversified mutual fund, diversified mutual fund. If you have undiversified mutual fund, standard deviation is the measure of risk. We learn this in portfolio. Standard deviation is the measure of risk. So we use Sharpe, which uses standard deviation. Denominator is standard deviation. Which is also called reward to variability ratio. If you have diversified mutual fund, diversified uses beta. Beta as a measure of risk. Denominator is going to be beta. In this place, please write actual return. It means actual, not expected. Write actual. Write the word actual return. Actual return minus the risk-free return. That is how much extra is the fund generating. Divided by standard deviation, divided by beta, reward to variability, reward to volatility. Higher the better, and these values can be negative. It came in one of the exam, and students were thinking how it can be negative. It can be negative in case the risk-free rate is higher than what the MF is giving. The risk-free rate is higher than what the MF is giving. What is alpha? Is calculating CAPM return. RF plus beta into RM minus RF. I apply CAPM formula, I get 14. MF is giving 16. Positive 2 alpha. MF is giving 10. Negative 4 alpha. So in Sharpe, higher the better. In Trainor, higher the better. Obviously positive values. And in case of alpha, higher positive alpha is better. Using this data, some reverse working question can come. What is reverse working question? Is breakup of NAV. The NAV which a mutual fund gives has normally two components. One is the cash component. Second is the investment component. Cash component will go up or go down based on the income I generate, are based on the expense I pay. So normally question will give one expense ratio. So the cash component will go down. For example, I start with 2 rupees is the NAV is 20, 10% is cash 2, equity is 18. Equity is 18. This 2 will go down by the amount of expenses you incur. If you are doing monthly calculation, expense per unit per month. If you are doing quarterly calculation, expense per unit per quarter. So in a month, in a year, I incur 3 rupees. So in a month, it is 25 paise. Let's assume I'm doing monthly calculation. So this will go down to 1.75. On top of it, this may go up or go down depending on what is happening to the stock market. Stock market going up, this will go up. Stock market going down, this will go down. But if stock market is up by 10 and my beta is 2 times, then I will go up by 20. I'll go up by 20. My change will be beta of the portfolio into the change in market. Beta of the portfolio into change in market. Clear? Any doubts on this? Beta of the portfolio into change in market. This will be the change as far as my portfolio is concerned. Last area, tracking error. This got tested in one of the recent MTP which ICI has given. A tracking error question has come in the MCQ. In the MCQ form, there are two things. One is tracking error and a side pocketing concept, which is a theory area. There was a concept called side pocketing which got tested in the recent mock test paper, which is the first 10 mark case scenario. First 10 mark case scenario on the concept of not calculation at all. They did not ask for any calculation. It was more of a theoretical concept. When you see that, you'll be able to understand it. What is tracking error is? Tracking error is applicable in case a mutual fund tracks any index. So here, Nifty index mutual fund. In that question, what they did is they said Nifty is giving 12% return and you are giving 8% return or 9%, or you're having a tracking error of 4-5%. If I have a tracking error of 4-5%, I'm not able to track exactly that fund. This was something like an MCQ of 2 marks. Along with that, other questions were there, but this was one of the area whether you were able to track it properly or not. On top of it, some expense ratio question was also there. It was combination of 4-5 question in a case scenario. You will be able to do that provided you know the theory fully. You know the theory fully, just the descriptive alone will not help there. So tracking error is applicable in case I'm tracking a fund. Now, how do I calculate this? I'll calculate the variation in performance. What is variation in performance? Is how much Nifty is giving, how much my mutual fund is giving, find the difference. After find the difference, get the average of it. So whatever difference you find is like return, probability, product, deviation, PD square. On the gap which you find is the return. On the gap, that is I should not have any difference. So first I find the difference. On the difference, I just take an average. Deviation is equal to difference of that period divided by the average. X minus X bar. Take a square of that. Ultimately, ICI divides normally by n in normal areas. Here they divided by n minus 1. Here they divided by n minus 1, and ultimately the tracking error was calculated. Already one time it has come in the MTP. They did not ask for calculation. So one example is there in the concept book. Do go through that. Clear? With this, my mutual fund discussion gets over. Any doubts anywhere on the mutual fund side? Okay. I'll just wait for 2 minutes and then go to the next area. Okay, now we move to next chapter, mergers and acquisitions. What we learned first is why does a merger happen? We have seen Idea getting merged with Vodafone. We have seen a lot of banks getting merged. So many mergers keep happening. Merger happen because of two reasons. One is operating benefits, which is your P&L kind of a benefit. Second is financial benefit, which is more of a balance sheet benefit in the end. Debt side benefit is there, or cost side benefit is there, or it could be managerial self-interest. Management wants to expand the company because of that reason, or I have two sons, I want one business for both of the son, so I could do anything. So it could be because of any specific reason. Primarily, cash flow should improve, our PAT should improve, our cost of capital should go down, P multiple should go up. If this happens, there is a benefit from merger. Every question we do, we try to put the data in this format. The format says PAT. So I start with PAT as 10 lakh. Number of shares is 50,000. 10 lakh divided by 50,000 is EPS is 20. 20 into P multiple is 10. 200. Again, number of shares 50,000. 1 crore. This is the format. EPS, that is PAT, divided by number of equity share, EPS, P multiple, MPS, number of equity shares, market value of firm. But the formula for market value of firm is not this. The real formula is PAT into P multiple. And this is what merger is targeting. Either PAT should go up or P multiple should go up. PAT should go up or P multiple should go up. One of them goes up. I am very happy. It is going to lead to gain from merger. So first thing is there any gain from merger? What is gain from merger is value of the combined entity minus the sum of the parts, individual A, that is ACTC is the name I use. AC is acquiring company, TC is target company. So acquiring company plus target company value is 20 lakh. Then merger happens, it becomes 40 lakh. The extra value is called gain from the merger. The extra value is called gain from the merger. Why does it happen? PAT, cash flow, or PAT is greater than the sum of individual company, or P multiple or cost of capital. P multiple or cost of capital is better than the weighted average. How weighted average and all is done, as we proceed, you will understand. This is the broad context. People are doing merger either to improve PAT or to improve P multiple, improve cash flow or improve cost of capital. First is what is cost of merger. What is cost of merger is what am I paying to you? You are the target company. I am the acquiring company. When I acquire you, I will be paying you something. This payment can happen in two ways. One, I can pay you cash or some stock or cash. Cash is very simple. You had 20 lakh shares. Every share I paid 10 rupees. So 20 lakh, 10 rupees into 20 lakh share, 10 rupees into 20 lakh share. This is a very simple way of making the payment. 10 lakh, 10 rupees into 20 lakh share. What is the other option? I'm going to allot shares. Whenever I allot share, calculate the number of share into post merger market price, multiply with post merger market price, multiply with post merger, not pre merger, multiply with post merger market price. Once this is calculated, I paid you 500 lakhs and you had a value of only 300 lakh. Before merger, your company had a value of only 300 lakh, but I ended up paying you 500. The extra which I paid you is called true cost of merger, or real cost of merger, or net cost of merger. Next, I will be calculating something called as comparing the MPS, comparing the EPS to find whether I am gaining in the merger or losing in the merger. When I do this comparison, for me, I am the acquiring company. For me, the comparison is post merger price, pre merger price as it is, because I was holding one share, I continue to hold one share. You were holding earlier 10 shares. Now you will be holding 5, 20, 30, 4, depends on what allotment I do, because I may allot lesser, I may allot more also. So for target company, we have to calculate equivalent number. We have to calculate equivalent number. What is equivalent number? Is post merger normal number into the exchange ratio, into the exchange ratio. Why is this calculated? Using this only I can do comparison, else comparison cannot be done. Comparison can happen only after calculating this number. Now, how do I calculate the exchange ratio? See, I say material tails in some other way. Final answer and all remains same. How exchange ratio is determined is first find out the basis. What can be the basis? EPS, MPS, BVPS, return on equity, growth rate, whatever be the basis. Write the base value as acquiring company is to target company. Acquiring company is to target company. Write the base value as acquiring company is to target company. When you write the base value, for example, MPS is the basis 40, 20. I wrote the value, but I say I am very generous and I'm going to pay you extra 50% for the target company. I'm going to pay extra 50%. Adjust the base value in case I want to pay extra, I want to pay lesser. It can be either ways. So now the base value is 40 is to 30 because I'm giving you extra. That's my wish. I want to give you extra. And after you get the adjusted value, just do the swap now. Just do the swap. Switch those values and take it as exchange ratio. Take it as exchange ratio. Now, this switching is not to be done in case you have a negative parameter like NPA and all. Logic is very simple. What switching does is, if I am a stronger company, my number comes first, your number comes second in that form. If I am a stronger company, then I want to give a ratio which is less than 1. And if I'm a weaker company, I want to give you a ratio which is greater than 1, which is greater than 1, which is very logical. I am a good company, I'll give you a lower number. I am a bad company or you are a very good company, I'll end up giving you a lower number. So if market price is 40 is to 20, exchange ratio is 20 is to 40 because I am better. If market price is 20 is to 40, exchange ratio becomes 40 is to 20. Exchange ratio becomes 40 is to 20 because you are a stronger company. You are a stronger company. Only exception is negative parameter. If somebody says NPA is 40 is to 5, it means I'm a bad company. It means I'm a bad company. 40 is my NPA, your NPA is only 5. So I will allot you 8 is to 1. I'm a bad company, you are a good company. I'm a bad company, you are a good company. So switching is not to be done only in case of adverse parameter. Only in case of adverse parameter. Adverse parameter does not mean that my value is higher, my value is lower. Adverse parameter mean those parameter where I'm trying to minimize something, where I'm trying to minimize something. Nobody will say I'm trying to maximize NPA. Nobody will say I'm trying to maximize cost ratio, but everyone will say I want to maximize EPS, I want to maximize MPS, I want to maximize BBPS. So EPS, MPS, BBPS are called favorable parameter. Do switching. NPA and others are called adverse parameter. Don't do switching. Gain or loss calculation. Gain or loss calculation can be done on the basis of EPS, MPS, problem silent, do both. Some question will say impact on EPS, then calculate on EPS, impact on MPS, calculate impact on MPS. When you are doing this, for me, I am the acquiring company, post merger price, pre merger price into the number of share. But for you, I have to take the equivalent. I'll have to take the equivalent value, calculate the profit or loss, and multiply with your pre merger number of share. Multiply with your pre-merger, not post-merger, multiply with pre-merger number of share because I calculate the equivalent number. So now I go back to your past data and past is whatever number of shares which were there. Some question will say, I want to maintain some parameter. If you want to maintain EPS, ER on the basis of EPS, provided no gain at a PAT level, provided no gain at a PAT level. You want to maintain MPS on the base of MPS, no gain at PAT and P multiple, no gain on PAT and P multiple. Why no gain scenario? Because I want to be doubly sure that that parameter is not increasing or decreasing. In that case only you can use that as a basis. If you have a scenario where MPS you have to maintain and question says there are some synergy gain and all, do the table format, write the MPS, number of share reverse working, number of share is reverse working. If you want to maintain BBPS, exchange ratio on the basis of BBPS, exchange ratio on the basis of BBPS. Here also again no revaluation gain should be there. Any parameter to be maintained, this you be very cautious because most of the question there will be a synergy gain. There will be a synergy gain at the PAT level. There will be a at a P multiple level. Synergy gain at a P multiple level. P multiple post merger. What should be the P multiple post merger? Problem silent. Post pre merger P multiple of acquiring company is equal to the post merger P multiple of the merged company, acquiring company. One question was there where I said it will be target company. So read the question. Silent acquiring company. If they say weighted average, what is weighted average? First company 100 profit, 10 multiple. Second company 200 profit, 15 multiple. So 100 into 10, 200 into 15. Weighted average 100 plus 200. Weighted average 100 plus 200, which will be between 10 and 15. The final number is going to be between 10 and 15. What's the number you get here? 13.33. There can be a question which will say minimum P multiple to justify merger. What is minimum P multiple to justify merger? Is a merger is justified if at least there is no negative gain. At least there is no negative gain. First company 5 crore value. Second company 10 crore value. Put together give me at least 15 crore. Put together give me at least 15 crore, which is my numerator. Put together give me at least 15 crore. Divide this by the PAT of the merge firm. Divide this by the PAT of the merge firm. This formula and this formula is almost same. Only difference here is here you use PAT of AC plus PAT of TC. Here you use post merger PAT, which can have some synergy gain, which can have some synergy gain. PAT of AC plus PAT of TC plus some extra can be there. Some extra can be there. Then there can be a deviation. Otherwise, weighted average P multiple and minimum P multiple to justify the merger is same. How do I arrive at the value of the merge firm? First approach which we use in most of the question, post merger PAT into the P multiple, post merger PAT into the P multiple. What is the approach to? I have pre-merger value of acquiring company, my value, your value, and some valuation gain is given in the question. Valuation, any problem they say there is no gain from merger, it means no PAT level gain. Still there can be a valuation gain. Still there can be a valuation gain because of P multiple. Because of P multiple, no PAT level gain. It just means no PAT level gain. Clear? Any doubts on this? No PAT level gain plus valuation gain from the merger. So how can I calculate valuation gain? We did one problem where I had to use Gordon's model to get the valuation gain. One question where the valuation gain was given in the question. All that we'll have to calculate are as given in the problem. Exchange ratio, if basis is not given, the question is not even telling me the basis, then we have two options. One is called minimum exchange ratio, second is called maximum exchange ratio. Minimum is from your point of view because you are saying at least give me so much. Maximum is from my point of view. This leads to minimum consideration and maximum consideration. What is minimum consideration is you at least want your pre-merger value. You at least want your pre-merger value. So I will have to say 100 is there, 200 is there, put together became 600. In this 600 you at least want 200. You at least want 200. Balance 400 is mine. Balance 400 is mine. This is called minimum consideration. What is maximum is 600 minus my earlier value. 600 minus my earlier value, that is post merger value, minus the pre merger value of acquiring company. So I can now give you a consideration of 500 and I will at least have 100. My earlier value 100, at least 100. In minimum, your earlier value 200, at least 200. Your earlier value 200, at least 200. In case of maximum, my earlier value 100, at least 100, at least 100. Decision on sale of share. Now, once this consideration is calculated, you will divide as 200, 400, whatever. My value and my shares are already known. My value, equal to my shares. My shares cannot change. Balance is your share. Balance is the balancing figure. Decision on sale of share. How do I decide whether to sell the share or continue with the company in a merger exercise? A merger exercise is going to happen. Should I continue with this company or I sell the share because I don't know whether merger is good or bad? To decide that, two types of question will come. One is called opportunity cost of capital given. Second is opportunity cost not given. This is more logical to me. If they don't give opportunity cost, compute gain or loss at a market price level. Gain or loss at a market price level. How do I calculate gain or loss at market price level? Post merger equivalent. Post merger equivalent MPS. Pre merger MPS deducted profit or loss. When you do this analysis, the pre-merger MPS may have already gone up also. It could have gone up. If it has gone up, take the gone up number and find out is there a profit or loss in merger. Profit, continue. Loss, exit. This is if opportunity cost not given. But if they end up giving opportunity cost of capital in the question, I don't agree to this approach fully. But if they give you, we calculate something called as earning yield. What is earning yield? Is earning, first understand yield means the denominator is going to be market price. Most of the dividend yield, denominator market price. Earning yield, denominator is market price. So yield is market price denominator and numerator is EPS. Numerator is EPS. But only thing is market price is pre-merger, today price. EPS is post merger. EPS is post merger. Market price is today. So market price today, post merger, I'll take equivalent. I'll take the equivalent number because I cannot take the normal number. Post merger, what I am going to get is the equivalent number. So my equivalent EPS divided by my MPS today into 100 is 10%. My opportunity cost is 14%. I don't want to continue. You are giving me only 10%, whereas I have another opportunity at 14%. I don't want to continue with the company. If earning yield is greater than cost of capital, I will continue. Lesser than cost of capital, I'll sell the share. How do I calculate earning yield? Earning yield is calculated as EPS by MPS equivalent. Equivalent EPS divided by MPS today. Value of original shareholder. Now what this concept says is, you are saying merger will give gain, all that is and all is okay, but if merger does not give gain and it fails, what is the loss or profit for both the people, or what will happen to both the set of shareholder? So in this scenario, We just calculate the value as if merger will not give any gain. How do I calculate? Pre-merger value of AC plus pre-merger value of TC, pre-merger shares of AC plus whatever extra shares I issue, So the calculation is 1000 plus 500, and this 1500 is held by two people. No need to remember the formula. Held by two people. I hold 100 shares and I give you 20 shares. So 1500 split is 100 of mine, 20 of yours, and this is called value of original shareholders. Value of original shareholders. The issue here it can happen is, in case the merger fails to give gain, then it can lead to problem for people. If it fails to give gain, it can lead to problem for people. Now, overall gain, which I started initially saying that I want to gain out of the merger exercise, which is post merger value minus the pre merger value of AC and TC because of PAT or because of P multiple, will be enjoyed by two people. Either you enjoy it, you are TC shareholder, or I enjoy it, I am the acquiring company shareholder. What you enjoy is called true cost of merger, or net cost of merger, or gain of TC shareholder. Balancing figure is my gain, which is called NPV of merger, or gain of acquiring company shareholder. NPV of merger or gain of acquiring company shareholder. Balance is my gain, and whatever I am always balancing figure. I am always balancing figure in the process. Post merger EPS. If it is stock issued, very simple. Earlier PAT plus new PAT plus the synergy gain divide by earlier shares plus the new shares issued. The table itself will give the answer. In case I do a cash offer, I'm not going to issue any shares to you. So denominator will not change. Numerator will change because of two reasons. When I issue shares to you, when I give cash to you, I need money. This money could come by taking a loan. If it comes by taking a loan, please deduct the interest cost. Or this money could come by breaking the FD. In case you break the FD, again consider opportunity cost. So my PAT, your PAT also will belong to me, but for me one extra expense is there. The expense is interest cost. Book value per share. What is book value per share? Is what is the value as per my books of accounts, technically called net worth. Divided by number of share. Net worth is calculated as share capital plus reserves minus fictitious asset. Or if you go through asset side route, total assets, remove the fictitious asset, remove the current liability, remove the debt, remove the preference, everything other than equity, divide by number of shares. This will help in some question where the basis is BVPS. The basis can be BVPS. Free float market cap. What is free float market cap? Is shareholding by non-promoter, or shareholding by general public, which can be normally bought and sold. Promoter doesn't do buying and selling. His job is not to do buying and selling. Promoter job is never to do buy and selling. So shareholding by whom? Non-promoter. How do I do the free float market cap calculation? So free float market cap is nothing but total into minority holding, into the minority or non-promoter holding. Some question will say free float is 200 lakh, promoter is holding 40%, which means others are holding 60%. 200 by 60% is the overall value. 200 by 60% is the overall value. Impact of bonus or split. Whenever you do bonus or split, overall value cannot change. Overall value of the company cannot change. But what will change is number of shares will increase. Along with number of shares increase, NPS will go down, BVPS will go down, EPS will go down. Overall value will still remain same. What will go down is EPS, MPS, BVPS, all this will go down proportionately. Nothing like that. There are cases where promoter holding is less also. Impact of revision in growth rate. What is impact of revision in growth rate? Is we normally use a Gordon's formula to value somewhere. What is the Gordon's formula? Says V0 is equal to D1 divided by KO minus G, or call it as FCFF1 by KO minus G. When I do this valuation, growth is a very important number in this. A question says that a company is growing today at 4%. Using this 4%, I applied the formula where V0 is known, FCFF1 is known, growth is known, KO is balancing figure. KO is balancing figure. You can also say KO or K is equal to D1 by P naught plus growth rate. You got the KE number or the KO number, whatever way you want to call it. After you got this, suddenly now I'm saying, no, you got this is okay. You apply the same formula again, but now use that KO which you calculated, but growth is changing. Growth is changing. If growth changes, value of TC business will increase in case growth rate increases. First, existing cost of capital, then revised values overall dividends by existing KO minus the new growth rate. This increase, whatever happens, will somewhere be used in this formula. Pre-merger value of AC plus pre-merger value of TC plus the valuation gain plus the valuation gain from the merger exercise. So this can lead to any extra gain. The price which we pay for a share can be broken down into multiple components. This is called decomposing of share price. Price can be broken down as EPS into P multiple. EPS can be broken down as ROE into BVPS. ROE into BVPS. Clear? What is the use of this? Once you break it down, you get ROE. Question will give retention ratio. ROE into retention ratio will give you growth. ROE into retention ratio will give you growth, which is where my next concept comes, final exchange ratio. What can be the final exchange ratio in a process? I'm saying it can be 1 is to 1, 2 is to 1, 5 is to 1, 10 is to 1, 0.5 is to 1. It all depends on how good we both are in negotiation. When the negotiation starts, you could be the stronger company or I could be the stronger company. It all depends, because it depends on, it's never acquiring company is always stronger or the target company is weaker. There are possibility that the target company is stronger and acquiring company is weaker also. First, find out who is stronger. How do I find? P multiple, growth, brand, cost of capital, return on equity. Once you find out who is a stronger company, if I am stronger, I'll put down the ratio very low. If you are stronger, you will increase the ratio. Closer to, yeah, this is an error. Closer to lower limit if acquiring company is stronger, and closer to upper limit if target company is stronger. There's an error there. Okay, closer to upper limit if target company is stronger. Next point is intrinsic value. What is intrinsic value? Is real worth of a company. Intrinsic value is nothing but a real worth of a company. Real worth of the company is equal to market price, if the problem is silent, is equal to market price. So there was one question where originally they gave market price 20 is to 40. This was one basis of exchange ratio. Then they said intrinsic value basis I want to use. One company they gave intrinsic value, other company we continued the same number. This I've already discussed. Exchange ratio based on adverse parameter. If you have any adverse parameter, you are not going to do swapping. Like NPA, expense ratio, COGS ratio. What is adverse parameter? Something which I want to minimize. It is not based on my value and the other company value. Ratios related to bank merger. In case of bank merger, we had two ratios which you have to be aware of. One is NPA percentage. NPA percentage is very simple. NPA in rupees by total advances into 100. You will have for one company, you will have for another company. You have to do a weighted average and get the third company. How will you do? You will write NPA advances, GNPA percentage, first plus second is third, and the balancing figure. The balancing figure is the overall. Same way I can do capital adequacy ratio. What is capital adequacy ratios? Am I having adequate capital? In the company for the risk which the bank is taking? The formula for capital adequacy ratio is net worth divided by risk weighted asset. Net worth could be there in the question. Capital adequacy could be there. Risk weighted assets is balancing figure. In the other one, GNPA percentage will be there. Advances will be there. In rupees is balancing figure. So depending on the data in the question. Post-merger PAT of next year. Now I have to estimate the post-merger PAT of next year, not current year. Why next year? Gordon's formula you're going to use. If you do next year PAT calculation, normal logic is first company PAT plus the second company PAT into 1 plus the post-merger growth rate. Whatever is the post-merger growth rate, add that and add any synergy gain. In case question says I've already invested the retained earning. invested the retained earning. What is retained earning? Already reinvested is the individual companies already did the capex for the next year. Then whatever was the PAT of the acquiring company, add its erstwhile growth rate. PAT of target company, add its erstwhile growth rate, and add the synergy gain. Second year onwards, you will shift to the merged company growth rate. Second year onwards, you will shift to the merged company growth rate. There's one problem where promoter wanted to reduce his shareholding to comply with SEBI norms. To comply with SEBI norm. Practical world, if I want to comply, I will sell the share. But the question said, no, no, you're not going to sell the share. You're going to give free shares. For example, I am having 80% holding. Let us assume the company has 100 share, which means 80 is mine, 20 is minority. This 80 I want to bring it down to 60. This 80 I want to, number of shares, not percentage I want to bring down. How will I bring down the percentage? If my 80 by 60% becomes the overall share, 80 by 60, 133. So from 100 share, 80-20 is the split. In 133, 80 will be mine, and balance I'll give to minority as a free share. So minority are allotted extra share. Minority are allotted extra share, and this will give you the bonus ratio. This will end up giving you the bonus ratio. Okay, fund available for merger in case of cash consideration. Whenever I'm doing a cash consideration, I need money. How much money is available to do a merger? Let's understand. First, every company will have something called as a debt equity ratio. What is the debt equity ratio going to tell us? How much borrowing can the company take? Maximum debt is equal to net worth into debt by equity. So let's assume this is 200 lakh. In this 200 lakh, I already have 20 lakh borrowing. You have 50 lakh borrowing. I acquire yours also. So 20 plus 50 already there. So I can borrow another 130. I can borrow another 130. On top of it, I have some 20 lakh cash. 130 plus 20, 150 is maximum I can pay. Maximum I can pay you with the available liquidity. With the available liquidity, this is the maximum I can pay you. Post merger shareholding, this is weighted average calculation. What is weighted average calculation? I have some shares in my entity, also in the other entity. So existing shares plus whatever new shares are going to be allotted to me. I have existing 10 shares in my company, and 100 is my company share. In the other company, I am allotted another 3 share, and the other company allotted totally 30 share. 10 plus 3 divide by 100 plus 30 is my post merger holding. 10 plus 3 divide by 100 plus 30 is my post merger holding. Some of these concepts you'll understand it better only by pausing, going through the MCQ example. I will not do any examples now. So at any place you have to go through the examples in case you want more clarity whenever you see this at later point of time. Last is distribution of shares in case of partly paid share. What is partly paid share is, I did a merger exercise. I said I'm going to allot 5,000 share to the other party. Normally what we do for 5,000 is we find out how many shares are there and allot. But here there are fully paid as well as partly paid. Your job is to convert the partly paid share into equal and fully paid, and then do the distribution. Then do the distribution of shares. This is not a logical item. Valuation of debt and equity of a merged firm. What is valuation of debt and equity of merged firm is, there is a company 1, there's a company 2. Company 1, you are valuing the debt and equity separately. Company 2, you are valuing the debt and equity separately. How will you value debt and equity? They will give overall value. In that, debt is paid first, equity is balancing figure, some probabilities will be given, do weighted average, complete the valuation of debt, complete the valuation of equity. Individually do the valuation and then put the total, that is the merged entity value. Put the total, that is the merged entity value. I don't fully agree to it, but this is what we have to do. Next is ROE as per DuPont framework. DuPont framework. Why ROE is needed is growth calculation. ROE into retention ratio. ROE into retention ratio. For that calculation, I need ROE. How do I calculate this ROE as per DuPont framework? Is net profit margin. The formula is PAT by sales into sales by asset into asset by equity. PAT by sales is net profit margin. Could be given in the question. Sales by asset, sometimes they may give asset by sales, you have to do inverse, and equity multiplier is asset divided by equity. Asset divided by equity. What is asset? Debt plus equity. Asset is equal to what? Debt plus equity. If you do not have any information, question may say debt equity ratio 4:1, which means asset is 4 plus 1, equity is 1. Asset is 4 plus 1, equity is 1. This is what you will do in case they do not give you the number for asset separately and equity separately. Internal reconstruction is something which you learn at inter level. You would have learnt there. This is there in 2 3 areas. You have to first find out capital reserve. What is capital reserve? Is there are certain items which are increasing the net worth, certain items which are decreasing the net worth, and then prepare a reconstructed balance sheet or a restructured balance sheet. Prepare a reconstructed or a restructured balance sheet. Minimum consideration for promoter. Normally, minimum consideration, when I explained initially AC and TC comparison, minimum consideration was equal to pre-merger value of yours. Pre-merger value of yours. Promoter is saying, no, no, I don't want only pre-merger value. You give me something extra. I asked why extra? Because promoter was enjoying all of this. Higher remuneration, some perquisite benefits, all this extra benefits were coming to me, which I put a value. All the extra benefits, I put a value for those extra benefits. And after putting a value for those extra benefits, I tell you, please pay me this extra. Pay me this extra. I'm putting a value for all these benefits which are there. So then minimum price is equal to existing price plus this extra benefit divided by the number of share. Extra benefit divided by the number of share. Again, this chapter is also done in around 30 minutes. A very simple area. If you understand the crux, there are multiple things which are there. If you understand the crux, it will become very simple. Clear? Okay, 2 minutes break. Okay, let's now move to derivatives. What, let's understand first the basis of derivative. What derivative is basically saying is that you are planning to buy something today, derivative is not needed. You are worried little bit about the future scenario. For future scenario, I need certain hedging tools. There are four types of derivative instrument: futures, forwards, options, and swaps. These four instruments will help me in hedging my risk of the future. Hedging my risk of the future. I'm more worried about what is going to happen in future, and because of this, I want some protection against it. It could be hedging, could be speculation, could be arbitrage, but we are worried more about the future rather than the past. So we have two types of market. One is a spot market or a cash market. This will give me the spot price. I went to a supermarket, they told me chocolate price is 50 rupees today. Same supermarket can also give me future price. They can say that tomorrow, normally normal supermarket will not give, but we have a stock market which will say I will give you the price for the future. Example, we had a TCS where the spot price is 3786. The Feb 27 price was 3. This was actual data I had pulled out in the month of Feb. 3789, 3810, and 3832. Chocolate price in the spot market is 3780. In the futures market, the chocolate price is 3789, 3810, 3832. We have three types of we have different types of in the futures you can have multiple prices depending on the time period. So this is technically called TCS Feb futures. This is called TCS March futures. This is called TCS April futures. I went, asked for the chocolate. He gave me the rates and all. In this also, I have two types of futures price. One which the market is giving. One which the market is giving. The market is telling the rate is 10, 15, 20. And second one which I do my own estimation. I do my own estimation. I say, no, no, I don't agree to what market is giving and all. You are telling me chocolate will be 55, 60, 65. I feel it should be 54, 59, 62. I do my estimation. I don't agree to what the market is giving. Actual futures price is what which is quoted in the market. Any buying or selling will always happen only at this rate. Any buying, selling, hedging, speculation, arbitrage will only happen at actual futures price. Will only happen at actual futures price. Then what is the use of fair futures price? Fair futures price means price at which the future should have quoted in the market, and I'll compare this with the actual futures price and see whether any undervaluation is there or overvaluation is there. Now, how do I compute fair futures price? We have a very simple formula: spot price into 1 plus R, or spot price into e power RT. Power n will come in a rare scenario in case you do some extra compounding. Otherwise, it's just into 1 plus R into just 1 plus R. So first formula is spot price into 1 plus R and spot price into e power R T. Now, what is spot price? The price which is prevailing in the market today. What is our risk-free rate of interest? What is T time period in years? Time period in years. If question says 1 month, time period is 1 by 12. R is for a year. R is for a year and T is also in terms of years, which is e power RT. What will you do for 1 plus R? I'll explain as we proceed. If the compounding frequency changes, if there is no change in compounding, that is, some question will say you compound 2 times, you compound 3 times. If compounding is not happening multiple times, R is equal to annual rate into the number of months by 12. Annual rate into the number of months by 12. If you're doing a 6-month future, annual rate into 6 by 12. 3-month future valuation, annual rate into 3 by 12. The first thing is there could be an adjustment in the formula. In the formula itself, I need some adjustment. Now, what is the adjustment I want? If there is no dividend, no storage cost, don't make any adjustment. Zero adjustment to be done. If there is a dividend, see whether the dividend is in rupees and 1 2 3 time or the dividend is continuous dividend in percentage. Continuous, when can continuous be? It can be in case of Nifty or Sensex and all. Continuous dividend is possible. If you have continuous dividend, replace R with R minus Y. Replace R with R minus Y. R for a year, Y for a year. Do replacement, then do into number of time period, all that you do. R minus Y. In case there is a dividend in rupees, then replace the spot price with adjusted spot price. What is adjusted spot price? Is deduct the present value of dividend. How do I deduct present value of dividend? Depends on whether you are using e power RT for compounding, then you divide by e power RT. And if you are dividing by, that is multiplying with 1 plus R, divide here by 1 plus R. Present value you have to divide. Continuous compounding, continuous discounting. Normal compounding, normal discounting. The compounding could be for 6 months because it is a 6-month future valuation. Discounting is only for the number of months the dividend is getting paid. If it is paid after 3 months, 3-month discounting. After 2 months, because from the third month I want to bring it to today, I want to bring it to present value. So if dividend is paid after 4 months, discounted back by 4 months. Dividend is paid after 2 months, discounted back by 2 months. But valuation of futures into 6-month time period. So e power RT which you use there and divide by e power RT may not match in many questions. It may not match in many problem. If you have storage cost, it is an extra problem. So you add the storage cost in the present value. You add this storage cost, that is spot price plus PV of storage cost, or R is replaced with R plus S. R is replaced with R plus S. Now, how do I calculate this e power value, which is 1? For example, I want e power 0.02, 1 plus 0.02 by 1 factorial, 0.02 square by 2 factorial, 0.02 cube by 3 factorial. This will give me the value for e power x. These are the points which I normally use for valuing a futures. First, you tell me the spot price. Second, you tell me the time period, 3 months, 6 months, 9 months, 12 months. Third, what is the risk-free rate of interest? Fourth, any dividend, any storage cost. And last comes the compounding frequency. Practical world, it is only continuous compounding. It is only continuous compounding. Exam purpose, it is not going to work that way. So they have given some compounding frequency. Now, what is the rule? If the question uses the word CCRFI, daily compounding, e power value, natural log value given in the question, all this you go ahead and do CCRFI or continuous compounding. CCRFI or continuous compounding. If this is not there, see any other indication. It says monthly interest, quarterly interest, 1 month interest, 2 month interest, 3 month interest, 5 month interest. If they use such words, then do that compounding. If nothing is there, just do into 1 plus R. Just do into 1 plus R in the formula. What is R? Proportionate interest rate. That is annual rate into 3 by 12, annual rate into 6 by 12, annual rate into 9 by. If it's a 3-month derivative contract and it's monthly compounding, 3-month contract, what you will do is you'll first calculate monthly interest and do power 3. Power 3 if it's monthly compounding. No indication, directly do into 1 plus 3 month interest, no power, no power on top of it. No indication, compounding once. Why we are doing all this? To see is there any opportunity for arbitrage, to see if there is any opportunity for arbitrage. This you exactly do it in exam, no need to do detailed step and all. Arbitrage, how do I calculate this? Is there a difference between fair futures price and actual futures price? If there is a difference, arbitrage gain is higher number minus lower number. That's all. Higher number, no formula. Higher number minus lower number. Let's assume FFP is 1000, AFP is 1200. In this case, AFP is greater than FFP. Futures are overvalued. Market is giving a very high value. I don't know why they are giving overvalued. Sell in futures, buy in spot. If you want to buy in spot, you need money. Take a loan. Take a loan. Final arbitrage gain is difference. You want to do detailed step, you have comfort, do it. No detailed step, you don't have comfort, just write the gain number and write this 5 points. Futures overvalued, sell futures, buy spot, borrow to buy share. Just write this. More or less, you'll be able to get to the final marks which is there for a question. In case AFP is less than FFP, futures are undervalued. Buy futures, sell spot. For selling in spot, I need share. If you don't have, you may do a short sell if it is allowed. You are short sell not allowed, share also not there, you cannot employ this strategy. Create FD for sale proceeds. When we did this, normally the gap between FFP, normally the gap between the FFP and AFP is called as arbitrage gain. There are certain allied terms which I'll introduce now. One is called convenience yield. As I proceed, I'll explain. First is cost to carry. What is cost to carry is, if I'm having a share and I'm holding it for the next 3 months, holding it for the next 6 months, I do incur some expense on that. One is the notional interest cost which I incur because I bought the share. Second, I may have certain other cost also in case some demat charges are there, some depository participant charges are there. All this is called cost to carry. The how you calculate cost to carry is FFP as per the formula minus the spot price. The gap is called cost to carry the asset, which can be any types of cost, like interest cost can be there. If you have a physical asset like gold, storage cost can be there, and there can be some benefits also, like income can come, which is netted off in the formula automatically. This dividend yield, where R is replaced with R minus Y, has one headache. Normally, the question may not give dividend yield every month and all. But if they ended up giving every month, saying that first month 5%, second month 2%, third month 0, fourth month 10%, then same yield, no problem. Take the given yield as the final yield. But if they give different yield every month, then I have to take average of the yield of the time period for which I'm doing valuation. Average of the yield of the time period for which I'm doing the valuation. If I'm valuing from June to August, take the average of June to August. If you're doing valuation for August to December, take average of August to December. Convenience yield. If you hold anything in physical form, if you hold anything in physical form, there is always an extra benefit. For example, if I hold gold in physical form, I can wear the gold, I can give the gold as a security and take a loan. So there is always an extra benefit. Because of the extra benefit, the formula which you use does not consider this extra benefit and all. So you apply the formula and you say fair futures price is 1000. Question is saying no, it can't be 1000 and all, because spot is better. You are saying 1000 and all, but market is saying it will be only, as per the question, only 980. As per the question, it's only 980. You are saying 1000, but market is saying only 980. We will go physical is better, futures and all is bad, futures and all is bad. So convenience yield is equal to FFP. This goes to this side. Okay, convenience yield is equal to FFP as per the formula minus FFP as per the question. FFP as per the formula. This is called future value because you're comparing to future value. Discounted to today, you'll get the present value of convenience yield. You'll get the present value of convenience yield. To put it simply, this is the extra value you attach to the allied benefits. What are the allied benefits? Wearing gold, giving it as a safety, giving it as a security. All these extra benefits you cannot have it in futures. Because of this, there is an extra benefit on the spot price and disadvantage in the futures price. Disadvantage in the futures price. implied risk-free rate. Now, what is implied risk-free rate is if there is a risk-free rate given in the question, that is the normal risk-free rate for anyone. If question says 10% risk-free rate is equal to 10%. But if there is an arbitrage opportunity available, I can earn more than 10%. I can earn more than 10% because there is an arbitrage opportunity, and arbitrage means making profits without taking risk, making profits without taking risk. So in case that option is available, what it says is normal risk free rate, which is 10%, extra gain on the spot price into 12 by m into 100 is the implied risk free rate, is the implied. And what is arbitrage gain? Difference between ffp and afp, ffp and afp. Clear? Any doubts on this? Next comes types of settlement. Now there are two types of settlement which can happen in a futures. One is a physical settlement, which is I give the share and get the money, or I get the share and give the money. Physical settlement means pay cash, receive the share, or deliver share and get the cash. Other option is to do net settlement. Net settlement. In net settlement, what will happen is I'll not give the share and all. I'll not give the share and all. I will be pressing something called as a buy button and a sell button and calculate profit or loss. How do we calculate this? You see, what did you originally do? What did you originally do? You could have originally sold something at some rate. Originally, it could be a sell or buy. So first find out, did we sell something or buy something in the futures market, and take an opposite action on the last day. The difference is called as the net settlement amount. The difference is called as the net settlement amount. This concept, you may not get it full clarity now because here I'm just explaining very crisp. In case you want more clarity on the net settlement part, the detailed video which I've talked about, in case at later point of time, whenever you're seeing the video and you need more clarity on it, this is one area which explanation may not suffice at this point of time, because there I do a very lengthy explanation. Here I've done a very brief explanation. Concept is very simple. I press a sell button, I press a buy button, and the difference is called as the profit or loss. The difference is called as profit or loss. This formula and all don't try to remember. Just understand the logic that there is a buy happening one time and a sell happening one time, and the difference is called profit or loss. Clear? Okay, I take a break of 15 minutes now and then I continue. 15 minutes break. Okay, let's continue with it. So we learned about net settlement. Now we have two types of markets in the practical world. One is called as a contango market and second is called as a backwardation market. Contango is a market which is normal in nature. What is normal in nature is the futures price is more than the spot price. That is what normally will happen. The futures price will be more than the spot price, which technically means negative basis. Why negative? I'll explain as we proceed. And then backwardation market is a reverse market, a rare scenario. A rare scenario, you may find a backwardation market where the futures price is on the lower side. Why this is negative and positive basis? Because basis is calculated using this formula, spot minus futures. So when you calculate basis using spot minus futures, if you get a negative number, it is a normal market, and if you get a positive number, it is a backwardation market. Rather than basis understanding, you go through the logic. Logic is backwardation means it is reverses happening, and a normal market means futures is going up as compared to spot. Next comes the concept called beta. This is extensively used for the purpose of hedging, because what we do for hedging is when I want to hedge my portfolio, exact portfolio may not be available in the futures market. I have Bharadwaj Institute in the spot market, shares of Bharadwaj Institute, but futures market it may not be listed. So the hedging normally happens through Nifty futures or index futures or BSE futures or NSE futures. Because of this purpose, I have to first calculate a hedge ratio. What is hedge ratios? Technically, the ratio between the spot market value and the futures market value for the purpose of hedging. How do I calculate? If beta is given, okay. Otherwise, portfolio chapter where we have SD of market by SD of security by SD of market into correlation coefficient. Once this is there, this can also be used to find out the percentage change in share price. When I did mutual funds in the last scenario, I was talking about percentage change in the equity component, which is percentage change in market into the beta, percentage change in market into the beta. Hedging. When I do hedging, what hedging means is I want to make the beta zero. Perfect hedge. Make the beta zero. full hedge, make the beta 0. Some question may say I have a target beta 0.5, use the beta as 0.5. That is, you want after hedging 0.5 beta. After hedging, you want 0.2 beta. After hedging, you want 0.1 beta. After hedging, you want 0.7 beta. And some question may say I want to hedge some specified percentage. If you want to hedge 60%, old beta minus 60%, old beta minus 18%, old beta minus 120%, old beta, if you do minus 120, positive beta will become negative, positive beta will become negative. Now this is the format we use: security, beta, weight, product, and extensively used format by us, where certain rules alone you'll have to remember. First is weight. In the weight column, BSE futures or NSE futures will not come in the total. It will not come in the total. Second, what is the beta of these futures? One time, because they are representative of the market. Third, purchase. If you are buying something, positive weights, and if you are selling something, negative weights. Purchase is positive, sale is negative. Sale is negative. What is the amount to be hedged? This is the what we are trying to calculate, which is equal to weight of index future. Weight of index future, and number of contracts then will be calculated based on actual futures price, based on actual futures price, never on the basis of fair futures price. AFP if not available, FFP is assumed as AFP, both not available, spot assumed as futures, spot assumed as futures. There was one question where they gave natural log value in the question. If you have natural log value in a question, if it says natural log 1.105, using natural log, if the cost of capital is 10.5%, they have to give natural log for 1.105. 10.5 is 105. If they give this natural log value, a normal value can be converted into CCRFI, and a CCRFI can be converted into a normal value. I can do the conversion of normal to CCRFI, CCRFI to normal. Changing beta can also happen through risk-free investment. Like you do it through futures, you can also do it through risk-free investment. For futures, we use this format. Index futures is balancing figure. Same format we use it even for risk-free. But only thing is risk-free, beta is 0 and weight will come in the total. Weight will come in the total. In case you want to increase risk, borrow money, and reduce risk, you have to invest money. For extra investment, I may sell shares or I may bring in fresh money. Two scenarios. For borrowing, after borrowing, I may buy more shares or I'm yet to decide what to do with the money. So two scenarios can even exist there. Profit or loss calculation. If you buy something and price goes up, buying is plus, price going up is plus, plus into plus is profit. Buy something, price goes up, profit. Buy something, price goes down, loss. Plus into minus. If you sell something, price goes down, profit. Minus into minus is profit, and minus into plus is loss. And this is what we are trying to play around in the hedging. In one place I'll have positive position, another place I'll have negative position. Positive position, price goes up, profit. Negative position, that time will have a loss, and in case price goes down, negative position will have a profit and this will have a loss. Effective realization in the futures market, realization in the futures market will always happen only at the spot rate, most of the time we will do net settlement, realization as per spot rate on the expiry date. Again I say realization will always happen at the spot rate, and plus or minus net settlement, how net settlement? Buy button and sell button, the gap will give you the net settlement amount. Asset swap, like I had told, there are four things: forwards, futures, option, swap. What is asset swap? Is I'm swapping one return with another return asset. For example, I earn out of fixed deposit, I give my FD return to you, you earn out of mutual fund or you earn out of Nifty, you give your return to me. So I swap my return with you and you give your return to me. In the end, net settlement will happen. It can be return from Nifty versus return from FD. When you do this calculation, return from FD though will be positive, but Nifty can be negative also. So minus, another minus, the net amount can significantly change. The formula is return from one asset minus return from another asset. What you pay will come in the second time and what you receive will come as the first item. That is, what I have to receive is here and what I have to pay is the later one, and then we find out the difference. We find out the difference. Next comes the concept of margin. Anybody who enters into a futures contract, I am worried whether he will fulfill the obligation or not, because I cannot trust the person. So I am worried whether he will fulfill the obligation or not. So broker says you have to give me some money initially for you to enter into the contract. Without giving the money, I will not allow you to enter into the contract. So I want you to give me money. After you give me the money, you can enter into contract. That's called initial margin or maintenance margin. What is maintenance margin? As we explained, initial margin is deposited at the start of the contract. If they say value of one contract, some percentage is given, multiply with the number of contract. Value of one contract, some percentage, multiply with the number of contract. Other option is what is the daily change? Daily change, to be on the safer side, three times of standard deviation. To be on the safer side, three times of standard deviation. Then I calculate maintenance margin, which can be a specific percentage of initial margin or on the contract. What is the maintenance margin? Is if initial is 50,000, maintenance could be 40,000. Your margin value keeps going up and going down every day basis. How you do? You write date, price, change in price, profit or loss, and this profit or loss is debited to the margin account or credited to the margin account, and the value keeps changing. If the value goes above 50, you can withdraw that money. If the value goes below 40, you have to replenish it back to 50. You have to replenish it back to 50. If you are in between, broker will not disturb you. So amount margin higher than initial margin, it can be withdrawn. Lower than maintenance margin, margin call. And if you are in between, no adjustment. Something I invested through futures, I made some investment through futures route. I did not make a real investment through the futures route. When I do it through the futures route, what I pay on this, the formula is what I get back divide by minus what I give divide by what I give into 100. What I give on day zero will be a very small amount. I pay some margin, maybe some commission, some brokerage. Whatever I pay on day zero is the denominator, and what I get back is the profit which I make out of the transaction. So profit made divided by what I gave into 100 is the return on investment through futures route. Return on investment through the futures route. Then comes the option contract. Now in futures, I have a problem. The problem is you are forcing me to buy or sell at that rate in the future. If it is favorable, I want to buy. Unfavorable, I don't want to buy, which is where an option comes. So I went to a shop, asked the shopkeeper, what is the futures price? He said 60. I said, no, I don't like 60 and all. Then he says, I'll give a voucher to you. In this voucher, I write a letter. The letter will say that if you want, you can use this voucher to buy chocolate at 60. You don't like it, don't buy at 60 in future. So if price in the market on future is 70, 80, I'll use that letter. If price is lesser, I will not use the letter. It gives me a flexibility. It gives me a flexibility whether to use that price or not. We have two types of option: call option, put option. Call gives me right to buy, not an obligation. Put option gives me right to sell, not an obligation to sell. There are two parties: holder or buyer, writer or seller. The holder or buyer is the one who is getting that letter from the shopkeeper. I have that right. I have that right. And the right is given by some other person who's called as the, so gets the right to buy or right to sell. Other party gives me the right to buy or right to sell. But for getting and giving this right, I have to pay the premium and he will receive the premium. I'll have to pay the premium and he will receive the premium. Put does not mean receive. Writer, because many people think put means we are seller. No. Put and call has no implication. It is buyer and writer. To put it simply, we'll have four parties: call holder, call writer, put holder, put writer. Call holder gets the right to buy. Call writer gives the right to buy. Put holder gets the right to sell. Put writer gives the right to sell. Option exercise. I am holder. I will decide whether to exercise it or not. I am writer. Still the holder will only decide. Still the holder will only decide. Just because I am the writer, I don't have any power. Only holder can exercise it. Only holder can exercise it. And if he exercises, there will be a profit for holder. And if he decides to exercise, if we are writer, holder will only decide and it will be a loss for me. It will be a loss. On the last day, holder will have profit, writer will have loss if it gets exercised. On day zero, holder is paying the money, writer is receiving the money. Writer is receiving the money. There are two types of option. One is an American option and second is an European option. American option can be exercised at any time. It can be exercised at any time before the expiry date. European option can be exercised only on the expiry date. One another important term is exercise price or strike price. This is the price at which any buying or selling will happen. In a call option, you have to ask, do you want to buy at this price? That price is called exercise price. And in put option, you have to ask, do you want to sell at this price? That price is called exercise price. Three types of options are there: in the money option, at the money option, out of the money option. In the money option are those which can be exercised by the holder, which can be exercised by the holder. Out of the money are those options which are going to lapse, as per the holder. At the money option are those where there is no difference. You are indifferent whether to exercise it or allow it to lapse. This word will be critical in few questions because some problem may not give the exercise price or the market price, and they'll say at the money. At the money means both are same. Price change: if the price is likely to go up, I can either go for buying a call option because call option will get exercised, or selling a put option. When you sell a put option, put will lapse. As a writer, I want the option to lapse. As a holder, I want the option to be exercised. Writer wants it to lapse, holder wants it to be exercised. Likely to go down, opposite, long put or short call. Whatever premium I pay has two components. The first component is the real value, which if you are saying it is in the money, real value is there. Out of the money, zero value. Balance is called time value. And the time value will keep going down as the time period increases. As the time period increases, the time value will keep going down. Option utility. What is option utility? Is call option is useful for restricting the maximum purchase price, and put option is useful for receiving the minimum selling price. So if you're planning to sell something, put option. You're planning to buy something, call option. At what price you want to buy? Question may say extra 5%, less 5%, that call option. Selling extra 5, less 5, that put option. Break even price, profit is okay. Break even prices in a call option, the break even prices, strike price is my outflow, premium is also my outflow, so both are added. In a put option, strike price is my inflow, premium is outflow, so I subtracted. Premium is my outflow, both are outflow, added, but one outflow, one inflow, do the net amount. Next is, how do I find this premium amount? Option valuation model. What is the fair price of the option? We have multiple model. First is PCPT model, risk neutral and binomial model, which has a subpart called replication, and a Black-Scholes model. PCPT said only one thing: share plus put should always be equal to call plus PV of exercise price. This method cannot be used just to do the valuation. If you give me three data, I can use it. If you have only, you don't know the share price or you don't know the call price as well as the put price, this method cannot be used. This method is useful when you have done valuation of call, want to value put. You have done valuation of put, want to value call. So in the share price, there can be an adjusted share price. What is adjusted share price? Is share price minus PV of dividend, and in case the yield is there, then you adjust it in the share price itself. No adjustment in R. Share price into e power minus yt are divided by 1 plus y. This when you do, you are removing the cum dividend price to the ex dividend price. You are removing the cum dividend price to the ex dividend price. This is PCPT model. Then comes risk neutral model. Risk neutral model said, first give me two judgment prices. The two judgment prices does not mean probability is 50-50. Then how do I calculate probability? Judgment price 1 into P, higher price into P, lower price into 1 minus P is equal to fair futures price. How do you calculate fair futures price? Spot price into e power RT, or spot price into 1 plus R. Once you get that, get the probabilities. After the probabilities are calculated, for the two prices, calculate intrinsic value. On the last day, multiply with the probability, you will get future value of call option or put option discounted to today. Binomial model is same as the earlier model. Only thing is the two changes which are happening. First, you will start with one price, two prices you will get. Again, another four prices you may get, eight prices you may get. The changes can happen multiple time. The changes can happen multiple time. Here, you have to again calculate probability. For calculating probability, take the first binomial, and FFP at the end of first binomial. The life could be 2 years, but the first binomial ends in first year, FFP at the end of 1 year. The life could be 6 months. First binomial ends in third month. First binomial ends in third month. FFP at the end of month 3. FFP at the end of month 3. Get the probability. Once you get the probability, upside write the same, downside reverse order do the valuation. In this, when you move to one period to another period, you have to consider time value of money. And in case of an American option, it can be immediately exercised, it can be later exercised. I have to do an extra check. The extra check is, what is the value of the immediate exercise and what is the weighted average of the later exercise. Choose whichever is better. Next come Black-Scholes model. Earlier model and all need two judgment prices. Black-Scholes model said, I don't need any judgment prices. You just give me some information and I'll be able to give the value of the share. What did the model say is the value of any option, call option, is spot price today minus the exercise price. Spot price minus the exercise price. Spot price is today value. Exercise price is later value. So bring it to today. Bring it to today by doing present value of exercise price. Do into what? N of D1, N of D2. N of D1 is technically called call delta. And how N of D1 is calculated is by calculating D1. What is D1 is what is the current gap between the current market price and the exercise price. What is current gap is natural log S naught by E, natural log value. Then future gap is R into T, half of variance, zero point 0.5 into the variance into the time period, divided by standard deviation, which is into root T. D2 is item 1 plus item 2 minus item 3 divided by sigma root T, and the shortcut is D1 minus the denominator. D1 minus the denominator. For these two values, you'll have to get the probability, which could be given directly in the question or do interpolation. Impact of dividend. In case of Black-Scholes model, if there is a dividend is given in rupees, replace spot price with adjusted spot price, which is spot price minus PV of dividend. Given in percentage, again replace spot price with adjusted spot price. Again replace spot price with adjusted spot price, because in your formula you need to do S0 into N of D1 minus PV of exercise price into N of D2. So go ahead and do the replacement, no problem. But for D1 calculation, I give you two choices. Either adjust in item 1 or in item 2, depending on the natural log value given in the question. The natural log value can be S0 by EP. If you take S0 by EP, then R will become R minus Y. Or you can do natural log adjusted S0 by EP. Adjusted S0 by EP. In that case, what will happen is you will leave R into T. There are certain assets which have limited life. In case an asset has a limited life, your dividend yield is equal to 1 by life of the asset. When you do PV of exercise price, always ensure that it is only R and not R minus Y. Then a question said EP prevails on maturity date. If exercise price is prevailing on maturity date, it means on the last day, spot price is equal to exercise price. In that scenario, the value of the option will become at the money value 0, be it call option or put option. Now for hedging purpose, we have two options, futures route or option route. Futures uses the concept of beta, which does not change frequently. Options use the concept of delta, which changes frequently. So how do I calculate delta? Delta formula is change in the option price divided by change in share price. Share price 100 became 80, option from 10 became 5. So 10 minus 5 divide by 100 minus 80. You have to calculate the option price. It will not be 10 minus 5. You will have to calculate. How will you calculate? Intrinsic value. How will you calculate intrinsic value? Depends on the exercise price. In this example, if exercise price is 90, this is 10, this will be 0. 10 minus 0 by 100 minus 80. Call as a delta of 0.5. Put balancing figure. Call delta minus 1. Call delta minus 1. What is the use of this delta? To create a riskless hedge portfolio. To create a riskless hedge portfolio, and this will help me in doing something called as a replication model. This will help me in doing something called as a replication model of portfolio valuation. If delta is zero point 0.4, it means zero point 0.4 share and one call option is same. 0.4 share minus one call is equal to risk free. This equation, you use it for two prices, you will get the RF value. Discount the RF to today, zero point 0.4 share to today, call will be balancing figure. Call will be balancing figure. I'll repeat again. Delta of zero point 0.4 would mean one call is equal to zero point 0.4 share. So we'll say zero point 0.4 into 200 minus call value is equal to risk free. 0.4 into 400 minus the call value equal to risk free. The same number will come. The same number will come for risk free. Use that risk free to today's value and today's same equation. 0.4 share minus one call. This will give you the option premium. This will give you the option premium. If a question uses the word riskless portfolio, if the question gives you two probability and they are not matching with RN model, you have to do replication model of valuation. And for return calculation, the question will ask something called as return calculation. You do a weighted average and then compute the return. Next is CDS. What is the CDS? Is I am entering into a contract where I am seeking protection. I'm seeking protection against what? Default risk. What is the default risk? I'm buying a share, no problem. I'm selling a share, no problem. But I'm buying now debenture. When I buy debenture, what happens is if the company defaults, I will not get any money from the company or huge loss can be there. To seek protection against this default, I take an insurance. This insurance is called credit default swap, where a company A raises funds by not issuing shares, by issuing bonds. Bank B is the protection seller. He is giving you protection against the risk by receiving premium, and investor is the protection buyer who wants this protection. What is the use of this protection? In case the company defaults, I'll be getting a settlement from the protection seller, which is bank B in this case. I'll be getting some compensation from this party. Parties involved: protection buyer pays premium, protection seller receives premium. Premium amount is equal to notional amount into the CDS spread. No default on debt, no settlement. Default happens, cash settlement means whatever loss is compensated. Physical settlement means you give the bad bonds and they'll give you the face value. You give the bad bonds, they'll give you the face value. CDS spread is premium. What is the premium we are paying? In case the premium is increasing, it means there is a deterioration in the credit quality. Increase in CDS spread indicates what? Deterioration in the credit quality. If the spread is increasing, as a protection buyer, I was very happy because I continue to pay a lower amount and others are paying a higher amount. So profit is equal to notional amount into the change in spread into the duration. Loss will happen in case the spread is going down. What is the CDS spread? The premium, which has a formula. Probability of the default. If default has a 10% chance, premium will be 10% into 1 minus the recovery rate. 10% loss will happen, but there's a recovery of some 20-30%. So into 1 minus the recovery rate. Option Greeks. These are terms which are associated with option. Delta, we understood what will be the value, change in the value of change in the option price as compared to the change in underlying asset. Gamma, theta, rho, and vega. Gamma measures how frequently the delta will change. I'll not explain much in depth how frequently the delta will change. Theta, T, time, R, risk free, V, volatility. T, time, R, risk free, V, volatility. So theta measures what is the change in option price due to time factor. Rho measures change in option price due to risk free rate factor, and vega measures due to volatility. Volatility is called standard deviation. So first one, delta, which is measuring the value of change in option price due to the change in underlying asset. Gamma measures how frequently the delta is going to change. Theta, T, time, R, risk free, and vega, V, volatility. And volatility. Exotic option, multiple types of exotic options are there. What exotic option means is it is different from the normal option. There are various variants of option. You can go through, it will be self-explanatory. Variant can be like we normally have a call and put option, which is exercised only once. Here there can be 4 times exercise. We normally compare the closing price and the price prevailing in the market. Here what can happen is you can say I want to use the highest price, I want to use the lowest price, I want to use the average price, I want to have a fixed payoff. Fixed payoff is if I it is like a bet, if you win 1000 rupees, if you lose 0 rupees. So multiple variants are there. They are away from the normal option, they are different from the normal option. You keep going through it, you will understand what are they. And the last concept is CDO. What is CDO is, ICICI Bank currently have some money. They have a loan of around 2000 crore. These loans are given to so many people. I am in need of money. When I need money, I transfer this loan book to the CDO and CDO will give me money today. This is what a collateralized debt obligation means. Technically a securitization transaction. It's technically a securitization transaction. I just transfer it to someone and he gives me money today. He gives me money today. Now CDO needs money to pay to the ICICI Bank. So CDO issues this to the investor. Investor gives money. Investor gives money. I pass it on to ICICI, and whatever loan book was there, that will earn returns. And from this return, I'll return the money to the investor. I'll return the money to the investor. Three types of CDO are there. As you go through in the theory segment, you will understand it. I don't want to spend much time on this segment because it is more of a theoretical segment, more or less like securitization. It is more or less like securitization. Clear? So derivatives will become very, very simple if you understand how futures work and how options work. Allied areas may not be that critical. The allied areas like your CDO, exotic options, they may not be that critical, but being aware will be very critical. In case an exam question come, you'll be able to handle a CDS one MCQ type of question has already been drafted in one of the MTP. So it is better to be aware of these concepts. Clear? 2 minutes break. Okay, in portfolio management, there are two important terms which we need to be aware of. One is return, second is risk. Return basically means possibility of earning money, risk is possibility of losing money. I can earn money from SBI in the form of investing in SBI shares as well as in SBI FD. When I invest in SBI shares, it gives me 14% return, but SBI FD only gives me 7% return. Same SBI, but risk is different. SBI equity has a risk of 22% historical data, and SBI FD has a risk of only 1 to 2%. Formats which we use in this chapter extensively. In this chapter, the main focus is calculating return. Once you calculate return, everywhere return is going to be used in our format. We have three format. First format is probability, return, product, deviation, and PD square. Here, return has to be computed, multiply with the probability. If you multiply this together, it is called product. Deviation is whatever is the return minus the sum of the product, and PD square is probability into deviation into deviation. Format 2, repeat it for security A, repeat it for security B, and do a multiplication of the two deviation. Do a multiplication of the two deviation and multiply with the probability. Multiply with the probability. Format 3 is for beta calculation. Return of security is X, return of market is Y, X into Y and Y square. X into Y and Y square. Now, how do I calculate this risk and return? How do I calculate the risk and return? First, return calculation. Return is what I get back minus what I give divided by what I give into 100. P1 minus P0 plus D1 divided by P0. Some question D1 by P0 can be called as dividend yield. D1 by P0. Some question price could be this order, price could be reverse order. You do all the adjustment, calculate the return. After return is calculated, return probability could be given, not given, equal probability, not given, equal probability. Return, probability, product, deviation and PD square. Deviation and PD square. The square root of PD square is called risk. Next comes covariance and correlation coefficient. Covariance is the last column of format 2. Last column of format 2, which is total of sigma probability into deviation A into deviation B. From the covariance, I can calculate correlation. From the covariance, I can calculate the correlation, which has to be between -1 to +1. So correlation is equal to covariance divided by standard deviation of A, standard deviation of B. Now, covariance can also be calculated using beta, which is beta of the first security into beta of the second security into variance of market, and covariance between A and A is nothing but its own variance. Why are we learning this correlation and covariance? For diversification or portfolio creation. I want to create a portfolio which are securities which are negatively correlated. What is negative correlation? Fast food chain versus organic food brand, online retailer versus the physical store. What happens? First business 11% return, 21% risk. Second business 12% return, 17% risk. Together return is 11 and a half, but risk is only 3.74. Risk is only 3.74. Risk is going down because of negative correlation. Now, how do I calculate portfolio return? Weighted average. Portfolio risk A plus B the whole square, A square, B square, 2AB. A square is sigma A, WA square, B square sigma B, WB square, 2 sigma A, WA, sigma B, WB, correlation AB. Some question, covariance could be there. Covariance substitutes correlation SD1, SD2. It will substitute SD1 and SD2. You can do A plus B plus C the whole square also, which is A square plus B square plus C square plus 2AB plus 2AC. It goes on. Notion of dominance means one security is dominating the other security. Ideally, domination should not be there. What is non-domination? Higher return, higher risk. Lower return, lower risk. But I generate higher return with lower risk. Higher return with same risk. Same return with lower risk. All these are examples of domination. They are examples of domination. Whatever is getting dominated will be removed and they are called inefficient security. Others are called efficient security. Others are called efficient security. Compensation for the risk. I'm taking risk. I need some compensation for the risk being taken up. This compensation for the risk depends on whether you have a diversified portfolio or an undiversified portfolio. If you have a diversified portfolio, calculate train or ratio. Train or ratio improves, you got good compensation. Train or ratio deteriorates, bad compensation. Otherwise, Sharpe ratio. Otherwise, Sharpe ratio. There are two types of risk. One is called systematic risk, otherwise called as non-diversifiable risk. Unsystematic risk, otherwise called as systematic. Non-diversifiable impacts everyone, cannot be removed, through diversification, Unsystematic, diversifiable risk, which is specific to a company, will not impact everyone. Ideally, I should not carry this, so I can remove this through the process of diversification. Now, there are two ways of measuring risk in a business. One is standard deviation, which is the total risk. How will you calculate standard deviation? Return probability product deviation PD square, or A plus B the whole square, or A plus B plus C the whole square. Beta, how does my security react only to market, not other factor, How do I measure the beta now? We have two scenarios. Probability information not given, probability information given. Not given, and they do not ask any other data. No standard deviation, no characteristic line, no CML, no SML, no extra information. Then you can use format 3 and use a formula called regression. Sigma xy minus n x bar y bar, sigma yy minus n y bar y bar, n y bar y bar. In case probability information is given, use the format 2 and use the formula standard deviation of security by standard deviation of market into correlation. This correlation can be substituted as covariance by sigma s, sigma m. Some cancellation will happen. Column 10 by column 9. This the other formula is column 10 by column 9. Column 10 by column 9 of your format 2. Column 10 by column 9. And one approximate formula, which is beta is equal to percentage change in security by the percentage change in market, or change in security by change in market, not the preferred approach. Risk-free rate represents the return on government security. This can be calculated using current yield formula. Current yield is equal to interest in rupees divided by the value of the bond today. Multiple risk-free rates are there. I can follow an aggressive approach, I can follow a conservative approach, I can follow a moderate approach. Aggressive approach, RF is equal to higher number. Conservative approach, RF is equal to lower number. Moderate approach, RF is equal to average. And there can be a hidden RF, which is security with zero beta. Security with zero beta. Risk premium of market. What is risk premium of market? What is the market giving extra? What is the market giving extra because I take a risk? Normally it will have a positive RM minus RF. Rare scenario, it can be negative also if the risk free rate is higher. If the risk free rate is higher than the market rate. If the risk free rate is higher than the market rate. Portfolio beta, weighted average, security beta, weight product can be altered if you add a security or remove a security. Can also be altered. Can also be altered by borrowing or investment. By borrowing or investment in risk-free security. By borrowing or investment in risk-free security. The format will give us the answer. How we alter, I explained when I did the futures explanation. Return, we have two types of return. One is called fair return, equilibrium return, CAPM return, required return. Other is called actual return or expected actual return. This is what the security is really giving. This is what the security is really giving. Formula for this is P1 minus P0 plus D1 by P0. And what a security should give. What a security should give, which is CAPM formula. RF plus one fair and the other actual is interlinked. One fair and the other actual. One fair and the other actual. RF plus actual beta into RM minus RF is fair return. Actual return is equal to RF plus fair beta. Plus fair beta. What should be the beta is called fair beta. What should be the return is called fair return. Actual return P1 minus P0. Actual beta F1, F2 and F3. Once I do this, I can compare the actual beta with fair beta equal optimum risk. Actual beta is greater. I don't know why I'm carrying this extra risk. High risk I'm carrying and no benefit I'm getting. And actual beta less than fair beta, low risk. It is a low risk kind of a situation. Decision on purchase or sale. I can purchase or sell based on multiple comparison. First comparison is through return. If your return is more than what you want, buy the share. Risk is less than what you want, again buy the share. Price is less than what you want, again buy the share. Opposite is for sell. I can do return comparison, I can do price comparison, I can do beta comparison. Risk taking ability of the investor. I am a person who wants to take risk, but it depends on whether it's a bull market or a bear market. Markets likely to go up, invest in all high beta security. Market likely to go down, invest in low beta security. High beta security and low beta security. High beta will give me higher positive return. Low beta will give me lower negative return. Low beta will give me lower negative return. Next comes the systematic risk and unsystematic risk, which we learned earlier, saying that systematic is going to impact everyone, unsystematic is going to impact only specific. Unsystematic has multiple other names: specific standard deviation, residual risk, random error. How do I calculate this? Balancing figure. What is balancing figure? Total risk minus systematic risk. How is the systematic risk calculated? Numerator of F2, formula 2 of beta computation. What was that formula? Beta is equal to sigma S by sigma M into correlation SM. So you can either use this or take it to the other side. Take it to the other side, left hand side or right hand side. Do square if you want to follow variance approach. If you want to follow SD approach without square. SD is not the preferred approach. Only the variance approach is preferred. Only the variance approach is preferred. Portfolio risk. There are two approaches: Markowitz, Sharpe. Both should give same answer if question is drafted properly. Markowitz uses correlation and Sharpe uses the co-movement or technically beta. It uses the co-movement or technically uses beta. Now this is A plus B the whole square, A plus B plus C the whole square, A plus B plus D the whole square. When it becomes 4, 5 security, very difficult to do Markowitz. Then Sharpe said portfolio risk is equal to systematic risk of portfolio plus unsystematic risk of portfolio. What is systematic risk? Same logic. Beta of the portfolio into SD of market square. Unsystematic is weighted average. Weighted average of the individual unsystematic risk with W square. With W square being the assigned weight, with W square being the assigned weight. Now, you can also calculate my systematic and unsystematic risk using coefficient of determination. What coefficient of determination says is, if it is R square systematic risk as per variance approach by total variance, this is, if problem silent, it is R square. So if the question will say coefficient of determination, if it says coefficient of determination, systematic risk is equal to total variance into, so I take it to the other side, into R square, total variance into R square. This got tested in one of the mutual fund question in one of the exam for doing, even in the recent exam they used the coefficient of determination formula, where you use R square and calculate systematic risk. Systematic risk is otherwise called as beta into SD of market. Beta will become balancing figure. Beta will become balancing figure. Investment with margin of 60%, 40%, 50%. What this means is, I invest 100 rupees of mine and add another 60 rupees and invest 160% in risky and borrowing of 60. Margin of 20% means investment 120, borrowing 20. Fully diversified portfolio, which is a very rare scenario, but if the question says it's fully diversified, it carries zero unsystematic risk. It carries zero unsystematic risk. So SD is equal to systematic risk of portfolio equal to beta into correlation, beta into SD of market, or sigma S into correlation. And using this logic, you'll be able to calculate beta. You'll be able to calculate beta. Why is beta needed for the next calculation? Components of return. Anybody who invests in a market, in a stock market or in a security, earns return because of 3-4 reasons. First is risk free, 4. From risk free, I go to the market, which is 9. The gap is called return due to market risk, 4 to 9. I am carrying beta of 3 times, 4 times, 5 times. So I take a lot of risk. I take a lot of risk. So 9 to another 14. This gap is called return due to extra risk. Formula for this is CAPM return for the beta which is there minus the market. And this guy, instead of giving 14, generated 17, 18, which is sheer skill of the portfolio manager, which is sheer skill of the portfolio manager. Characteristic line, CML or SML. Characteristic line is stock specific, which says alpha plus beta into return of market. Here, how alpha is calculated as we proceed. Security market line is your CAPM, RF plus beta into RM minus RF. This formula is wrong. It is beta of security by beta of market, but we never write that because beta of market is one time. Beta of market is one time, which is where this came. SD of security by SD of market into RM minus RF, which is called capital market line. This is used for undiversified. This is used for diversified. Using this, I'll calculate alpha. What is alpha? Is return earned in excess of the required return, or return due to the sheer skill of the portfolio manager. Alpha is equal to actual return minus required return. Positive, good performance; negative, bad performance. But how do I calculate required return? 3 formula. CAPM, RF plus beta into RM minus RF. CML approach, RF plus standard deviation of security by standard deviation of market into RM minus RF. Characteristic line, just beta into RM, just beta into RM. If the question gives you two securities and gives their CAPM return and beta, form two equation, and RF and RM can become balancing figure. RF and RM can become balancing figure if you give me two equation, two securities with their CAPM return and with their beta, with the CAPM return and their beta. Okay, CAPM approach is a very simple approach where what we do is we just do RF plus beta into RM minus RF. APT said we don't like this. You're using only single factor. You use multiple factor. So under APT, first formula is RF plus factor 1 beta into RM minus RF, factor 2 beta into RM minus RF, factor 3 beta into RM minus RF. Second formula is surprise factor. Surprise factor, which is RF plus the surprise factor into the beta. Surprise factor, if surprise is plus 1 minus 1, you have to see. This can be expected minus actual, can be actual minus expected, depending on the data given in the question. ICI material says expected minus actual. In exam, they did actual minus expected. So RF plus expected minus actual into the beta of factor 1 plus expected minus actual into beta of factor 2, beta of factor 3, but it can be expected minus actual, it can be actual minus expected. Next, beta and leverage is one of the most important area. This will help me in estimating what should be the cost of equity, estimating what should be the cost of equity or cost of capital to do a project evaluation. Beta, asset side beta is equal to liability side beta. This is the first rule. You can calculate beta from asset side, you can calculate beta from liability side. Asset side beta is weighted average of the beta of various asset or various business, which is technically equal to proxy companies asset beta, proxy companies liability beta. When you do liability beta, weighted average of the beta of various liability, only thing is for debt, you have to do into 1 minus tax rate, into 1 minus tax rate. And beta, two types, asset beta called as unlevered beta, called as overall beta. I will not use this approach unless there is no other way. What we normally do is we will use this, get the KE plus KD weighted averages WACC. KE plus KD, that is cost of equity into its weight, cost of debt into its weight, and you will do WACC calculation. This approach and doing it directly may give a different answer in case taxes are there. In case taxes are there, it may end up giving you different answer. Debt beta is normally taken as 0, but if the question gives some specific interest rate, debt beta can be calculated as interest rate on the debt RF plus debt beta into RM minus RF. We have three types of portfolio strategy: buy and hold policy, constant mix policy, CPPI policy. Buy and hold, buy once, no adjustment at all. Constant mix policy, rebalancing is done every month or every 5% change, every 10% change. It will say when the rebalancing will be done. What will you do rebalancing? You originally had a mix of 20-80, debt 20%, equity 80%. Put the total, make again 20-80, make again 20-80, make again 20-80. CPPI policy says rebalancing will be done when every event. What is every event? Every month, every 10 days, every 5% change. But here you have to calculate first floor value. What is floor value is the total investment which I'm going to do minus how much loss can happen in the market. So you're saying maximum 5% loss, 10% loss, 20% loss. So minimum value is calculated. 10 lakh is my investment minus 20% loss. 10 lakh is my investment minus 20% loss. So floor value is 8 lakh. Floor value is 8 lakh. After the floor value is calculated by us, investment in equity is equal to whatever you are investing minus the floor value into a multiplier. This you have to keep using the formula every time you have to do a rebalancing. What is the portfolio value minus the floor value? So today 10 lakh minus 8 into 2. Later 10 became 9, 9 minus 8 into 2. 10 became 13, 13 minus 8 into 2. This will be the investment in equity. Balance is the FD component. Balance will become the FD component or the debt component. Minimum risk portfolio. What is minimum risk portfolio? Is to minimize the risk which I see in a portfolio. There can be three situations: 2 securities, 3 securities, more than 3 security. In a 2 security scenario, we have a very simple formula which says weight of the first security is dependent on the risk of the second security. Weight of the first security is dependent on the risk of the second security. So variance of the second security minus the covariance. For the second security, the formula is variance of the first security minus covariance. This plus this is the denominator. This plus this, variance of 1 plus variance of 2 minus 2 times of covariance. Obviously, both put together will add up to 1 time. Both put together will add up to 1 time. Critical line and Sharpe's optimal approach, I don't explain now. In case you want to go through the detailed approach, just go through the detailed video, because I've not done it in the session. You may not be able to follow it now. So critical line and Sharpe's optimal approach, just look at the detailed video if needed. Real estate valuation can be done based on credit side of P&L, based on debit side of P&L. What is credit side of P&L? Is number of, that is sales comparison approach, area in square feet into the selling price per square feet, into the selling price per square feet. Debit side of P&L, area in square feet into the construction cost per square feet. Based on income, credit minus debit, get the income and apply a multiplier or divide by a capitalization rate. Cash flow is present value of future cash flows, present value of future cash flows. Clear? Any doubts in this? Okay, I'm taking a break at this time itself. We resume again at 1:30. I resume again at 1:30. Okay, now I start with, we are done with four chapters. I now move to chapter two, then we do three, then we do five. Security analysis doesn't need any discussion here. So I move to chapter two where nothing is there. Value at risk set. What will be the maximum possible loss in a worst case scenario? If the worst happens, what can be the loss which I make in my portfolio? Depends on what is the amount I invest, also depends on what is the risk of my investment, called as daily standard deviation, weekly standard deviation, monthly standard deviation, into the important part is square root, into square root of number of days. You'll have to do into square root of number of days, and multiple, we have two multiple. For 95 we have 1.65, for 99 we have 2.33. Most important one, daily SD into square root of 20, into square root of 20. When you want to convert a daily standard deviation into monthly, and 1 month has 20 days, 20 trading days, daily SD into square root of 20 and not into 20, into square root of 20 and not into 20. Next, I move to capital budgeting. There's a CA inter portion and there's a CA final portion. I'll quickly summarize the CA inter portion as well. We have six techniques of capital budgeting: payback method, discounted payback, NPV, profitability index, ARR, and IRR. Payback refers to time taken to recover the initial investment, ignoring the time value of money. So here we do year, cash flow, cumulative cash flow, payback equal to base year plus unrecovered cash flow of base year divided by cash flow of next year. What is base year? Is the last year in which cumulative cash flow is negative, the last year in which CCF is negative, and I divide by cash flow of next year in the calculation. We do not do any discounting here, lower the better. Discounted payback, same thing, but you have to use the discounted cash flow, unrecovered discounted cash flow of base year divided by discounted cash flow of next year. Again, lower the better. Again, this is lower the better. NPV, inflow minus outflow. Profitability index, inflow divided by outflow. Inflow divided by outflow into 100 if you express in percentage. Otherwise, it is expressed in times. We end up expressing this in times. Higher positive NPV is better, greater than 1 is better, greater than 1 is better. Accounting rate of return, ratio of the average profit to the initial investment or to the average investment. How profit is calculated is cash flow minus depreciation. From the cash flow, if you deduct the depreciation component, you get PAT, because from PAT you add depreciation and get cash flow. So from cash flow deduct depreciation, get PAT, take an average of that, divide by initial investment or divide by average investment. IRR is the rate of return at which NPV of the project is 0. If you get a positive NPV, IRR is greater than discount rate. If you get negative NPV, IRR is less than discount rate. And if you get 0, IRR is equal to discount rate. In order to do the calculation, I normally need a discount rate to start with. That discount rate can be taken as 2 by 3 of ARR on average investment. 2 by 3 of ARR on average investment. Once you calculate that, that is your initial guess rate. You get a positive NPV, you get a negative NPV. Positive NPV, increase the discount rate. Negative NPV, reduce the discount rate, and formula is L1 plus NPV at L1 divide by NPV at L1 minus NPV at L2 into L2 minus L1, interpolation formula. Discount rate which we use for capital budgeting is the risk which is specific to the company, the risk which is specific, the risk which is specific to the project, risk which is specific to the project and not to the company. RF plus project beta into RM minus RF. When you go through the concept, you should tell on your own. I'm not looking at the screen itself. So that is how you'll have to do. RF plus project beta into RM minus RF. So I have to use the project beta which is specific to the project, and the risk can go up, can go down. We'll have to use the concept of step up or step down discount rate. Depreciation is a non-cash item. It is relevant because of tax benefit, irrelevant if taxes are not there. If a company is not paying taxes, it becomes irrelevant. Opportunity cost, cost of benefit, foregone. it becomes a relevant item, because what is opportunity cost is what am I losing because of doing the project. It is a relevant item. If it is given after tax, adjust after PAT. Given before tax, adjust before PBT. Adjust before PBT. Sunk cost or historical cost or cost already incurred is an irrelevant cost. It is already incurred whether paid or not. Example, your market survey, research and development, all these expenses are to be ignored. Overhead cost, we have two types of overhead cost: apportioned, general, corporate, distributed. All these are ignored. Anything specific or incremental is considered relevant in our analysis. Working capital, money which I need for smooth functioning of the company. There is one, an initial working capital, which is outflow in year zero. There's an increase in working capital, which is again an outflow. Decrease in working capital becomes an inflow. Increases outflow of money, decreases inflow. All of this will come back on the last day. All of this will come back on the last day as inflow in last year. Reward exclusion principle says ignore the reward paid to the providers of capital. We follow a long-term funds approach, which is basically an FCFF approach. So ignore equity dividend, ignore preference dividend, ignore interest, ignore buyback of share, ignore redemption of all this. You have to ignore. All this will have to be ignored in our analysis. Steps in computation of cash flow: I have an initial outflow, which is at the starting of the project, capital expenditure and working capital. Then there's an in-between cash flow, which comes throughout the project, CFAT. Terminal flow, net salvage value, which is different from salvage value, and recapture of working capital. My initial outflow is capex and working capital. In between flow, what do I earn every year? Increase in revenues, inflow. Decrease in cost is also inflow. Deduct all cost, deduct depreciation, PBT, deduct tax, PAT, add back depreciation, CFAT. After the CFAT is calculated, there can be an increase in working capital, which is outflow, decrease in working capital, which is inflow. You could be paying for the original machine, or you could be buying an additional machine. All this will give you the CFAT number. This will give you the CFAT number. Payment for original machine, purchase of additional machine, this will give you the CFAT number. And terminal flow is whatever working capital was blocked comes back, and something called as net salvage value. What is net salvage value? So it is different from the salvage value. Salvage value plus, that is sale value plus, if you save any tax, if you save any tax on capital loss and tax paid on capital gain, tax saved on capital loss, tax paid on capital gain. How do I comparison? Sale value less book value, capital gain or capital loss, tax paid or tax saved, and net salvage value, tax paid or tax saved and net salvage value. Block of assets method, which is the method followed in income tax. Block of assets method followed in income tax. No capital gain or loss will be applicable in case the block is not exhausted. In case the block is not exhausted, and you will charge depreciation on the incremental value. What is incremental values? Purchase price of the new asset minus the sale price of the old asset. Investment normally happens at end of the year. In case any investment is happening at beginning of the year, in case any investment is happening at beginning of the year, capital budgeting says that end of year 2 write year 2, end of year 3 write end of year 3, but beginning of year 4 write it as end of year 3, beginning of year 4 write it as end of year 3. Losses if I make in a business, if I'm a profit making company, immediate tax benefit, immediate tax saving. Loss if I have to carry forward, no tax saving in the year of loss, carry forward. Next year loss, profit will not go down, profit will remain same, but you pay taxes on the lower amount, you pay taxes on the lower amount. And third option is no carry forward and no set off, no carry forward, no set off, you don't get any benefit. If there is some tax exemption on a specific percentage of profit, then I can calculate effective tax rate as normal tax rate into 1 minus the exemption percentage. My normal tax rate will be 50, into 1 minus exemption will make it lesser and may bring it to 40 or 30. Expenses not paid in the year of incurrence. That is, I incur some expenses, but I don't pay in the year of incurrence. In this case, for my tax purpose, I have to follow accrual method. So calculate PAT, add back what was not paid, and deduct what has been paid. Add back what was not paid, deduct what has been paid. Subsidy or grant, there can be a capital subsidy or a revenue subsidy. Capital subsidy is adjusted with the cost of the asset or not adjusted with the cost of the asset. Difference is depreciation calculation. And revenue subsidy can be taxable before PBT, exempt after PAT. Till this is CA inter part. Now comes utility value. What the concept says is attach utility values for the various cash flows given in the question. How do you attach? The question will give you the utility value, and our job is to do weighted average of the utility value. Weighted average of the utility value. The one which has higher weighted average. One which has higher weighted average is a better project. One which has higher weighted average is a better project. Abandonment decision. When should I sell an existing machine? In order to do this evaluation, we do a very simple thing. If you sell today, what money do you get? NSV you have to calculate. Sale value less book value, gain or loss, tax paid or tax saved, NSV. If I sell today, I can get 5 lakh from a car. If I use the car, I will earn first year cash flow, second year, third year, fourth year, fifth year, and then I sell. If sell immediate 5 lakh, use and sell 4 lakh, I'll sell immediately. And we call this as NPV. NPV is PV of continuation minus the PV of selling. Continuation 4 lakh, selling 5 lakh, go ahead and sell it because you got a negative answer. You got a negative answer. Now comes, how do I decide on replacement? This is where the most important part. Okay, how do I decide whether to replace a machine or not? What is replacement? Is selling an existing machine and buying a new machine on its behalf. Selling an existing machine and buying a new machine. We do 3 steps: initial outflow, in between flow, terminal flow. In every step you have to do new machine, old machine comparison. Initial outflow, capital expenditure, working capital, they are outflow. Net salvage value of existing machine is inflow. Net salvage value of existing machine is inflow. The gap is your initial outflow. Initial outflow is capital expenditure, working capital, net salvage value. Step 2, in between flow is equal to what was the old machine giving, what is the new machine giving, gap, new minus old. You can do it in single column, you can do it in multiple column depending on the data. Last is terminal flow. Calculate what is the terminal flow of the new machine. What is new machine? Capital expenditure, which comes in the form of NSV, working capital, which comes as recapture of working capital, and the terminal flow of old machine. Again, if the old machine had continued, what do I get back? I do the calculation and find out the difference. Consolidate all of this, calculate NPV. If NPV is positive, go ahead with replacement. NPV is negative, don't do the replacement. This is called as type 1 problem. Type 1 problem, deciding whether to replace an existing machine. Then comes a type 2, deciding on optimum life. Optimum life of a regularly used asset. If there is any regularly used asset and I'm going to acquire it, or it is just acquired, and it can have a life of 3 years. In a type 2 problem, what you do is you are checking what is the optimum life. Now, how do I calculate the optimum life? You go ahead and say that a car has a life of 3 years. First, I buy, sell it in 1 year. Buy, sell it in 2 years. Buy and sell it in 3 years. For all these 3 situations, either calculate NPV or PV of outflow. And to make them comparable, you have to do EAB or EAC. To make them comparable, you have to do equated annual benefit or equated annual cost. Type 3 problem is almost similar, but this asset was acquired some 2 year back or 3 year back or 4 year back or 5 year back. It is not a regularly used asset. It was purchased sometime back. In this case, you have to see what is the balance life. If the balance life is 2 years, I replace immediately. What is the cash flow? I replace a year later. What is the cash flow? I replace 2 year later. What is the cash flow? And after calculating cash flow, you divide by, that is what is replacement is, you sell the old machine, buy the new machine. So there will be a purchase price of the new machine and sale price of the old machine. Purchase price of the new machine and sale price of the old machine. Whereas here in a type 2 problem, only purchase price of new machine will be there. No sale price of old machine. No sale price of old machine. When you're starting in a year zero, when you're starting, there is no concept of sale price of old machine. In a type 3 problem, there will be a sale price of old machine. If the life is very high, like 8 years, 10 years and all, then for the new machine, calculate equated annual cost, that is like the rental, that is like the rental, and do calculation only for uniform number of years and see which is better. Do calculation for uniform number of years and see which is better. Now, EAB or EAC concept, the EAB or the EAC concept is applicable because I have two projects. The life of the two projects can be same, NPV, PV of outflow. Life of the two projects is different. To make them comparable, if you have positive return, do NPV divided by annuity factor. NPV divided by annuity factor. And it has only cost, PV of outflow divided by annuity factor. This will give you equated annual benefit or equated annual cost. Equated annual benefit or equated annual cost. Clear? For evaluation of a project, a company may follow two approaches. One is called long-term funds approach. Second is called equity shareholders approach. Long-term funds. Now onwards, the core, the final part started. Even replacement to some extent, you learned it earlier. I have long-term funds approach and an equity shareholders approach. FCFF approach says calculate cash flow which belongs to all the owners. Calculate cash flow which belongs to all the owners. What is all the owners? Equity guy, debt guy, preference guy. So when you calculate FCFF, equity dividend not subtracted, preference dividend not subtracted, interest not subtracted, dividends pay, sorry, debentures issued not subtracted, debentures redeemed not subtracted, none of them will be subtracted or added, and you will discount this at cost of capital, get project NPV, project IRR. FCFE approach, FCFE approach, which belongs only to equity shareholder. It belongs only to equity shareholder. In this case, I ignore the cash flow between the company and only the equity shareholder, discounted at cost of equity, and we get equity NPV and equity IRR. We get equity NPV and equity IRR. Next, APV approach. The term APV approach is adjusted present value approach. What the approach says is, whenever I do a project, there are two parts to the project. One is investment decision, second is financing decision. Normally, we don't mix them together. Investment separate analysis, financing separate analysis. So APV approach says, first you ignore what is the financing, whether debt is coming, equity is coming, preference is coming, you ignore all of that. Just evaluate the project assuming it's 100% equity funded, assuming it is 100% equity funded, and get the NPV. This is called base NPV. This is called base NPV, which many times can be negative. The base NPV many times can be negative. In case I still want to do the project, base is negative, but still I want to do the project, bring the financing aspect. Everywhere in a normal question, what we do is we just evaluate the investment decision on a standalone basis. We don't see where the money is coming, all that. We were never bothered at inter level. Even in whatever capital budgeting question we do, we are not bothered about that. APV approach says no, you have to be bothered about it. You analyze that separately, this separately, and see still the project can become viable or not. Can the project become viable or not? So base project not viable, but the debt, when I bring in debt, there is two benefits in the debt. First benefit is there can be an interest saving itself. There can be a interest saving itself. I could be paying interest at a lower rate. I could be paying interest at a lower rate as compared to the normal rate. So normal rate 8%, I pay 6%, 2% saving. And whatever I pay, there is a tax saving on that. Whatever I pay, there is a tax saving on that. So interest saving, tax saving, discounted at pre-tax, discounted at pre-tax cost of debt, discounted at pre-tax cost of debt. The discounting has to happen at pre-tax cost of debt, not at post-tax. Be very, very clear. Pre-tax cost of debt. Logic is Modigliani-Miller approach. This will enhance my NPV. But now, if you're mixing financing, you also bring this. When you're raising money, there is flotation cost which is incurred. So please bring that also into picture. You are saying you want to mix the investment and financing. You want to mix it. Please bring this angle also, that there can be an issue cost. So base NPV plus the present value of tax saving minus the PV of issue cost, minus the PV of issue cost is equal to final NPV, is equal to final NPV. Discount at pre-tax cost of debt. Discount at pre-tax cost of debt. Inflation in capital budgeting says we have two types of cash flow: nominal cash flow, real cash flow. Nominal cash flow includes the inflation value, real cash flow excludes the inflation value. We have two type of discount rate: nominal discount rate or real discount rate. Nominal discount rate includes inflation, real discount rate excludes inflation. Approaches: real cash flow, real discount rate; nominal cash flow, nominal discount rate. Now, because of this, if the question gives you cash flow as well as the discount rate, one of them would be nominal, other one assumption you have to take real. One of them could be given as real, other assumption you have to take nominal, else the utility of the question will get lost. So what we do here is, if discount rate can be adjusted, I'll adjust the discount rate as your nominal discount rate is equal to real discount rate plus inflation, but I cannot add them, so I add 1 and do multiplication. 1 plus MDR is equal to 1 plus RDR into 1 plus inflation. This is used in even Forex. 1 plus home currency return is equal to 1 plus foreign currency return into 1 plus or minus appreciation. Even in the risk-free rate and risk premium, 1 plus risky rate is equal to 1 plus risk-free rate into 1 plus risk premium. And if you want to adjust the cash flow, nominal cash flow is equal to real cash flow into 1 plus inflation rate power n. If different inflation rate is there, keep adding every year inflation separately. Then expected value, standard deviation and coefficient of variation. The expected value can be computed for NPV, can be computed for cash flow, can be computed for any other information the question says. How do you calculate expected value? Format 1 of portfolio management. What does the format 1 says? Return, probability, product, deviation, PD square. In place of return, we'll call it as cash flow, probability, product, deviation and PD square, or NPV, probability, product, deviation and PD square. The deviation will give me standard deviation, that is the total of PD square and a square root. When you do a problem, if the data is in thousands, don't write the data as it is. If it's 10,000, just write it as 10. When you do the squaring, you will get stuck. If you write 10,000 as 10,000, in squaring, you will get stuck. CV, what is CV? Is coefficient of variation, risk per unit of return. Coefficient of variation is risk per unit of return, standard deviation by NPV. For this expected NPV, for calculating the expected NPV, I have two approaches. One approach is weighted average. What is weighted average? Is return, that is NPV, probability, product, deviation, PD square. NPV, probability, product, deviation and PD square. This will be followed if question says best case and worst case. This is calculating 5 NPV, 1 final NPV. Second approach is I'll just calculate only 1 NPV. What I do is every year cash flow, I'll do cash flow, probability, product. This will give me the expected cash flow of every year. Use that expected cash flow and get only 1 NPV. Get only 1 NPV. When you do the expected cash flow every year, there's a cash flow, there's a probability, there's a product, and you add two more column: deviation and PD square, and calculate standard deviation every year. Calculate standard deviation every year. Why do I standard deviation every year? Is because the question may ask dependent standard deviation and independent standard deviation. Dependent standard deviation and independent standard deviation. Dependent means it is more risky in nature. Dependent cash flow are those cash flow where a failure will lead to another failure, a success will lead to another success. Independent, first year failure, second year success, third year failure, fourth year success, fifth year failure, sixth year success. There's no link at all. There is no link. Independent is normally low risk. Independent is normally low risk. Dependent is normally high risk. Dependent is high risk. So what you do is year, cash flow, that is standard deviation, PVF, DSD, discounted standard deviation, DSD square, discounted standard deviation square, DSD total. When you put a normal DSD total, that is dependent standard deviation. That is dependent standard deviation. And if you put DSD square total, if you put DSD square total and take a square root, DSD square total and take a square root, that is called independent. That is the independent. And also probability, if they ask what is the probability, dependent is whatever they have given, independent you have to do power number of years, independent you have to do power number of years. So if question is saying dependent and independent, follow approach 2, and if the question is saying give me best case worst case, follow approach 1. Best case worst case, approach 1. Dependent independent, approach 2. RADR, which is called risk adjusted discount rate. The concept says you cannot have same discount rate for every year. You cannot have the same discount rate for every project. So discount rate for a high risk project will be high, low risk project will be low. This is the broad concept. Now, in order to do the calculation, the risk can be measured through beta, standard deviation, coefficient of variation, risk index. Base simple formulas: risk-free rate plus risk premium. More another formula is RF plus beta into RM minus RF. That is RF plus risk index into normal discount rate minus RF. Also, we saw one problem where it was changing based on coefficient of variation. Based on coefficient of variation. RADR is saying go ahead and make changes to the discount rate, which is easy to do. But CF approach is saying no, there's another approach called certainty equivalent factor. I want to adjust the cash flow downwards. I want to adjust the cash flow downwards. So question will give me uncertain cash flow. I ask what is the confidence factor you have? How much are you confident about the given number? What is your confidence level about a given number? Once you give a confidence level of a given number, the uncertain cash flow into the certainty equivalent factor will give me something called as certain cash flow. The uncertain cash flow into the certainty equivalent factor, and once you get the certain cash flow, discount it at risk-free rate of interest. Discount it at risk-free rate of interest, because risk is removed from the cash flow, also removed from the discount rate, also removed from the discount rate. If you are following CF approach, and in case you want to follow RADR for the same question, in case you want to follow RADR for the same question, what you need to do is you need to put a total of the CF, put a total of the CF, high CF, low risk, low RADR, low CF, high risk, high RADR. Next concept, sensitivity analysis and scenario analysis. I have calculated the NPV of the project, good project, everything excellent, but still I am little worried if anything can go wrong. What can go wrong can be evaluated through sensitivity analysis and scenario analysis. Sensitivity analysis is one change at a time. That can be, it can change in life, change in selling price, cost price, or discount rate, initial outflow, anything can change, but only one change at a time. Scenario analysis is multiple things can change at a time. Multiple things can change at a time, which is scenario analysis. For sensitivity analysis, scenario is not very critical. For sensitivity, we have two approaches. First approach is impact on NPV due to uniform percentage change in variable. Due to uniform percentage change in variable. That is, every parameter changes by 10%. Find out how much NPV is changing because of this. With the one with the maximum change in NPV, one with the maximum change in NPV is the most sensitive parameter. One with the maximum change in NPV is the most sensitive parameter. Approach 2 is a Break even analysis approach. What is break even analysis is what will lead to break even zero npv, what will lead to break even or zero npv. So here I had an original selling price 60, but if selling price become 50, I will become zero npv. So here we calculate sensitivity percentage. What is sensitivity percentage is how much should be the change in variable which can make the npv zero. It can be fall, it can be rise also. I have given fall, but it can be anything. So change in variable which leads to npv becoming zero. The one with the lowest cushion, one with the lowest cushion is the most sensitive factor. One with the highest change in npv is the most sensitive factor. Highest change in npv, most sensitive factor. Lowest cushion percentage, most sensitive factor. Next is decision tree. Decision tree is I want to represent a real problem or a bigger problem in the form of a diagram, in the form of a diagram, because there are a lot of decisions to be taken, and if I don't put a diagram, I'm not able to understand what decisions are going to be taken. So in order to do this, we draw a diagram which starts with a rectangle which is called decision node. Then some circles can come which is called chance node. In a decision node, whatever branches come, I can decide which side I want to go. So value is highest of the branches, value is highest of the branches coming from the rectangle node. And your chance node is weighted average with probability. How the probability will come, question can give, or risk neutral model can be used to calculate probability. Drawn from left to right, valued from right to left, and in case they give multiple probability, joint probability. Probability of year 1 into probability of year 2, probability of event 1 into probability of event 2. Clear? Any doubts on this? Okay, simulation. What does simulation say is I have a problem where it is a very extremely complex situation. I'm not able to go through in any of the approach. RADR is not helping me, CF is not helping me, the sensitivity analysis did not help, scenario analysis did not help. Then I said, okay, whatever problem you're having, you please define the problem. Tell me what can change for you, what will not change for you. What can change? I need probability data, and we prepare something called as random number table. What is random number table is I have life, probability, cumulative probability. Cumulative could be 0.20, 0.50, 0.90. So starting with 00, if it's 0.20 till 19, 20, 49, 50, 89. I'll have to keep writing this and then put the random number, run an experiment. Experiment will give a random number, tell what life maps to it, what cash flow maps to it, what revenue maps to it, and for do this experiment millions of times and calculate the average NPV. Calculate the average. In exam, they may ask you doing 5 times or 6 times, and you get the average NPV. Ideal discount rate is risk-free rate. Ideal discount rate is risk-free rate. That is the ideal discount rate to be used. But if data is not there, you go ahead and use whatever information is given in the question. Next, option in capital budgeting. I'm constructing a building. In the building, I cannot say I want to construct the 7th floor immediately. First, I have to construct a foundation. So, foundation is called base project. Foundation is not giving me any return. Negative NPV. When I construct a building, the foundation or the first floor when I constructed, I did not earn any money. So, it is negative NPV project. But I have an option to expand and do second, third, fourth, fifth, sixth, and seventh floor. This can give me money and it can make the entire project viable. It can give money and can make the entire project viable. So I have an option to expand. I can have an option to abandon. I can have an option to time the project. All this will lead to better NPV for the project. Better NPV for the project. With this, this area gets over. As far as capital budgeting is concerned, predominantly CA inter area. But after that, you will have to be aware of one, the standard deviation part, how RADR works, how CF works, sensitivity and scenario. That sensitivity is very important. Sensitivity analysis part is extremely critical. Clear? Chapter 4, I'm not doing it here. You can just go through the security analysis part. I don't feel a need for it to be done now. Okay, I'll now move to security valuation. Security valuation is a very lengthy area. A lot of things are there in security valuation. The term security can mean an equity share, can mean a debenture, can mean a money market instrument, can mean an hybrid instrument. So here we are going to do equity valuation, we are going to do bond valuation, we are going to do convertibles, we are going to do enterprise valuation, money market instrument, rights issue and buyback. So many things are there. We'll go step by step. First is equity valuation. What is equity valuation? Is arriving at the fair value of a share. Arriving at the fair value of a share. Now, to arrive at a fair value of share, practical world, we have multiple models of valuation. The first model of valuation is Walter's model. What Walter's model said is price is the sum of two parts. What you pay and what you don't pay. What you pay is dividend by cost of equity. What you don't pay is retained earnings. What you don't pay is retained earning. Why are you not paying this? In future, I'll pay you more. In future, I'll pay you more. So you are giving me a story saying that in future, I'll give you more. So I'm not paying you that money today. I'm not paying you that money today. So first is dividend by cost of equity, and the second part is R by KE. This is called a multiplier into the retained earnings divided by the cost of equity. Divided by the cost of equity. Both have common denominator, cost of equity. Certain terms we have to be aware. Dividend per share, total dividend by number of share, EPS into payout ratio, dividend rate into face value, dividend yield into market price, dividend yield into market price. R can be called as return on equity, return on retained earnings, return on investment, IRR, and R is calculated as return on equity, EAES by amount of equity, or EPS divided by book value per share. EPS divided by book value per share. So I need D, I need R, KE. KE refers to multiple names again. Investor required return, opportunity cost of capital, rate of capitalization, cost of capital, equity capitalization rate. And E is the earnings per share, EAES divided by number of equity share. Or we had another formula called ROE is equal to EPS by BBPS. EPS by BBPS. So when you do a cross multiplication, ROE into BBPS can give you the earnings per share. It can give you earnings per share. Now, why are we learning this model? Understanding this model helps me in classifying the company into three. There is a growing company, there's a normal company, and there's a declining company. What is growing company? A company whose return is greater than cost of equity. I am earning more than what is needed by you. I am earning more than what you need. If I earn more, I will keep all the money. I'll keep all the money, pay dividend of 0%. I'll keep all the money and pay dividend of 0%. If you can earn more, you take out all the money. You take out all the money, which is a declining company, which is a declining company. And if both are equal, it's a normal company. Any amount can be paid. It's a normal company. Any amount can be paid as dividend. Then, after learning optimum payout, one exam question said, what is limiting value? Limiting value is the minimum possible value. Limiting value is the minimum possible value, which is calculated by following a ratio which is opposite of the optimum. If optimum is 0, I will calculate at 100%. If optimum is 100, I'll calculate at 0%. Opposite of the optimum payout ratio. Opposite of the optimum payout ratio. This is concept of limiting value. Okay, next is Gordon's model. What is Gordon's model is? The Gordon's model of valuation is used to value any perpetuity. Gordon's model is used to value any perpetuity. Extremely useful model for us to do the valuation. It is a model where perpetuity can be valued. You would have learned this multiple times at Inter also. You would have learned K is equal to D1 by P naught plus growth rate. Growth rate goes to the other side. P naught is equal to D1 by K minus G, or D0 into 1 plus G, or E1 into the payout ratio. E1 into the payout ratio divided by K minus G, or E0 into 1 plus the growth rate divided by K minus 0. It can be multiple ways. The first problem is the given dividend D0 or D1? If clarity is there, go ahead. Clarity not there, give two answers. What is clarity? Paid out, will pay now, paid last year. All this is D0. Will pay next year, end of current year. All this is D1. All this is D1. No clarity is there. go ahead and take an assumption and give two answer. Give two answer. How do I calculate growth rate? How do I calculate growth rate? Two option. One based on my earning ability. Second based on my past history. Based on my past history. Based on my earning ability, my ROE into the retention ratio. My ROE, higher the ROE, higher is my growth rate. Higher the retention, higher is the growth rate. ROE into retention. How ROE is calculated? You know, EAES by amount of equity. Retention is 1 minus payout ratio or retained earnings by total earning. Other option is based on past dividend history. You take the last 10-year dividend, 15-year dividend, 20-year dividend, and the first dividend is called present value, last dividend is called future value. Present value is equal to future value into PVF, or future value is equal to present value into FVF, and somewhere R is equal to growth rate. Whatever is R there equal to growth rate. Now, how do I calculate this growth rate in case of this approach? In the second approach, what is second approach? Taking the past data. Taking the past data. When you calculate growth rate, I have two scenarios. One, I can be given earnings per share. Second, I can be given dividend per share. Earnings per share or dividend per share. My preference will be for earnings per share because that reflects the real growth of the company. Dividend is something I can change based on my policy. Based on the policy, I can increase the dividend, I can decrease the dividend. So the real growth comes only from the EPS data. EPS not there, go with DPS. If EPS is not there, go with dividend per share. Time value of money, future value is equal to present value into 1 plus r the whole power n. Present value is equal to future value divided by 1 plus r the whole power n. If you want to do annuity, multiply with future value annuity factor. If you want to do present value, multiply with present value annuity factor. All this we use it for discounting purpose. This is your Gordon's model. And in case you want to calculate an EMI amount, you can use annuity factor. This is entirely done at CA Inter. I don't want to spend much time here. Return on equity, we have spent so much time on return on equity. This keeps coming back in many concepts. Return on equity is equal to EAES divided by amount of equity. If you divide this by number of share and this also by number of share, you will get EPS by BBPS. How will you calculate BBPS? We learnt it in the mergers and acquisition chapter. Share capital, reserves minus fictitious assets divided by number of shares. What is cost of equity? Cost of equity is nothing but what does a shareholder want? What does a shareholder want? If you are paying dividend, I have one way of calculating. If you are not paying dividend, I have another way of calculating. If you are paying dividend, D1 by P naught plus growth rate. In case flotation cost is there, P naught minus F. P naught minus F. Many question flotation cost will not be there. Then only D1 by P naught. If it is there, D1 by P naught minus F plus growth rate. This, if you are not given dividend data, we use this our CAPM approach, RF plus beta into RM minus RF. This beta is equity beta. There is a equity beta and there is an overall beta or an asset beta. And based on P multiple, very rarely used formula, inverse of P multiple can be taken as cost of equity. In case there is a 100% payout, logic is very simple. P is equal to MPS by EPS. Inverse is EPS by MPS, and EPS is nothing but DPS. Dividend per share by market price per share. If you are doing a project, and you know whether the project is going to give you positive NPV or negative NPV, if you know that information, positive NPV, favorable project, share price will increase by the amount of NPV per share. And if it's an adverse project, share price will decrease by the amount of NPV per share. Increase by the amount of NPV per share, decrease by the amount of NPV per share if that information is available. How do I decide whether to buy or sell? In portfolio, we saw three approaches. Here only one approach, price comparison. But apart from price comparison, I can do return comparison, beta comparison, price comparison, return comparison, and beta comparison. Price comparison, actual price is higher than fair market price, overvalued, sell it. Actual price is lesser, undervalued, buy it. Clear? Okay, I calculated today's price. I want to go to the first year price or the second year price, or from second year I want to come to the first year. From first I want to go to second, I want to go to third. We will use something called as Modigliani-Miller approach. What Modigliani-Miller approach said is P1 is equal to today's price into 1 plus the return you want minus dividend, minus dividend. If I want to do it for the property, P1 is equal to P naught into 1 plus the return needed minus R1, rent of year 1. We use that concept in one question in derivatives. In one question in derivative, we use the rental concept there and calculated the price of the apartment after a year. Dividend investing. What is dividend investing? There are certain people who are investing in share for the purpose of getting regular dividend income. For the purpose of getting regular dividend income. These people, if company is paying dividend, very happy with it. If they stop paying dividend because of some reason, I'll continue to be there with the company, but I'll do partial sale of share. I'll do partial sale of share till the company starts paying dividend again. Till the company starts paying dividend again. How will I do partial sale of share? By calculating price of every year. How will I calculate price of every year? Modigliani-Miller approach. Modigliani-Miller approach. You will have year zero price. From there you move to first year, you move to second year, you move to third year, or from third year you move to second year, first year, Modigliani-Miller approach. Holding period return, already seen when we did our mutual fund area. Ex dividend and cum dividend value. The share is always quoted in the market at cum dividend value. Whenever dividend is there, it's always quoted at cum dividend value. What is cum dividend values? If you buy the share, you will get the share as well as the dividend income, as well as the dividend income, which is going to be paid maybe in 2-3 days or 10 days or 15 days. For calculation purpose or analysis purpose, I can only use ex dividend value, because the real price of the share is one without the dividend. Because moment the dividend is paid, share price will fall by the amount of dividend. Moment the share dividend is paid, share price will fall by the amount of dividend. Will fall by the amount of dividend. So I want only the ex dividend value. I don't like the cum dividend value. I don't like the cum dividend value. I want only the ex dividend value in every calculation, be it Walter's model, Gordon's model, KE calculation, anywhere I can, we will do something called as X rights price. Anywhere you do, you can only use what? Ex dividend value. You can only use ex dividend value. You calculated some value, fair market price. You want to compare, you can compare your fair market price with the ex dividend market price. With the ex dividend market price, you cannot compare with the actual cum dividend market price, because any model can only give you the ex dividend price. Required return of any security has two components. One is risk free rate, second is risk premium. Risk free rate and risk premium. Risk free rate has two parts: inflation and the real rate of return. Any increase in inflation premium will increase the risk free rate. We did one question where market return was to remain same, but risk free rate alone will go up. There was one problem which we did in the class where risk free rate is going up because inflation went up, market return remained same. That time when I was explaining, I said market return can also go up. In the recent MTP or RTP, they've added a question where the question did not say market return will remain same. So there they increased the risk free rate as well as the market rate. They increased the risk free rate as well as the market rate, because inflation premium is a sub part of risk free rate and risk free rate is a sub part of risk return of market. Risk free rate is a sub part of return of market. One question when we did in class, the question specifically used the word market return will remain same. In the MTP or RTP, they have said market return is not going to remain same. So they increase the market return also. Okay, next comes the step up growth model. What is step up growth model is my formula for valuation of Gordon can be used when a company is paying fixed dividend or growth is stable. But in a practical world, I may grow 10%, I may grow 15%, 20%, suddenly 5, 4. So stability will take time. The Gordon formula can be used as D1 by KE minus G or D2 by KE minus G, D3 by KE minus G. Whenever you want to use the formula, you can use it only if there is stability in growth rate. Only if there is stability in growth rate. If a company is paying multiple growth rate, if a company is paying multiple growth rate, step one, calculate the dividend. Calculate the price at the beginning of the stabilization phase. How do you calculate price at the beginning? If it's sixth year stabilization, P6 is equal to, or sixth year beginning stabilization, P5 end. P5 is equal to D6 by KE minus G. Discount all the dividend, discount price. Whichever year you're writing the price, that year dividend will also come. Whichever year you're writing the price, that year dividend will also come, because perpetuity is always valued a year in advance. Be careful about that. Dividend estimation for future period. I want to estimate the dividend for future period. Question says 10% growth, 10% growth, 5% growth, 4% growth. Keep adding in the calculator, keep writing the number. This is okay if there is no change in payout ratio. But if there's a change in payout ratio, you calculate EPS. Then from EPS, you calculate the dividend. You calculate the earnings per share, and from the earnings per share, you will have to calculate the dividend per share. Your dividend per share calculation will come from the earnings per share number. It will come from the earnings per share number. You cannot directly estimate the dividend. You cannot directly do the dividend estimation. Clear? Any doubts on this? Linear fall in growth rate. What is linear fall in growth rate? Is question says growth is going to fall from some higher number to a lower number. It is going to fall from a higher number to a lower number. Could be from 20 to 10 or 20 to 8. If they tell in how many years the fall will happen, find out the annual fall in growth rate. Find out the annual fall in growth rate. Higher rate minus the lower rate by number of years of fall. They don't mention the number of year. 1% fall, 1% fall every year. Like there can be a linear fall in growth rate, there can be a linear increase in payout ratio. There can be a linear increase in payout ratio. H model. H model said the price which you are calculating is sum of two parts. One is dividend, that is the company will grow at an extraordinary rate as well as at a normal rate, but specifically says H model. Specifically says H model. Dividend at normal growth rate you calculate. What is normal growth rate? Is today itself stability happened. Today itself stability happened. D0 into 1 plus normal. Stability will happen after 10 years, but today itself stability happened. Divide by KE minus G. Same denominator here, but because you are growing at a higher rate, you are growing at a higher rate, the difference into the base dividend into half of the number of years, I want to give some extra benefit. Half of the number of years, I want to give some extra benefit. D0 into high growth rate minus the normal growth rate into the transition period by 2 divided by KE minus G. Divided by KE minus G. Fair price is equal to another approach is P multiple approach, which is nothing but EPS into P multiple. If P multiple is given in the question, take it. Not given, 100% payout, inverse of cost of equity. And if you make an assumption, what is the assumption is book value per share is equal to market price, because ROE formula is EPS by BVPS. I assume this to be MPS. If both are same, inverse of ROE. Inverse of ROE is the P multiple. Inverse of ROE is the P multiple. Earnings growth rate model is not very much important. Instead of using D1 by K minus G, we're going to use E1 by K minus G. Implied growth rate by the current market price. The question has given some price and they said you first calculate the fair price. I did fair price calculation, I got 20. Question is saying no, only 40 is right. Only 40 is right. So take 40 as the number in the Gordon formula and calculate growth as balancing figure. Calculate growth as the balancing figure. Growth will become the balancing figure. Bonus issue. What is bonus issues? Here the question will say calculate the fair price of the share. When I do fair price of the share, present value of future cash flows discounted at investors required rate of return, first year dividend, second year dividend, third year dividend, fourth year dividend, fifth year dividend, then I'll sell the share. But if a bonus happens, you buy one share, but you'll sell 1.5 share or 1.2 share or 1.3 share or 1.4 share. You buy one share, but sales will be for what? 1.5 share or 1.2 share or 1.3 share. The sale number will be different and this number will be different because of what? The benefit which comes out of the extra bonus issue which has happened. And whenever bonus issue happen, number of shares will increase, dividend will also increase for me. The income will increase for us. So here sale proceeds will be higher number of share into the selling price. Normally whatever I calculate is equal to whatever calculation I do. If I calculate some number, that number is equal to whatever number I'm calculating, that number is equal to the maximum purchase price, because I calculated the fair valuation and fair valuation turned out to be 10, 15, 20, 30. That is the maximum purchase price. But in case there are any transaction cost in a question, my maximum purchase price will go down, because price plus the transaction cost, price plus the transaction cost is equal to the fair value. So transaction cost is percentage of the price, percentage of the price. So price plus 5% of price plus 5% of price is equal to the fair value. In a normal scenario, price is equal to fair value. In a normal scenario, price is equal to fair value, but now price plus 5% of price plus 5% of price. Clear? Any doubts on this? Okay, I'll wait for 2 minutes and then proceed. 2 minutes gap. Okay, we are almost done with the equity valuation part. A few more areas. Next is GDR. GDR is basically an Indian company like Infosys wants to raise money from US investor. US investor is saying, I'm ready to invest in your company, but I want you to issue shares in US dollar. The shares have to be issued in US dollar currency. Infosys India cannot issue shares in US dollar currency. So they do something called as a GDR issue, where I have 10,000 shares. I deposit with a custodian bank, and 10 shares is equal to 1 GDR. So the GDR are issued on the back of the security. GDR cost is equal to cost of equity, which is D1 by P0 minus F plus growth rate. The D1 and the denominator should be in the same currency. It can be in INR, it can be in US dollar, it can be in INR, it can be in US dollar. Same currency you have to take care. And the GDR, when we issuing, it will say today price is 300, 3 shares underlie each GDR, so issue price is 900 for a GDR. In this I may give some discount, 20% discount. 720 is the issue price. Convert this into dollar, and then get the price in dollar, and on top of that some flotation cost can be there. Cost of equity with multiple growth rate. Our formula for KE is D1 by P0 plus growth rate. But if you have multiple growth rate, you cannot use this formula. So what concept says is, you go ahead and write year, cash flow, PVF, DCF with some random cost of equity. Calculate the NPV of this investment. What is NPV? Year 0, today's price, 1, 2, 3, 4, 5, whatever inflow. And whenever it stabilizes, use the Gordon's formula, complete the valuation. One positive NPV, one negative NPV, and calculate the IRR. One positive NPV and one negative NPV. When you do perpetuity valuation, normally in NPV calculation, cash flow will not change. But here cash flow itself will change for different discount rate, because perpetuity valuation is dependent on the discount rate. You change the discount rate, perpetuity value will change. So every year you have to write dividend and the last year terminal value. Terminal value, be cautious. 2 times you have to do, 3 times you have to do. The cash flow itself will change here. Normally the cash flow remains same. In this case, the cash flow itself will undergo a change. PVGO. What is PVGO? What is the extra value the market is giving to a company because it is growing? Asian Paints, when it was growing, it was getting a higher value. When it is not growing, it may start getting a lower value. So value of a company with no growth. No growth means EPS equal to MPS. So indirectly EPS by cost of equity. This is the value if you don't grow. The current price could be more than that. The gap is called PVGO, present value of growth opportunities. Free cash flow approach. What is free cash flow approach? Is FCFE approach. FCFE approach. So if the question gives data on something called as capex per share, depreciation per share, all that information is there. I'll calculate FCFE. Formula FCFE 1 by KE minus G. FCFE means free cash flow of the equity shareholder, which is PAT minus how much equity is needed for capex and working capital, or net capex and working capital. What is net capex? Depreciation and gross capex adjusted value. Gross capex minus depreciation, working capital change will be there. This is the total money I need. In this, some money will come in the form of debt. Balance money equity guy will bring. So what equity is going to bring is called equity needed for capex and working capital. From the PAT, deduct this number. From the PAT, deduct this number, and you will get something called as FCFE. You will get something called as FCFE. This is the format of our income statement. Sales less COGS. You get gross profit, operating expenses, EBIT, operating profit or EBIT, interest, EBT, tax, EAT, any preference dividend there, EAES, number of equity share and EPS. In this interest calculation, problem is silent. Then they'll say 10% debt, 14% debt, 15% debt, debt into the interest rate, plus debt into the interest rate, plus debt into the interest rate. But some question did effective interest rate. It gave something called as an effective interest rate, which is a single rate for all the debt put together, which is a single rate for all the debt put together. So directly use that single rate, directly use that single rate. We have multiple types of ratios. Liquidity ratios, which is to test the short-term solvency of a company. Capital structure, long-term solvency of the company. Profitability ratio related to sales. Coverage ratio from an asset point of view, owner point of view, turnover ratios. I discuss some of the important ones if I feel some need is there. First one is liquidity ratio, ability to repay short-term liability. Both are self-explanatory. Current ratio, current asset by current liability. Quick ratio, quick asset by current liability. In quick asset, you have to remove stock and prepaid expense. This category is little important. Long-term ratio or capital structure ratio. This will tell where the money is going to come from. For FCFE, we said minus debt ratio. Debt ratio formula comes from here. Sometimes they'll use the word debt equity ratio, debt ratio, equity ratio. This has impact even on WACC calculation. Even on the WACC side, it has an impact. Debt ratio means debt divided by debt plus equity. Capital employed is debt plus equity. Ignore preference and all. Ignore preference and all. Equity ratio means equity divided by debt plus equity. Debt to equity ratio, as the name indicates, debt divided by equity. So there was one question which said debt to equity ratio. Then when you do WACC, debt is 2, equity is 1. When the question said debt ratio, debt is 0.5, equity is the balance 0.5. Equity is the balance 0.5. And if debt equity is 0.5, debt is 0.5, equity is 1. Equity is 1. Debt ratio, debt to equity ratio. Important, very important term. Capital gearing ratio means, this specifically we had to use it in one of the problem. Capital gearing ratio means fixed capital. What is fixed capital? Is debt plus preference divided by equity. Proprietary ratio means owner's fund. How much is my fund in the entire business? How much is my fund as compared to the total asset? What is this capital employed? Capital employed is nothing but funds deployed in the business. There is an asset side route. There's a liability side route. To put it simply, it's debt plus equity plus preference. Preference we don't have in many questions. Debt plus equity, that is equity including its reserves, debt, preference capital, any fictitious asset you removed. Any fictitious asset you removed. What we are doing in this category is, where is this capital employed coming from? Is it coming in the form of debt? Is it coming in the form of equity? Is it coming in the form of preference? If it's coming in the form of debt, it's called debt ratio. If it's coming in the form of equity, it's called equity ratio. Comparison of the two is called debt to equity ratio. Capital gearing ratio is fixed capital by equity, and proprietary ratio is proprietor funds by total assets. Coverage ratio. Coverage ratio is my expense coverage ratio is my income divided by my expense. My income divided by my expense. So coverage ratio is source of payment divided by what are we paying. Source of payment divided by what are we paying. Interest coverage ratio. If you look at in this format, interest is paid out of EBIT. Interest is paid out of EBIT. Preference dividend is paid out of EAT. Preference dividend is paid out of EAT. Equity dividend is paid out of EAES. Equity dividend is paid out of EAES. So what is getting paid and from where it is paid. Profitability ratio, self-explanatory. GP ratio, COGS ratio, net profit ratio, operating profit. Operating profit means EBIT. Operating profit is EBIT. Then we have turnover ratio. Again, another important category, because suddenly a question may give this ratio and you have to use that ratio to estimate the income or estimate the sales. Turnover ratio means it is based on sales. So sales based ratio, sales divided by relevant item. Now, why sales comes in the numerator? Let's understand. If it says asset turnover two times, if my asset is 100, I rotated that two times. I rotated it two times. So 100 into 2, 200 is the sales. 100 into 2, 200 is the sale. Fixed asset turnover ratio 5 times. Fixed asset 30 lakh, 5 times rotation. 5 times rotation. 30 lakh into 5, 150 lakh. 30 lakh into 5, 150 lakh. So sales divided by relevant item. Relevant item can be total asset, fixed asset, current asset, working capital, capital employed. It can be any of them. Like this, we also have other category which are turnover ratio, but they are not based on sales. One is debtor turnover ratio, which credit sale has to be used. Only credit sale is to be used. Creditor turnover ratio, credit purchases. Inventory turnover ratio, COGS. Inventory turnover ratio is COGS. In case I do not have credit sales, total sales can be used. In case I do not have COGS, sales can be used, but this is the preference. Debtors, credit sales, creditors, credit purchases, and inventory is COGS. Once this is calculated, 360 divided by 6 times rotation, 60 days once rotation. 360 divided by 6 times rotation, 60 days every time we are doing a rotation, which is called days, conversion into days. Debtor turnover ratio 10 times. 10 times I'm rotating the debtor money. It means in 36.5 day, debtor is making the payment. Debtor is making the payment. Then profitability ratio related to assets or investment. What is earned by what is invested, or what I get back minus what I give divided by what I give. ROI or ROC, the denominator is capital employed. I means investment. Investment is also capital employed. Investment is also capital employed. In the investment side or capital employed, you have debt, equity, and preference. These three people put together enjoy EBIT. These three people put together enjoy EBIT. But in this, suddenly one more person comes, which is the government. So I can have EBIT by capital employed, or EBIT into 1 minus tax rate by capital employed. EBIT into 1 minus tax rate by capital employed, or EBIT by capital employed. ROE, self-explanatory. This dividend yield, we had used it at many places. I kept on saying dividend yield, DPS by MPS. We did one question on M&A where I was talking about earning yield, EPS by MPS. EPS self-explanatory, DPS self-explanatory. Payout ratios, dividend as a proportion of EPS. One exam question talked about a certain ratio called fixed interest and fixed dividend coverage ratio. This has come in the recent RTP, but this formula is not logical. So ICI gave the formula in the question itself, saying that you use this formula, fixed interest and fixed dividend, because I cannot club them together. Interest and dividend coverage ratio not possible. So the formula which ICI uses is this. One RTP question which it came, they gave the formula itself, but still it's better to remember the formula. PAT, it will say PAT has to cover interest and dividend. So interest and dividend is the denominator. In PAT, interest has to be added back. Interest has to be no tax adjustment at all, no into 1 minus tax. All that is not done. Now, why are we learning all these ratios? The purpose is this. I will calculate the ratio. Once I calculate the ratio, if I am better or weaker than the other company, I can be better or weaker than the other company. If I am better than the other company, I deserve a higher valuation. If I'm weaker than the other company, I deserve a lower valuation. What is valuation? Into P multiple or divided by cost of equity. Into P multiple or divided by cost of equity. If you are better, higher P multiple. If you are better, lower cost of equity. If you are better, lower cost of equity. Our ratio is better, required return will decline. Required return will decline. Our ratio is weaker, required return will increase. Required return will increase. We also saw a concept called stock lending. What is stock lending? Is somebody is doing a short sell. When he does a short sell, he doesn't have the share. So he temporarily wants somebody to give him a share. So there is a person who is lending the share and there's a person who is borrowing the share. The lender, I own the share and I lend it. I will charge lending fees and I may get a dividend income. The borrower can make profit or loss on short sell. What concept? In the derivatives we learned, if you sell and price goes down, profit. If you sell and price goes down, profit. If you sell and price goes up, loss. So that will be there, along with some guaranteed charges to be given to the bank, and there can be a lending fees which needs to be, this both are same. Lending fees, income this side, expense on the other side. Then comes the rights issue. Now I want to raise money. When I want to raise money, instead of trying to get money from new people, it is easy for me to attract my existing people. So I go to the existing people, tell them that I'm doing really well, can you give money to us? That's called rights issue, raising money from the existing shareholders of the company. When I raise money from the existing shareholder, normally at a price which is lower than the current market price, normally at a price which is lower than the current market price. Here I have to calculate a X rights price. What is X rights price? Is weighted average of the current price and the rights issue price. Weighted average of the current price. Current price is existing shares into existing price. Rights issue price into the number of shares divided by existing shares plus new shares. In case any NPV and all you generate, please add it in the formula. In case you're generating any NPV, add it in the formula, because the share price will go up by the amount of NPV per share. So add it in the formula. Theoretical X rights price, expected price on completion of the rights issue. What is value of a right entitlement? Right entitlement is a rights issue is happening at 20. Today price is 30, and post rights it will be at 24. If it is going to be at 24, I am going to suffer a loss. 30 will go down to 24. So I should ideally go and buy this 20 rupee share, because 20 will become 24, 30 will become 24. Loss at one place, I'll get more profit at the other place and compensate, but I don't have money. When I don't have money, I can sell this right of mine to you. You pay the money and buy the share. So the theoretical value of a right, at the value at which a right will be sold, is nothing but 24 X rights price minus the rights issue price. X rights price minus the rights issue price. This money will come to me as an income, and for you it is an expense, and then you will get a new share at 20 rupees, and you get it at 20, you paid me 4, and your share will be quoted at 24, will be quoted at 24. This can be calculated as such, or you can divide by the rights ratio and call it as value of one right at a per share level. Now, whenever an organization does a rights issue, I have three things. Either I can subscribe, or I can sell the rights entitlement, or I can ignore it. Subscription, no problem. Sell the rights entitlement, no problem. Your wealth will remain same. But if you ignore the rights issue, wealth is going to decline. Ignoring the rights issue will lead to decrease in wealth. Will lead to decrease in wealth. Impact on EPS. Impact on EPS. This is due to buyback. Whenever an organization does buyback, the buyback will have an impact on earnings per share, book value per share, and number of share. Three items it will get impacted. First is earnings per share gets impacted because of PAT. PAT can go down. PAT can go down in a buyback because interest cost on debt, whatever buyback you did, you took money in the form of loan. You took money in the form of loan. If you take money in the form of loan and do a buyback, your PAT will go down due to the interest paid on the debt. PAT will go down due to the interest paid on debt. Or I had some existing money, that money was giving me some income. This income is removed from my income statement. Again, PAT can go down. There was a question where they said, I want this EPS. You tell how much loan we can take. So this is first part. Number of shares obviously will go down. EPS is a ratio of PAT, which is going down or remaining constant. Shares going down, EPS may go down, may remain same, or increase also. If it increases, it's a good buyback exercise. Same way BBPS. BBPS is net worth will decline. Net worth will decline by the amount of buyback. Number of shares will also decline, and BBPS may go down, remain same, or increase. Next comes the bond valuation. First, some basic terms with the bond. First term is face value, which is the nominal value of the bond on which interest is paid. Coupon rate, interest payable on the bond. Interest is always calculated on face value. Maturity value is amount payable on redemption, taken as par if the problem is silent. YTM is return earned by the investor by holding till maturity. multiple other names for YTM: cost of debt, discount rate, required return of investor, expected return, opportunity cost, market rate of interest, prevailing rate of interest, going rate of interest, similar bond interest. Multiple other names are there. One question asks calculate prevailing rate of interest. You have to calculate YTM. One question asks calculate market rate of interest. Calculate YTM. One question said calculate required return of investor. YTM. So technically YTM has multiple other names. How do I do valuation? Present value of future cash flows discounted at investor required rate of return. One caution: annual bond, annual cash flow, annual YTM. Half yearly bond, half yearly cash flow, half yearly yield to maturity. Half yearly yield to maturity. And if you have the first year price or year zero price, Modigliani Miller, P1 is equal to P0 into 1 plus cost of debt minus I1. You want to calculate the next year, P2 is equal to P1 into 1 plus cost of debt minus I2. Transaction cost. If I'm buying a bond and if there is any transaction cost, it is going to depress my return. It is going to depress the return which I'm going to make. If I'm normally earning 8 into 1 minus the transaction cost, like 1 minus the tax, 1 minus the transaction cost will reduce my return. Second, the question may say, how many days does it take to break even? I earn 8%. After transaction cost, it is 7.92. 8 is earned for 365. Transaction cost, let's assume, is 1%. If 8 equal to 365, normal YTM, not the 7.92, normal YTM, 8 equal to 365, 1 equal to question mark, 1 equal to question mark. Relationship between YTM, coupon rate and bond price. Coupon rate equal to what you want. I meet your expectation, par value. If I exceed your expectation, coupon rate greater than YTM, premium. Coupon rate less than YTM, discount. Greater than YTM, premium. Less than YTM, at discount. Yield, investor expectation and price relationship. Very, very important point. Any question says there is a change in interest, there's a change in yield, there's a change in investor expectation, it means change in only investor expectation. Bond interest cannot change. Coupon rate can never change unless it's a variable bond. So increase in investor expectation. If your discount rate is going up, price will go down. And if discount rate is going down, price will go up. Increase in investor expectation, decline in price. Decrease in investor expectation, increase in price. How do I calculate YTM of a bond? YTM is equal to IRR of the bond, is equal to IRR of the bond. First, you do a shortcut method. What is shortcut? CA inter cost of redeemable debt. You would have learned interest cost plus redeemable value minus net proceeds by life divided by redeemable value plus net proceeds by 2. This you will do it in the calculator. After you do it in the calculator, you can start that as the initial rate, one positive NPV, one negative NPV. One question said, what is the spread of yield from comparable bond? What is spread of yield? Is calculate YTM of our bond, YTM of the comparable bond. Difference. Spread means difference. Spread of yield of comparable bond. There are two types of YTM also. One is from an investor point of view and company point of view. Investor also two type: pre-tax, post-tax. Pre-tax means without tax cash flow, interest without tax, capital gain is not there, terminal value, calculate the YTM. Post-tax means interest is after tax, capital gain is to be considered in the calculation. Similarly, company point of view, pre-tax and post-tax. In company YTM, what happens is company is going to receive money on day 0 and keep paying money over the life. Receive money on day 0 and keep paying money over the life. So it is little different from a normal NPV or IRR calculation, because normally in NPV or IRR you have outflow and then a series of inflow. Here inflow and then a series of outflow. If you use pre-tax number, you will get pre-tax YTM. If you use post-tax number, post-tax YTM. To put it differently, this is not YTM. This is cost of debt. This is cost of debt. Company we are calculating is what? Cost of debt. Pre-tax cost of debt and post-tax cost of debt. Current yield is more relevant if it's an irredeemable bond. Current yield is nothing but interest divided by current market price. Current yield, if the question says current yield, it can even mean YTM, okay? Because the current yield means what is the yield today. Current yield, if it's an irredeemable bond, interest by current market price. For a redeemable bond, current yield, if it's given directly in the question, can mean yield to maturity. 2, 3 problems we have done that. It will mean yield to maturity. Increase or decrease in interest rate has to be interpreted as change in what? Investor expectation. Only investor expectation can change. Bond coupon cannot change unless it is a variable bond. Unless it is a variable bond. A variable bond interest changes with the change in investor expectation. Interest changes with the change in investor expectation. If investor wants more, I will start paying more. That is increase there, coupon will also go up. Decrease there, coupon will also go down. PVF computation for discounting purpose, another important area. It can be for equity valuation, bond valuation, NPV computation. Uniform discount rate. If it's uniform discount rate, PVF of year 2 is equal to 1 divided by 1 plus 10% equal to first year equal to second year. Change in discount rate. If there is a change in discount rate, there are two types of scenario. One is forward change and second is spot discount rate change. What is forward changes? Only the change for the second year, not for the first year. Only the change for the second year, not for the first year. In that case, PVF of year 2 is equal to whatever you calculated for first year. First year you would have done 1 divided by 1 plus 11%. Leave the number as it is and now do 1 plus 10%. If it is the change from the spot is from today. So first year you do 1 plus 11%. Second year you want to do 1 plus 10% 2 times. Third year 1 plus 9% 3 times. Fourth year 1 plus 8% 4 times. If it's forward change, 1 divided by 1 plus 11, same number by 1 plus 10, same number by 1 plus 9. Whether the given question is spot yield or forward rate, just see that. Expected price not very critical, but exam question keep coming where intrinsic value of the bond is multiplied with the beta. The formula is not fully logical. Discount rate for arriving an issue price. Whenever I want to arrive at an issue price, my discount rate should be equal to YTM. YTM has multiple other names as we saw, but some exception can be there. What is the exception? Is company says the ideal discount rate is 15%, but I want to pay 16-17%. I want to pay 16%. The ideal discount rate is only 15%, but I want to pay 16% to the investor. I want to pay 16% to the investor. Go ahead and use 16% as the discount rate for arriving at the issue price. Fair valuation 15%, issue price 16%. Broken period bond valuation. What is broken period bond valuation? Is whatever approach of valuation we have, year cash flow PVF DCF or period cash flow PVF DCF, can only be used to value the bond on a date on which interest is getting paid. This is technically called as clean price. Add accrued interest, you will get dirty price. Clean price, add accrued interest, you will get dirty price. We did this when we were doing money market instrument. Same logic is worked out here. You find out the price before the dividend is, before the last interest payment date. Valuation of bond on non-interest payment date, March 31, September 30. Valuation on June 1. Before June 1, last interest was paid on April 1 or March 31. Arrive at that value, add accrued interest. Add accrued interest. This is called clean price. Adding accrued interest is called dirty price, or the price at which it will quote in the market. Realized yield to maturity. What is realized yield to maturity? Is modified IRR. It is nothing but modified IRR. Realized to YTM is you have to first calculate cash flow for every year. Assume a reinvestment rate. Assume a reinvestment rate. Compute maturity cash flow of every year by taking a reinvestment rate. Reinvestment rate could be given in the question, or you can take it as cost of debt or cost of capital. One question said intermediate cash flow cannot be reinvested. You cannot reinvest them. In that case, reinvestment rate is 0. Reinvestment rate is 0. Compute IRR with one initial cash flow and one final inflow. One final inflow. That is called modified IRR or realized yield to maturity. In this, they will also ask something called as reinvested interest. What is reinvested interest? Is interest on the interest income. Interest on the interest income. Every time I get an interest, I reinvest it. 8 rupees I got. By the 5th year, 8 became 10. Second year, I got 9. That became 11. Third year, I got 9. It became 9.5. What extra you got is called as reinvested interest. What extra you got is called reinvested interest. Now, there is also a relationship between reinvestment rate and, so that is your normal YTM and realized YTM. What is normal YTM? Is normal IRR. If my normal IRR is 10 and I reinvested 12, very happy, reinvested at a higher rate. Normal is only 10, but I reinvested at 12, I will realize more than 10. I'll realize more than 10. Both are equal. Both are equal. Realized YTM is equal to normal YTM. Realized YTM is equal to normal YTM. My reinvestment unfortunately happened at 8, whereas other normally we were earning 10. Normally we are earning 10, but reinvestment happened at 8. The realized YTM will go lower than the normal yield to maturity. To put it simply, the realized YTM will be between these two rates, reinvestment rate and the normal IRR. Reinvestment rate and the normal IRR. If reinvestment is 12, normal is 10, in between answer will come. Normal is 10 and reinvestment is 8, in between 8 and 10 will come. In between 8 and 10 will come, and both are 10, final answer will be 10. Duration, there are three meanings of the term duration. First meaning is how long on an average does it take to receive the cash flow from the bond by using a weighted average of the cash flow, by using a weighted average with the time period. That is, every year you get a cash flow, year into the DCF, year into the DCF, put a total, divide by total DCF, year into the DCF, put a total, divide by the total of DCF. Second, time period at which there is no interest rate risk, technically called immunization, of the portfolio. Third is it can be used to compute volatility, and volatility can be used to find out the change in price, find the change in price. So how do I calculate duration? I need not calculate weight. I had told you in the class, you just do year into DCF, put a total of year into DCF and just divide by DCF, just divide by the DCF. Duration, redeemable, total of year into weight, no year into weight, year into DCF and put a total and divide by the DCF, you'll get the answer. Or you do this approach also, you'll get the answer. For a half yearly bond, your period will be in half years. And whenever you are doing duration, you cannot write annuity factor. You cannot write annuity factor. So you'll have to write 1, 2, 3, 4, 5. So your calculation will be in half years. Final duration will be in half years. You can convert into years if you want. You can convert that into years. Irredeemable, because there is no end to the irredeemable bond. 1 plus YTM by YTM. 1 plus YTM by YTM. Volatility or modified duration. Volatility or modified duration. This can help me in finding out the impact of changes in yield. Yield goes up, price goes down. Yield goes down, price goes up. Inverse relationship. Volatility is duration divided by 1 plus YTM. This means if volatility is 3%, yield change by 1%, price will change by 3%. Yield up by 1, price down by 3. Yield down by 1, price up by 3. First is this. It is not necessary that yield has to change by 1. It can change by 0.5, 1.5, 2. So percentage change is equal to volatility into the change in yield. Volatility into change in yield. Yield will increases, price will fall. Yield decreases, price will increase. For a half yearly bond, I'll have to calculate volatility little careful. The approach is in the denominator will be half yearly YTM. In the denominator will be half yearly YTM. What can you do? If you have duration in years, divide by 1 plus half yearly YTM. And if you have duration in half years, again divide by 1 plus half yearly YTM. No problem. It can be in years, it can be in half years. If you are using yearly data, multiply with annual change in interest rate. And if you are using half yearly data, multiply with half yearly change in interest rate. Both will give same answer ultimately. Denominator is 1 plus half yearly YTM. Denominator is 1 plus half yearly YTM. Using the concept of duration, I can churn my portfolio. Churn means I can change my portfolio. What changes I will make? If interest rates are likely to go down, bond prices will go up. Go up means high duration, high volatility, higher increase. High duration, high volatility, higher increase. If interest rates are likely to go down, price will increase the duration, high duration, high volatility, higher price increase. Other way around, if yield is likely to go up, price will fall. Lot of people today are investing in high duration bond. Reason is interest rates are likely to go down in India. If it is likely to go down, high duration bonds will give me the benefit of price increase, will give me the benefit of price increase. These are the three factors which can impact the duration of the bond. Time to maturity, self-explanatory, lower time to maturity, lower duration. Others, coupon and yield to maturity. Coupon, if I get money faster, and yield to maturity, again higher YTM, both of this will lead to lower duration. Higher will lead to lower duration. As far as time to maturity is concerned, lower time to maturity will lead to lower duration. When we were doing a problem, I had shown some numbers to show this validation. Immunization. What is immunization? Is whenever interest rate change in the market, I get impacted in two forms. One good form, one bad form. What is good form and bad form? Interest rate went up. Interest rate went up. Bond prices went down. Bond prices went down. But I'm happy about it because my reinvestment income will increase. My reinvestment income will increase. And decrease in interest rate. When there is a decrease in interest rate, again there is a two-way analysis. If there is a decrease in interest rate, price is increasing, but my reinvestment income is going down. This is called price risk. This is called reinvestment risk. Gain from one risk is equal to loss from other risk is called immunization. Gain from one risk is equal to loss from other risk. Effect of price risk is exactly offset. Is exactly offset. When will this happen? If you invest exactly equal to duration. If you need money after 4 years, find 4-year duration bond. If you want to fund an outflow after 6 years, find a bond which has 6-year duration. You don't have do weighted average. How will you do weighted average? Bond duration, weight, product. Bond duration, weight and product. How do I decide on bond refunding? What is bond refunding? Is replacing an existing bond with a new bond, like replacement decision. First find out what is the outflow today, then you find out what is the saving you get every year, and is there any terminal inflow or terminal outflow. What outflow can happen today? All this will happen to the old bond. I'll have to pay to the bondholder. There can be a call premium. Anything related to old bond, write it off. Anything related to old bond, write it off. If you pay extra call premium, write off. If you had some flotation cost, write off. What is the use of write off? Tax benefit. Tax benefit. Anything related to new bond, no tax benefit immediately. No tax benefit immediately. Then comes the step 2, interim saving every year. What is interim saving every year? Assume as if the old bond is continuing and the new bond is happening. Find out the after tax cash flow, after tax interest cost, after that is first interest, tax saving on interest, tax saving on flotation cost, tax saving on issue cost, all that you consider, and find out what is the after tax outflow in both. In the new bond, outflow will be lower, that is the saving. In the new bond, outflow will be lower, that is the saving. Similarly, end of year outflow of the old bond and new bond. In old bond, you have to pay par value. New bond, you have to pay more than par value. Then that difference will be an extra outflow. Can be an extra outflow or extra inflow. After this is calculated, I have to discount it. What discount rate do I use? After tax cost of debt. After tax cost of debt. Because bond refunding is done with the purpose of issuing a new bond in place of an old bond. After tax cost of debt. If it is not given, after tax cost of new debt. After tax cost of new debt. Next comes the concept of forward rate. What is forward rate? It's forecasting the future interest rate. Forecasting the future interest rate. How do I forecast? FRA formula which we saw. Same logic is going to work here. If cash flows are given, use the cash flow structure. What is used the cash flow structure? 1 year bond. I have a 1 year bond. Year cash flow, PVF, DCF, year 0 outflow, year 1 inflow, NPV 0, PVF of year 1 is balancing figure. PVF of year 1 is equal to 1 divided by forward rate. It's 1 divided by 1 plus forward rate. Sorry, 1 divided by 1 plus forward rate. 1 divided by 1 plus forward rate of year 1. You have to, in the denominator, add 1 plus. That's how normally the rates are written. 1 divided by 1 plus forward rate of year 1. Then you go to a 2-year bond. In the 2-year bond, PVF of year 1 is copy pasted. PVF of year 2 is balancing figure. PVF of year 2 is equal to PVF of year 1 divided by 1 plus the forward rate of year 2. PVF of year 3. This is if cash flows are given. Interest rate given to very simple. If they ask 1 to 2, future value factor for longer period divided by future value factor for shorter period minus 1. Future value factor for longer period divided by future value factor for shorter period minus 1. If they give 2 to 4, future value factor for longer period 4 years, Future value factor for shorter period 2 years -1. But this number is a 2-year number. This number is a 2-year number. You cannot divide by 2. You'll have to do the effective rate of interest concept, which is 1 plus r square is the number you calculated. 1 plus r square, take a square root. If you calculate month 3 to month 6, the number which you calculated is for a 3-month period. Do into 12 by 3 into less than a year into 12 by 3 into 12 by 6. More than a year, 1 plus r square, 1 plus r cube, 1 plus r power 4. Yield curve. Yield curve means how is the interest rate in the market. Yield curve is nothing but how is the interest rate in the market. Normally longer period, that is a 10-year FD should have an interest rate higher than a 2-year FD. Longer period should be higher. That is a normal yield curve. Long term interest is greater than short term interest. Inverted yield curve means long term interest is lesser than the short term interest. That is, short term interest is on the higher side. This is lot of uncertainty, recessionary condition, lot of uncertainty. People are not ready to invest money for longer period. Some problem is there. This is recessionary condition. Flat yield curve means both are equal. Both are equal. Bond convexity. Now we learn duration concept. Duration can help me in calculating the new price. Duration can help me in calculating the new price using the volatility concept. So I did that. I got 100. And when I did discounting technique, I got 102. There is a difference. What is discounting technique? Year, cash flow, PVF, DCF. You got a different answer. There will be small variation. This variation, I want to plug it little bit using the next concept called convexity. Convexity can help me in price computed using volatility does not match with the price computed under PV of discounting method. Gap between these two can be reduced using what? Convexity, and making estimation more accurate. How do I calculate this? Very simple. V plus. What is V plus? Is what happens to the price if yield is going up, what happens to the price if yield is going down, minus 2V0 divided by 2. This is the final convexity adjustment. Just divided by 2 is the final convexity adjustment. If you divide by V0, then convexity adjustment in percentage. And if you divide by delta y square, that's called convexity. After you calculate this, again multiply with delta y square. Multiply with V0 to get convexity adjustment. What normally is calculated is convexity, then convexity adjustment. But what we do is we directly calculate the convexity adjustment, which is just dividing by 2. If you divide further by V0, it's expressed in percentage. And if you further divide by delta y, that is the final convexity. After you get the convexity, multiply with delta y and V0, you'll get the convexity adjustment. Preference share valuation, very simple. Redeemable bond, present value of future cash flows. Irredeemable bond, current yield formula. Preference dividend by investor expectation. Okay, another point is valuation of warrant. What is warrant? Is something which can be converted into shares. Technically, it's a call option. With a specific rate. The rate is already decided. So if rate is 50 rupees and in the market it's 100, you will pay only 50. The gap of 150 is the value of the warrant. The gap between 100 and 50, and one warrant can give me 100 shares also. So 100 shares, it gives the gap into 100. Next comes the convertible instrument. In convertible instrument, we have a lot of terms which we need to be aware of. First term is conversion value or stock value. What is conversion value or stock values? Value of the bond if it's converted today. What is converted today? Converted into equity share. Today, current market price of the share into the conversion ratio. When you calculate this and compare with the value in the market, there will be extra which you pay. That's called conversion premium. You are paying 1000. Conversion value is only 800. This extra can be per bond if you divide by the conversion ratio per share, and if you divide by the conversion value or the current market price, percentage of conversion value, percentage of current market price. Like premium, we also have something called a straight value and downside risk. Like conversion value, conversion premium. Straight value will give downside risk. What is straight values? Present value of future cash flows of the bond without the conversion option. Can be called a straight value, intrinsic value, floor value, minimum price. Once you calculate this is 700. Why am I paying 1000? Because I feel conversion will happen and it will be beneficial. 700 and 1000 gap is called downside risk. 700 and 1000 gap is called downside risk because a bond can fall down to 700. It cannot go below 700. It cannot go below 700. So that's called downside risk. Current market price in excess of straight value. This can be calculated per bond. Per share will not be happening. Per bond or percentage of straight value or percentage of current market price. With the current market price, I can also calculate something called as conversion parity price, market conversion price, minimum price for conversion, break even price. This is all same name only. What is conversion parity price? Is the minimum price at which I will go for conversion, the minimum price of the share at which I will opt for the conversion option. Next is favorable income differential. Investing in bond has one disadvantage. You are paying extra premium, but has an advantage. What is the advantage? Bond will give me 100 rupee interest. Shares will give me 1 rupee dividend. 30 shares are there, 30 rupee dividend. So if I invest in bond, I get 100. If I invest in share, I get 30 shares. So you invested in share, you got 30, I got 100. 100 minus 30 is the favorable income differential per bond. 100 minus 30 is the favorable income differential per bond. This I'll compare with what I paid extra. With what I paid extra, I paid extra 200. 70 is favorable. This will help me in recovering the premium. Will help me in recovering the premium. Premium payback period. Premium payback period. So per bond extra can be calculated at a per share by dividing with conversion ratio. By dividing with conversion ratio, and whatever is the conversion premium per bond divided by the favorable income differential per bond, and per share divided by favorable income differential per share. Convertible bond valuation. Valuation of any bond is present value of future cash flows discounted at investors required rate of return. But redeemable value will have to be little cautious. In a convertible bond, there are two things to be calculated. One is the redemption value, which can be par if problem is silent. Second is conversion value on the last day. How do I calculate conversion value on the last day? Calculating price of fifth year of the share. How can I calculate price of fifth year? P5 is equal to D6 by K minus G, or P0 plus 5 plus 5 plus 5 plus 5, something can be given. I have to estimate the future price. I have to estimate the future price. After estimating the future price, take whichever is higher. Take whichever is higher and then do the valuation. Then do the valuation. Decision on conversion is same as conversion parity price logic. If the current market price is greater than conversion parity price, go for conversion. Otherwise, do not opt for conversion. I can opt for conversion only if the current market price is greater than what? Conversion parity price. Enterprise value is a concept which says I want to value the company on a whole. So we have total enterprise value, which is value of debt plus value of equity minus cash and cash equivalent. Operating enterprise value is total enterprise value minus the non-operating investment, and core enterprise values. From this, remove the non-core asset. It can be used to do valuation, EV to EBITDA multiple or EV to sales multiple. EV to EBITDA multiple or EV to sales multiple. TCS EV to EBITDA, calculate and use it for Infosys. EV to sales, calculate for them and use it for Infosys. So this is the purpose. And a question may ask, what is the cash return on total investment, which is nothing but 1 divided by EV to EBITDA multiple. 1 divided by EV to EBITDA multiple. EV divided by EBITDA. Inverse, if you do EBITDA divided by EV. EBITDA is cash. EBITDA is in cash because depreciation is not subtracted, and divided by EV. So cash return on total investment is EBITDA divided by EV, or inverse of EV to EBITDA multiple. Next comes yield of a treasury bill or money market instrument. Any money market instrument, the valuation will happen or return will happen calculation using NAV1 minus NAV0 by NAV0 into 365, no 12, into 365 by number of days into 100. That is closing price minus the opening price maturity value minus the issue price divided by the issue price into 365 by number of days into 100 is equal to the yield. This can also be used to calculate the issue prices balancing figure. The issue prices balancing figure, when you do into 100, other side you have to write the number as it is. That is, if it's 12, write 12 as it is. Don't put a percentage there. Just write 12 as it is. In case there is any higher frequency of compounding, what is higher frequency of compounding is quarterly compounding or half yearly compounding, then you have to calculate effective rate of interest. What is effective rate of interest? 1 plus the normal rate divided by number of compounding power the number of compounding divided by number of compounding power the number of compounding. Clear? And in case there is something called as compensating balance. What is compensating balances? I issued a commercial paper. I got some 50 lakh rupees, but bank is not allowing me to withdraw entire amount. He's saying keep 2-3 lakhs in the bank. Then what we do is we first calculate the interest cost. There could be some cost of placement, stamp duty, issuing charges, other charges, put all the total. And amount raised is 50 lakh. In this, I cannot withdraw 1 lakh 50, and I had to originally pay stamp duty, issue charges, rating charges, sometimes interest also paid initially. So whatever you pay, subtracted, and this is called effective amount raised from 50 lakh. Deduct line of credit to be maintained, deduct all cost other than interest, even deduct interest if it's upfront paid. Then what is the formula for effective cost of CP? Simple logic. Effective cost of CP is equal to all cost divided by effective amount raised into 365 by number of days or 12 by number of months into 100. This is pre-tax into 1 minus taxes post-tax. Last concept in this chapter is on the repo and reverse repo transaction. In a repo transaction, there is a bank which has need of money and it has invested in 12% GOI bond. It doesn't want to sell the bond. So it gives this bond to Bank B. Bank B gives a loan at a rate of interest which is only 5% because Bank A is a well reputed bank. So they get a loan at 5%. Normally this will be given to RBI and RBI will give a loan. When RBI gave loan at 5%. Bank A very happy because I continue to earn 12% interest, but I pay only 5% interest. That bond belongs to me just as a safety I have given you. I keep earning this. I got the money, I return it and get back the security. Now, what analysis could be needed? Question will ask something called as clean price and dirty price. Clean price means value without the accrued interest. Dirty price is clean price plus accrued interest, and accrued interest will be at the value of the bond, will be at the interest rate of the bond, So accrued interest will be at 12%. Once I calculated this, I give you 1 lakh bonds. 1 lakh into the dirty price is the amount I deserve to get. You say, no, I'll not give you the full amount. In this, I'll deduct some margin. I'll deduct maybe 2%, 3%, 4%. So into 1 minus the initial margin and then I give you the amount. Into 1 minus the initial margin and then I give you the amount. Then I have to return this money, which is called the second leg of the transaction, plus the interest. Interest will be at the repo rate, which is 5% in this example, will be at repo rate, which is 5%. Accrued interest at 12%. This is at 5%. This is at 5%. Clear? Any doubts in this? So we have actually covered the equity valuation part as well as the bond and everything. It's a very lengthy area, but as you go through, you will keep getting clarity on concept. We'll take a 15-minute break and then resume with the balance areas. Okay, we proceed ahead. We are left with 4 chapters now. We proceed ahead. We are done with 8 chapters, including the security analysis part. If I take 8 chapters are done, 4 are pending. I spend 10-15 minutes before I go to the next chapter on what you need to do now to complete your preparation, how to write the exam, what needs to be done from an exam point of view, what you need to do in 1.5 days before exam. In the classes, I have tried to cover it in a comprehensive manner. Most of the things are covered in the class, except for few things here and there, which I have told you to do. As a strategy, first, for 1.5 days, the doubt is, should I do concept book, concept charts, or should I do MCQ, or should I solve practice questions? The ideal approach is concept book, charts if you want to use it along with that, or either ways, whichever way, concept book or concept charts. MCQs you should try to solve it. MCQs you should try to solve it the day before exam. Every chapter, take mutual fund chapter, go through all the concept. You can ideally do what I did today, that 30-minute video, just hear it, or a 20-minute video. And mutual fund, I think it's a 30-minute video. Hear it faster. Solve the MCQs if you can get time for another 15 minutes to solve the MCQ. And after that, Ideal thing to do is solve in the mutual fund chapter. I have kept 1, 2, 3, 4, 5, 6, 7, 8, 9 questions are there. See how much you can solve out of this. This is my not important question. This is the questions to cover maximum concept. Practice has to be done. So you have asked me, should I solve questions and see 100% you have to solve. MCQs alone are not going to help. MCQs can only help in quick revision. It can only help in quick revision. MCQ can only show you the path. It cannot help you in completing a solution in exam. So you have to practice solving question. I'll share this list with you. This is again, I'm saying it's not important, unimportant, nothing like that. It is only the areas where I felt maximum concepts can get revised. Some of the concepts are not here because they are getting revised in MCQ form. So everything has to get revised, some in MCQ form, some in non-MCQ form. I'll share the list to you guys. You see what you want to do. This is on your strategy before exam. 1.5 days before exam, approximately you can say you will have around, maybe I take 12 hours a day, another maybe 8 hours in that earlier day, are all put together 18 to 20 hours is the max a student will have to complete the preparation. That's the max you will have. In that, at least 2 hours give it to theory, at least 2 hours. Don't give anything less than 2 hours to theory. And for theory preparation, you should at least do one time preparation. After you are done with one time preparation of the theory, you can ideally just go through page 218 to 251 of the concept book. 218 to 251 of the concept book, where the entire theory is again given in summary form. Now the problem is, I myself will not remember some of these because I don't remember all the points of theory. So first you have to read the theory, and then only these points will be understandable to you. Somebody thinks, no, I will directly read this. That's your wish, but direct reading is not advisable. It is not advisable. At least 2 hours for the theory. You can even do two more also, three also okay, four also okay, because descriptive anyway you will be able to answer it. If you had clarity on the concept, you will anyway be able to answer it. Theory is something, memory power is needed. You will not be able to answer it unless you go through the theory part day before the exam. So theory 100% you have to give time. Don't end up ignoring the theory part thinking that no, I will ignore it, I will be able to manage. All that will not work. So theory videos are there. You see theory video if you want. Don't want to see theory video, don't see. But first you read full reading. Full reading is, there is a theory material of 90-95 pages. Do one time full reading, then you do summary reading. I'm okay with doing summary later on. First you do one time full reading, understand it properly, and after you understand that, you get into the summary theory mode. That is more than sufficient as far as theory preparation is concerned. Any complex area you don't understand, you have a choice: watch the video. If you still want to get more clarity, or you're not able to get clarity, or you don't want to watch video, I tell very simple. You have my soft copy. Copy the content, put it in chat GPT, tell them to simplify and explain it. It'll explain in a very easy manner. You'll be able to understand it, and that goes there. So wherever theory you want, not my subject, any subject where soft copy material is there, just copy the content, put it in chat GPT. Many of my content I've used chat GPT. Many of my content has chat GPT usage. So put it in the chat GPT, it will simplify and explain you. Like, you can put comments like anything. You can put a comment saying that explain this as you explain to a kid. It will explain in a very simple manner which you understand, and then go ahead. If you understand the crux, easy to present it in exam. Without understanding, just by hearting things is not going to help. So entire theory content, you copy the entire 2 pages of theory, control C, put it there, and say simplify this or explain this in a better manner. It will explain to you. Use it. I'm not saying my content only has to be used. You use my content, or you use chat GPT usage, or you go through my video. My video, that's what I'm trying to do, but you have to listen to the video. Goes on for a longer period of time. Time constraint can be there with few of you. So whatever way it works, but theory preparation has to be given its own weightage. Don't think theory can be ignored. Okay, so theory 2 minimum, can go to 4. Beyond 4 is difficult for you to give time. So at least that amount of time you have to give to theory. After that, for the practical area, if you are quite confident about some of the chapters, please don't waste time on that day before exam. Just the concept book is sufficient. No need to solve also. No need to, but concept book 100%. Concept book or concept chart, whatever way you are comfortable. Concept book, concept chart with MCQs if you can solve. MCQs also I leave it to you. It all depends on, because it ultimately what matters is how much time is available at your end. It all depends on can you afford to spend that time or not spend that time. That is the call we are taking. See, when I do in a regular class, I cover AFM in 200 hours. When I do it in a revision, I almost cover the same thing in a 80 hour, and then the speed obviously is at a different level. So students feel that I go faster in revision. I don't have a choice, because if I want, I can go through. I told you to go through interest rate risk management in a regular video. Some of the student message me saying that can you give the revision itself? I don't want to look at regular because time is not there. Time becomes a challenge, so that you have to maximize the time. In the regular class, focus was getting to know everything. In the revision, ROI, I want maximum return per hour. Every hour I spend, I want 1 mark at least. That was the logic with which this is taken. So maximum return was needed. Same, I'm talking about your 1.5 days. In 1.5 days, you decide what you want to prepare and decide your strategy now itself. Some students say, give me the order of preparation. For some student, Forex is very easy. They are saying it is okay for me. Forex is easy. For some other student, Forex is very difficult. They may have to read Forex first. And if it's very easy for you, you may not read Forex first. So I cannot give a direct order saying that this is the order of preparation. Lot of things has to be customized according to your requirement. You would have felt when I started with mutual fund, some student would have felt why he started with mutual fund, can he start with other topic, is this topic better, because everybody have their own expectation. You cannot fulfill everyone's need. So you decide your strategy, what you want to do, but make it very very clear what you are going to do as a strategy. So 1.5 days theory preparation. Right today itself, theory how many hours you're going to spend, Forex how many hours, derivatives how many hours, mutual fund how many hours, bond valuation how many hours, that is security valuation how many hours. Every chapter note down the number of hours you are going to spend day before exam. When you are doing preparation day before exam, 10 minutes up and down is okay, but beyond that you cannot afford to waste time. And take a call, is it 20 hours you're going to study in 1.5 days, or is it 18 hours you're going to study, or is it 14 hours, 18, 20, 25, whatever be the number of hours. Decide that properly and just go with that plan. Not for my subject, I'm talking about every subject. Decide your plan now itself. I came for class with certain plan. I did tweak the plan little bit up and down, but without plan I cannot just come and say that I'll start the class and I'll complete maybe on the 12th day, maybe on the 13th day, maybe on the 15th day, maybe on the 18th day, maybe on the 20th day. It doesn't work. Planning is needed, so you do your planning on your 1.5 days. I cannot give a strategy. Many students say you give your strategy. I can only tell you few pointers. Theory needs importance. First preparation is theory. Balance whatever you do. It's your wish what you want to do. Problem solving should be there. Day before the exam, you should solve few question. May not be 170 question. You decide how many questions you want to solve, which questions you want to solve. When I share this list, in this also, if some question you are comfortable, mark it easy. Don't do them. Whichever you find little tricky, you do all those questions so that you get grip on various concepts. Anyway, in the question name itself, the concept is there. Minimum risk for two security, APT formula 1, APT formula 2. So if somebody says, no, I know APT formula 1 and all, how it works, don't see that question. Don't see that question if you know what is APT formula 1. If you know what is portfolio beta, don't see. Beta computation using formula 1 and 2, you don't see it. So you decide what you want to see, what you don't want to see. I give the concept name and the question number. In the revision which you are going to do after some time, whatever, because my class gets over, after that you decide which question you want to practice, which you don't want to practice, but decide your 1.5 day strategy. Only pointer I can tell you is theory is important, and practical area, give the number of hours now itself, which chapter, how much time you want to spend. I hope most of you are writing the May exams. So switch off your social media, switch off IPL, because IPL is starting today and you will start watching it. I will watch it. I can afford to watch. You cannot watch it. You cannot watch it. I can watch it and I have no problem in that, but you are not going to watch it. Make it very, very clear. In May exam, this is one headache which keeps coming in and people waste lot of time on it. People waste lot of time on that. You end up wasting time. ICA will say no problem. November, right? That time IPL is not there. That time no IPL. You write it in November. You will not clear it. You will write again in the month of November. So at least lot of people have that interest in cricket or whatever. Not cricket is, I'm just telling about IPL, but it could be other things also. But you don't have a choice now. You don't have a choice. You have reached a stage where time is very, very critical for you. If I suddenly say that I'll take another 5 days of classes, then people will get irritated, because I know you would have done your planning using certain pointers saying that okay, I need only this much amount of time. If it takes more time, it is difficult for me to plan my other subject. So everything is known, and that is where we also try to manage within the given time. So in that, if you end up wasting time on non-core things, it will become very, very difficult. And try to write one mock test. You have asked me to keep a mock test. I don't think so I'll be able to keep it, because time constraint, a lot of other things are going on with me. I have to start my inter revision. Possible I'll give a paper, but I would suggest you to don't look at MTP2 of the ICI. MTP1, I kept on telling this happened, that happened. MTP2 will come at some point of time. Whenever it comes, you don't look at the paper. Whenever you are ready to write all the subjects. If you're writing group 1, write all group 1 subjects. Writing group 2, write all group 2 subjects. On the MTP, you can write on your own. ICI doesn't do evaluation. There are some portals which says for MTP we will do evaluation and give it to you. They may charge you 200 rupees or 150 rupees or 100 rupees, whatever it is. Just search about those portal, which ICI mock test paper you have to write, give them your scrap. You have to scan and give them. They will correct and give comments to you. Whether it is useful, not useful, also I'm not sure what kind of comments they give, but for your satisfaction, write it and give it to them, so that they evaluate and give it back to you. But write it properly. Write it properly. If you are not fully prepared, don't write it, because you will see marks very low, and then that will break your confidence. So if you are confident, go ahead and write. I will at least suggest you to write one MTP. Don't look at MTP2 till you are ready. MTP1 will not work, because I've discussed many days. This has happened, that has happened. So MTP2, you are, whenever you are ready to write, go ahead and write that test, scan it. Those portals are there. You search, you will get the portal name and upload it there, and they may charge something. So just invest it and close it. This is on your test process. Test process, one test. Don't try to write more test and all. Time is not there. I normally suggest people to write lot of tests, chapter wise test, all that is there. But time is the problem, and we have now reached a stage where I don't think so you'll be able to spend that much amount of time in writing test also. MCQ tests are also there in my app. That also, how much time you will be able to afford, I don't know. It all depends on person to person. Some people are writing one group, some people are writing both the group. So it depends on person to person. If you are having time, go ahead and spend. MCQ tests are there, which will give you the score. It will give you a feeler as to what is going to happen. But all those MCQ tests is on the clarity side, but writing is different. Writing the test is different. Descriptive is different. MCQ is different. Descriptive is different. Why in the class I do MCQ format? It is easy for me to explain the concept, easy for you to get the concept also. If you have got the concept, you'll be able to solve a descriptive question. That is very much possible, because students feel MCQ alone cannot help. That's not the point. MCQ alone can help, because otherwise courses like CPA, CFA will not be MCQ based. They are MCQ based courses, because that is sufficient if you have clarity on the concept. If you have clarity on the concept, but in ICA exam, you have to then present it in a descriptive form. Clear? So 2 3 main points from me. Decide your 1.5 day strategy. That's the most important point. Write one mock test. Cut down on all your social, whatever way I call it, whether it's social media or your friends, whoever is interested in study, just keep friendship with that person for the time being. Others, you cut it for the time being. No choice. You don't have a choice. There will be good people. Well, friends are good, but some people will say you will manage it, no need to study, you will manage it. All that is not needed. Spend time. Despite all this, I'll tell you what happened with me. Whatever you prepare, confidence will not come in this course. It is a natural thing which happens. My last exam was indirect tax. Day before exam, I opened the book. I don't remember anything. I start crying. My parents told me to write the exam, but still I was little worried that I don't remember anything. When I was reading the book, after preparing so much also, day before exam, nothing was clear to me. It happens to everyone. It will happen to you also, and it will happen to best of the people. So whether you know it or you don't know it, go ahead and put your efforts and write your exam. ICI mostly plays with your confidence, because confidence will not come in this course, because some are the other places you will get stuck. And syllabus is huge. Because of the huge syllabus, it becomes very, very difficult for students. So whatever be the scenario, somehow you need that confidence factor. If that confidence factor is there, it will make a lot of difference in your exam writing. Because without confidence you write, you will thinking writing saying that anyway I'm not going to clear, I write, it is not going to help. At least have that confidence. Whatever be the paper in exam comes tough or easy doesn't make any difference. If it's a tough paper, evaluation becomes little lenient. This is something which ICI does. And if paper is very easy, they expect best out of you, evaluation becomes very tough. That time if it's an easy paper, don't get excited. Tough paper, don't worry about it, because both will get compensated by ICI in some form. Because they will anyway ensure if everybody is scoring lot of marks, it means the paper is easy. They will then give instruction saying tone down on the correction side. This does happen, that somewhere the marks would be at around an average level. It can't be so bad also, and it can't be so good also for student. So paper toughness may not make a big difference in your exam. So at that time, if you get a tough paper or an easy paper, don't worry about it. You can answer MCQ first or MCQ later, that's your wish. I normally advise MCQ first. Complete MCQ and have a rule of 1.5 minutes per mark. This is the rule I tell student. 1.5 minutes per mark, 150 minutes. Completing the paper is the logic, but obviously you will not do 1.5. It's a 10 mark question, 15 minutes. You may spend sometimes 16, 17, 18, but don't end up spending for a 10 mark question 40 minutes, because a consolidation question comes in exam and you end up spending 1 hour on that. ICI will give you only 14 marks, means only 14 will come. Just because you have spent 1 hour doesn't mean the number of marks can increase. So you will have to maximize your time. Many times, some questions students end up spending a lot of time. It does happen in accounting a lot. Questions like consolidation and all end up taking a lot of time, and people think I'll complete it, and you end up wasting a lot of time. So take a proper call on that. That how you manage your paper. I normally say 1.5 minutes per mark. These are the few pointers from my side. I'm so very confident because I know the kind of coverage I've done. I've also seen the participation you guys have done. So with the participation, I'm quite confident that this subject though easy 60. 60 is easy. If somebody is scoring 60, that is a known fact. What I want is more than 60 now. You have reached a stage where 60 is too easily coming in this subject. You can even go to a 70, you can even go to an 80, 85, but don't take any pressure on yourself. If you take pressure, it will become very difficult. Pressure is something I personally felt it the day before exam. Obviously, I had a good support. Family somehow convinced me to write the exam. I reached a stage where I was even thinking whether to write the paper, and I'm not creating the story. Many students think that I create the story. No, I did not create the story. This happened really with me the day before my last exam. The day before last exam. And I also believe that somewhere, if I keep doing my work, God will take care of it. So, somewhere have that belief. Some luck factor is obviously needed in a course like this. Everything will be taken care of. So, you keep praying good things, it will happen to you. But if from an exam point of view, you give your best, then rest will happen. So, first from your side, you try to give your best. Where we have reached now the slog overs, the last 10 overs of the cricket match. Now you have to go at a faster pace, do all the possible things. Slow pace will not work at this point of time. We are reaching the last 1 month. In the last 1 month, faster pace is needed. Day before exam, the pace has to be even faster at your end for preparation. But do complete preparation. Without complete preparation, if you go through, it will be difficult. And I wanted to experiment that only in this today's session, that whether I'm able to complete the entire AFM. I can complete it, I knew, but still I wanted to check whether I can complete the entire AFM in this number of hours which we have slotted. I had slotted 6 hours. We have already reached around 4.5 hours of effective classes, and I feel I will be able to almost close it. Some chapter here and there may get missed out, but almost will be able to close out. Clear? This is the point from an exam point of view. Some of you ask me for IBS strategy. I cannot give a separate IBS strategy and all. IBS, if you are aware of the subject, obviously it becomes easier for you to go through. And now one good thing which would have happened is, at least now you are aware of what are the things there in the subject. When you have gone through the classes, you are at least aware of what are the things which are there in the subject. So if something comes from AFM, it will 100% strike you. It will 100% strike you, and you know where it is there. ICA, obviously you will have to carry your ICA study mat and all that you have to carry, but you will know where it is from, and you'll be able to manage it in exam. So no separate strategy for IBS. There is an index which is given at the front for in the concept book, but the index may also not help much. It is not going to help much unless you in your mind know various things. And Obviously for IBS, I say study mat is critical. Whatever said and done, I copy paste study mat. I would have done some cutting here and there. I cannot exactly replicate everything, and suddenly ICMA from a remote place asks something. So it is possible. So SM is 100% to be carried for your IBS paper, and from there you will be able to manage my paper. You'll be able to manage, but more than AFM, I think you should be scared about the SCPM part, because that also comes for 15 to 20 marks in the exam. That comes for 15 marks in every IBS till now. That should be the worrying area rather than this area. So there you spend little bit of time to familiarize what is there. In case you're writing your group 2, familiarize more on SCPM and law rather than the other subject, because law and SCPM will become difficult, because in your exams, your whatever self-paced exam, you wouldn't have paid that much attention. You would have somehow managed it, but difficulty will come from your SCPM and law as far as IBS is concerned. Clear? Now I go back to subject. In case you have anything else to be told, let me know. Else I go back to and we start with Forex. Anything else you want to ask? Clear? Okay, let's get back now. Okay, we start with Forex chapter. Now in Forex, we started with a main understanding called as price currency and product currency. Price currency refers to the first currency in the quote. Product currency refers to the second currency in the quote. For every transaction, all our action will always happen with product currency. Appreciation, depreciation given, product currency. Buying, selling, product currency. Banker buying and selling, product currency. All transactions will normally happen only with the product currency. Product currency is rupees per apple. Apple is the product. Apple is the product. So rate at which two currencies are exchanged. Price is the first currency in the quote. Product is the second currency in the quote. INR in case of INR per USD. USD in case of INR per USD. Then have direct quote and indirect quote. Direct quote is the one which comes first in the quotation. Indirect quote is, sorry, home currency comes first in the quotation. Foreign currency comes second. In a direct quote, INR per US dollar, INR per GBP, INR per Japanese yen. Direct first, indirect second. Indirect quote is, sorry, home first and foreign second. In an indirect quote, foreign will come first and home will come second. Foreign will come first and home will come second. Two-way quote. What is a two-way quote? Is banker is openly telling what profit he is generating. What is the profit he is generating is the difference between the bid rate and the ask rate. Bid rate refers to the rate at which bank buys the product currency. Bank buys the product currency. Ask rate refers to the rate at which bank sells the product currency. The gap between them is the profit of the bank, called a spread. The average is called middle rate, and the spread can be a percentage of bid rate, can be a percentage of ask rate. In a two-way quote, when I give a two-way quote, if the number after the decimal in the quote is called pips, 67.20 pips is 20, 67.2, 67.8 pips is 20 and 80. If the number before the decimal is same, when I give a two-way quote, I don't repeat the number before the decimal. I don't repeat the number before the decimal. So 67.2, 67.8 will be written as 67.2 -80, 80. If the pips number also same, that is also not repeated. What is that? 12.315, 370. 315 is the pip, 370. 33 is same. Don't repeat 3. So 12.315 -70. 70 will mean the last two decimal. 7 if they give last decimal. 7 is the last decimal. Direct quote 50 per USD. Do inverse of that, you will get the indirect quote. Inverse will give you the indirect quote. But if you have a bid and ask rate, for the bid rate you have to take the inverse of the ask rate, and for ask rate you have to take inverse of the bid rate. For this, inverse of ask, and for ask you have to take inverse of the bid. Quotes interpretation. Practical world, the quotes USD/INR would mean INR per USD. Most of the question it will mean USD per INR. So here what we do is, an understanding of the practical world will help me in interpreting the quote. How do I understand and interpret it? The order is Japanese yen, INR, New Zealand dollar, Australian dollar, Canadian dollar, Singapore dollar, USD, Euro, CHF and GBP. If the given number is greater than 1, cheaper currency first, costlier currency second. If the number is less than 1, costlier currency first, cheaper currency second. Cross rate. What is cross rate is, I know INR per USD 80, I know INR per GBP 100, I mix them together and get USD per GBP. I mix them together and get USD per GBP. So or GBP per USD, whatever I want. So GBP per USD is equal to GBP by INR into INR by USD. This is directly available. GBP per INR is not available. So 1 by. If the question says likely rate of one currency, whichever rate of means rate of Apple, rate of something. So likely rate of yen means yen is the product currency. Likely rate of INR is the product currency. So likely rate of INR against USD means INR is the product currency, USD is the price currency. These are the steps we follow to solve any type of a problem in this Forex chapter. First, find out the known currency and the unknown currency. Known currency means you know the number. Unknown currency means amount is not known. Unknown currency left hand side, known currency right hand side into unknown currency by known currency. Known currency got cancelled. And then you see what is the denominator currency. What are we doing with the denominator currency? What is the bank doing with the denominator currency? Bank is buying it, bid rate. Bank is selling it, ask rate. And thereafter you complete the calculation. You can expand the formula by doing A by B into B by C into C by D. All that you can do and then expand the answer. Exchange margin is the extra profit of the bank. Bank is saying, I want to earn more money. I want to earn more money. He is going to earn this money with the difference of ask rate and bid rate. How can he earn extra money? By increasing the ask rate and reducing the bid rate. Increasing the ask rate and reducing the bid rate. Exchange margin is subtracted from the bid rate, reduction in bid rate, added to the ask rate, increase in ask rate. We have two types of rate, merchant rate and interbank rate. Merchant rate means rate for the ultimate customer. Interbank plus or minus exchange margin. Interbank rate is between the two banks. How do I calculate this EM? EM, please get the final rate and apply it on the final rate. Apply it on the final rate only once. In case the question says it's a triangular arbitrage or you do bank A and then you go to bank B, then in the individual quotes apply it. In the individual quotes apply it. And if the question says it is some paise or something, apply that paise in the final quote. Only apply it on the final quote. EM on buying rate and EM on selling rate. Buying rate means we will understand as bankers buying rate. Selling rate means bankers selling rate. We did this in one of the question. EM application on bid INR per USD. If you are doing it on bid INR per USD, they give INR per USD, just subtract it. But if you are using USD per INR, it will be 1 by ask. Ask is the denominator. And in the denominator, ask rate is there, add. In the ask rate, add it. In the bid rate, deduct it. In the ask rate, add it. In the bid rate, deduct it. Cover transaction or squaring up of transaction. Cover transaction means doing opposite of the original transaction. Doing opposite of the original transaction. If you have bought something in the current transaction 1, you have to sell it in the transaction 2. In this process, I'll have to calculate the sale proceeds, compare with the purchase cost, and calculate the profit or loss. If the profit or loss is in INR, great. If it's a non-INR, we have to take efforts to convert this. We have to take efforts to convert this into INR currency. We have to take efforts to convert this into INR currency. Profit or losses in non-INR currency, take efforts to convert this into INR currency. Should be converted into INR if the question has information to convert the loss into INR. In case of loss, you'll have to buy the foreign currency, and in case of profit, you'll have to sell the foreign currency. How this bid and ask rate is determined? When one banker is dealing with another bank. When one bank is dealing with another bank, what we are going to do is very simple. We'll see who is the initiating bank and who is the other bank. Initiating bank is like the bank customer and the other bank is the real banker. So if the initiating bank is buying, we'll say what is the initiating bank doing? What is the other bank doing? What is the other bank doing? And the rate will be determined based on the other bank, based on the other bank. Return in foreign currency, our formula of 1 plus MDR is equal to 1 plus RDR into 1 plus inflation. Same logic, 1 plus home currency return or 1 plus INR return is equal to 1 plus USD return into, if USD is there, appreciation of USD. This side you write USD and this side you write INR. 1 plus USD return is equal to 1 plus INR return into 1 plus appreciation of INR minus depreciation of INR. Appreciation of INR or depreciation of INR. Depreciation means minus. In case you have a bid and ask rate in the question, this formula and all will not be applicable. You have to convert all the data into a single currency, and after you convert this into a single currency, you'll have to compute return. You'll have to convert this into a single currency and compute after that the return. This single currency can be INR or the single currency can be USD. what I get back minus what I give divided by what I give into 100. Swap points. What is swap points? Is difference between the bid rate, difference between the spot rate and the forward rate. Difference between the spot rate and the forward rate. This difference question can say 1525. First 1525 means last two decimal of the code. 1525 means last two decimal of the code. If 15/25 ascending order, add it to the spot rate. 2515 descending order, deduct it from the spot rate. Swap premium. Swap premium but in descending order. Swap premium. Premium means you have to only add. Premium only you have to add. Appreciation or depreciation calculation. Formula is NAV1 minus NAV0 by NAV0 into 12 by M into 100. What is NAV1? Forward rate minus spot rate by spot rate into 12 by M into 100. For which currency? Product currency. You want for price currency? Convert the code. Convert the code and then apply the formula. Convert the code. For what I have to do? One for bid rate, one for ask rate. One for bid rate and one for ask rate. In this also, if the computed number is positive, appreciation, and negative, depreciation. If it's positive, appreciation, negative, depreciation. And if the question says calculate on average rate means in the denominator, average of the two numerator which you write, FR and SR, average of the two numerator which we are writing, which is FR and SR. Forward rate calculation using premium percentage. Question will say there's a premium of 10%, 5%, some number is given. First check whether it is for product currency. If it's for product currency, add premium to the spot rate, deduct discount from the spot rate. Add premium to the spot rate, deduct premium from the spot rate. If it's for the price currency, convert the quote. Product currency becomes price currency becomes product currency. Now you apply and then reconvert if you want. If the question says 6-month premium is 3%, 3% means for the 6-month period directly 3%. If they say 3% per annum, per annum, then you'll have to do into 6 by 12 and then do the calculation. Interest rate, 6-month interest rate 3% can still be understood as per annum in the practical world, but premium, if they use the word per annum, it is yearly. If they don't use the word per annum, it is for that specific period. Swap points for broken period. What is broken period is the question gave for 1 month, question gave for 3 months, and they're asking for 2.5 months. Interpolation technique. I'll follow the interpolation technique. Difference in left hand side, difference in right hand side, target difference in left hand side, increase in value, old value plus the increase will give me the new value. IRPT can help me in forecasting the exchange rate. 1 plus RH by 1 plus RF equal to F1 by E0. RH means price currency. RH means price currency. RF means product currency. This will ensure when I do international financial management, you don't have any confusion. Price currency and product currency. And if you are doing a 6-month calculation, RH and RF would be for the 6-month period. If you are doing an annual calculation, annual rate. 3-month calculation, 3-month interest rate. Same, okay, with the IRPT, there is a link with the interest rate. What is the link with the interest rate? Is high interest rate in a country will lead to depreciation of the currency of that country. Will lead to depreciation of the currency of that country. And implied differential interest rate is equal to appreciation or depreciation of any of the currency, ideally product currency, because product currency easy to calculate. Price currency I have to convert and calculate. So appreciation or depreciation of the product currency. If product currency is appreciating, it means it has lower interest rate, and product currency is depreciating, it means it has higher interest rate. Same with PPT, 1 plus IH by 1 plus IF is equal to F1 by E0. IH is price currency inflation, IF is product currency inflation. Price currency inflation and product currency inflation. IH and IF should be for the period we compute the forward rate. Same as the IRPT logic. Space arbitrage. What is space arbitrage? Arbitrage means making profit without taking risk. I buy in one bank, sell it in another bank, buy at the lowest ask rate, sell it at the highest bid rate, and see if you can make money. Buy it at the lowest ask rate, sell it at the highest bid rate, and see if we can make money. In case there is a direct and indirect quote given in the question, convert one of them. So you get 2 direct quotes or 2 indirect quote, which means either I get INR per USD, INR per USD, or USD per INR, USD per INR. Once it becomes common, buy it at the lowest ask rate, sell it at the highest bid rate. When you do a formula, sometimes you will be using bid as 1 by ask. If you are using ask in the calculation, anywhere you use ask in the calculation, 1 by ask or whatever it is, it can be 1 by ask. Wherever you ask, lowest ask rate. If multiple options are there, lowest ask rate, and if multiple options are there, highest bid rate. Multiple options there, it could be 1 by bid, 1 by ask, or direct bid, direct ask, doesn't matter. If you're using bid rate anywhere, it is lowest bid rate, sorry, highest bid rate, and it is ask rate, lowest ask rate. Covered interest rate arbitrage. What is covered interest rate arbitrage? The question has given me the spot rate and given me an actual forward rate. Given me an actual forward rate. I'll first calculate the fair forward rate using the IRPT. After I calculate the fair forward rate, if the actual forward rate is greater than fair forward rate, market is giving lot of value to the product currency. Market is giving lot of value to the product currency. Invest in product currency. Just remember this alone. Invest in product currency, which means borrow in price currency. Other situation exact opposite. Other situation is exact opposite. These are the steps. You decide where you want to borrow, then convert into other currency, invest, take a forward cover, redeem, convert, repay the loan, and you'll be left with some arbitrage gain. Covered interest rate arbitrage, if you have a two-way quote. What is two-way quote? Is there is a bid rate and a ask rate. In this case, FFR and AFR comparison cannot be done. Trial and error method. What is trial? Option 1, borrow in price currency, invest in product currency. Option 2, borrow in product currency, invest in price currency. Triangular arbitrage. What is triangular arbitrage? You give three currencies. So there will be a starting currency. You decide what is the starting currency. If US dollar is the starting, USD to INR, INR to GBP, GBP back to USD. One this side, one reverse side. USD to GBP to INR to USD, which is giving you profit. Which is giving you profit. In this case, if there is an exchange margin, in every conversion exchange margin has to be charged. In every conversion, exchange margin is to be charged. Two routes are there. One of them will give you arbitrage gain if it's a one-way quote. If two-way quote is there, both may give loss or one may give profit. So you do first route, profit, stop it. That's all. First route, profit, stop it. Second route is not needed. If luck factor is there in the first route itself, you get profit, it ends there. Forex risk management technique. We have multiple risk management technique. We first start with currency invoicing. What is currency invoicing? Is go for home currency invoicing for export, go for home currency invoicing for import, no forex risk. INR billing, there is zero forex risk. In case I am not able to do this, or I want to do some speculation, in that case, if there is a liability, depreciating currency, and if there is an asset, appreciating currency. If you give me multiple option and all are appreciating and I have to import something, least appreciation. All are appreciating, I'm export maximum appreciation. All are depreciating in export, go with the least depreciation. Other side, go with the highest depreciation. Currency invoicing, when you convert the value from one currency to another currency, when this conversion is happening, you can use bid rate, you can use ask rate. I will say you go ahead and use whichever is favorable for you, but that also not guaranteed. Okay, that also not guaranteed, but you can go ahead and use whichever is favorable and write a note. And if time permits, then do both also, saying that I can use this rate or I can use the other rate. The next part is your leading and lagging. What leading and lagging says is lead means make the payment immediately or collect the payment immediately. Lag means make the payment as per the original due date. Because if you're making the payment immediately or collecting the money immediately, you get the money. This can be invested or this can be used to close some loan. So some interest implication will be there. Some interest implication will be there in the lead scenario. Lag scenario, no interest implication. So from the lead scenario, I take it to the lag scenario by adding interest at the borrowing rate if there is a deficit of money, at the investment rate if there is a surplus money. In the leading and lagging, there was one question where I had to do a letter of credit instrument. What does a letter of credit do is I'm deciding whether to take a loan in India or take a loan in a foreign bank. If you take loan in India, Indian loan, higher interest, 19% interest was there in that question. Indian loan, pay higher interest. Other option is take a foreign loan, pay lower interest, but it's in the foreign currency. Foreign loan. But that foreign bank is saying, if you want that loan, give me a letter of credit today. today. A letter of credit is a guarantee from my Indian bank saying that this company will make the payment. If they don't make the payment, we will make payment on their behalf. So because of this guarantee given by the bank will charge me LC commission. This LC commission is paid on day 0. I take it to day 180 by adding interest on LC commission, and I have to pay the foreign currency loan along with interest at the forward rate. Along with interest at the forward rate. Netting refers to the process where dues receivable are netted off against dues payable and the net amount is settled. Two types of netting is there. First is bilateral netting, two parties, one-to-one cancellation. Then multilateral netting involves more than two parties applied after the bilateral netting is done. Netting can also be done in cash management. In cash management, I can have a centralized cash management or I can have an independent cash management. Centralized means you net off the amount today, make one investment. Independent means everyone make their own investment. In the end, I pull them together and do netting. I pull them together and do netting. Both can have finally different number at the end, different number. The gap is the benefit of netting. If you centralize management gives you more money, decentralized gives you less money. The benefit of netting is difference in option 1 versus the difference in option 2. Forward contract is a contract to buy a specific currency or a specific product at a specified rate at a future date. The forward contract is same as a futures contract, but futures contract has those 2-3 challenges: contract in decimal, basis risk. Forward doesn't have all of this. I will enter into a forward contract if I feel my outflow under forward contract is going to be lower, inflow under forward contract is going to be higher. Now there is a cover rate which I calculate in a forward contract. What is cover rate is hedging rate which I pay in case of a payable, premium which I pay, interest on premium which I pay. In case of a receivable, hedging rate is my inflow, premium is my outflow. So one inflow, two outflows. So outflows I do put it as minus, and inflow I put it as plus. In case of payable, all are outflow. All are outflow. So you can write all minus or all plus. Doesn't make any difference. Once you get the cover rate, you will do a post-mortem comparison. That is, once the 6 months got over or 9 months got over, we compare what has happened versus what could have happened. If I collected 20 lakh in forward contract and in spot I could have collected 21, I feel I made a loss. I feel I made a loss. If I paid 20 lakh in forward contract, in the no hedge scenario, I could have paid 22. Then I feel I made a profit because I paid 20, whereas 22 could have been paid. Don't remember the formula. What happened versus what could have happened. What happened versus what could have happened. Expected loss. What is expected losses? When I'm entering into a forward contract, that date itself, somebody told me that forward contract you enter or you don't enter, loss is going to be there. So expected losses if you hedge. What is my cash flow at the build rate compared with the cash flow at the hedged rate? If I go by the build rate, I have to pay 20 lakh. If I go by the hedging rate, I have to pay 25 lakh. So 5 lakh losses expected. This is if you hedge. No hedge means again compare cash flow at the build rate versus the cash flow if the hedging is not done at an expected spot rate. You are expecting something. You are expecting something. In this scenario also there is going to be a loss. In this scenario also there is going to be a loss. A closure of a forward contract or a fate of a forward contract, there are three things which can happen. It can be honored, it can be cancelled, it can be extended. Honor can happen on due date, after due date, before due date. Same with cancellation, same way with extension. If you honor on due date, no extra calculation, no extra calculation. If you do honor before due date or honor, cancel and extension after due date, these will involve extra calculation. These will involve extra calculation, and any question if interest rate is given, it may involve extra calculation. Other than honor on due date, all will involve cancellation. How will I do that? Using this format: date, that is entry date, position, action, execution date, and rate. I enter into a first contract, transaction 1, then there is a transaction 2 to cancel the contract, then there's a transaction 3 which is a new contract, could be a spot. 1 and 2 no effective rate calculation. 1 and 2 comparison is cancellation gain or loss. 2 and 3 comparison is effective gain or loss. 1 and 2 cancellation gain or loss. 2 and 3 effective gain or loss. If you do not have the third transaction, only cancellation gain or loss. Only cancellation gain or loss. Third transaction will come if you're planning to honor it or extend it. If you're planning to honor it or extend it, third transaction will come. Otherwise, only 1 and 2 transaction. The gap between 1 and 2 is cancellation, gain or loss. Automatically, it will tell. Formula, the plus and minus you write. Outflows, write it as minus. Inflows, write it as plus. Buy means ask rate. Sell means bid rate. All that rules you have to follow. Once I calculate this, I said these are the items. Original position, buy if we are buying the product currency, sell if we are selling the product currency. Opposite position, opposite of the original position. That is, you press the buy button, now press the sell button. Reference date, this is the execution date. Rate, positive if it is sell position, negative if it is buy position. Flat cancellation charges can be an extra charge which the banker may charge on top of the cancellation. Now, what are the losses I calculate? Two losses. Cancellation gain or loss, comparison of original rate and the opposite rate. And effective gain or loss, don't see this. Effective rate is row 2 and row 3. Row 2 and row 3. What is row 2? Row 2 is your second cancellation opposite rate, and row 3 is the new rate. Row 3 is the new rate. Customer did not come on due date. FEDI rule says that as a bank, first, if customer gives you a contract for Jan 1 to March 31, you also take a contract for Jan 1 to March 31. I followed whatever the banker told me to do. After following this, on March 31, customer is not seen. And I call him, he says 3 days grace period is there, you please wait. This 3 days grace period forces me to cancel my original contract, which is row 1 with a row 2, and enter into a new contract. This is banker analysis. This is banker analysis. In the banker, once this analysis is done, banker will have two. One is cancellation loss, effective loss. Cancellation loss, banker doesn't disturb me. Effective loss, I have to pay to the banker. But on the cancellation loss, interest will be charged. On the cancellation loss, interest is going to be charged by the bank. Interest is going to be charged by the bank on the cancellation loss, which is going to happen. Then I do my analysis. In my analysis, I will have a cancellation gain or loss. So I have to pay my cancellation loss, banker's effective loss, interest on banker's loss, interest on banker's cancellation loss, interest for 3-day period, interest for 3-day period. When is the contract cancelled in case of no instruction? We saw a problem where April 4 was there, in between 7 was there, 14 was there. 3 days. In 3 days, automatic cancellation. So interest is calculated only for 3 days. Interest is calculated. After all these charges are calculated, if you say honor, I'll say yes, let's do a spot honor. If you say new contract, I'll give a new contract. All this is later analysis. First, you have to pay this amount. Honor before due date. If you're honoring before due date, it is a surprise to the banker. It is a surprise to the banker because you suddenly came and said you want to honor the commitment. Again, 3 transactions. Just understand. Row 1 is the original contract. Row 2 is the opposite contract. And row 3 is your new contract. New contract. First, original is there. You'll have to cancel the contract, and new will be a spot. New will be a spot. Now, final realization of the customer or payment of the customer is row 1. First, the execution happens at row 1. Understand, execution happens at row 1. Whether it happens, not happens, doesn't matter. Execution happens at row 1. On top of it, row 2 and row 3 difference. On top of it, row 2 and row 3 difference, which is the swap loss of the customer. And between row 1 and row 3 difference, interest will have to be paid or received from the bank. Interest will have to be paid or received. Row 1 and row 3 difference. Between row 1 and row 3 difference, interest will have to be paid or received from the bank. Don't understand anything else, just understand this way. Row 1 execution, 2 and 3 is cancellation gain or effective gain or loss, and 1 and 3 comparison. 1 and 3 comparison will give you interest inflow or outflow. Lead and lag with an early honor. If there is an early honor, I get the money immediately. Once I get this money immediately, I say that I want to do an early honor. I got INR. I deposit this or repay the loan and reduce my expense or increase my income. So whatever you receive early, get that amount and add interest income or interest saving. Add interest income or interest saving from the early date to the final date. From the early date to the final date. Then if you are saying you don't want to do this, then do honor as per the original date. But when you do honor as per the original due date, the money would have come to you. This you could deposit somewhere. This you could deposit somewhere. On the US dollar deposit, you may earn some interest. So original $1 lakh at the forward rate, and extra what you are earning, whatever you are earning extra, that you take another forward contract and realize it. Together you calculate and see which is better. See which is better. Time value and currency fluctuation component. What is time value of money component? Is any cash discount given to me because of early payment. Any cash discount given to me because of early payment. Amount of discount which I get into the exchange rate. And any difference in the two exchange rate into the payment I do is called currency fluctuation component. Time value of money component and currency. Time value of 2 by 10 net 90 something, let's say 2% discount if you make the payment in 10 days. The 2% discount is time value money component. If you pay later 56, if you pay today 55, that 1 rupee is the currency fluctuation component. Decision based on average contribution to sales ratio. Contribution to sales ratio, you know the formula and all. Here they will say you prepare an income statement if you hedge all currency. Prepare another income statement if you don't hedge all currency. Calculate contribution to sales ratio. If approach 1 has better contribution to sales ratio, hedge everything. Approach 2 has better, don't hedge everything. But it's not a selective call. You'll have to do everything together or everything no hedge. No selective 1-1 call. Okay. This I told you to leave. Money market hedges preparing a balance sheet. In the balance sheet, first find out, do you have a foreign currency asset or a foreign currency liability? For example, I have a debtor of USD 1 lakh. Against this debtor, I will take a loan of USD 97 today. How do I take the loan? Principal plus the interest on loan is equal to 1 lakh. Principal plus the interest on loan equal to 1 lakh. I calculate the principal value, convert this into my currency and earn income on this. This and this will get squared off on the last day, and my deposit will get redeemed along with interest. Deposit will get redeemed along with interest. Same way, if you have a creditor, then against this you have to create a deposit. Against this you have to create a deposit. How do you create the deposit? Deposit amount plus the interest is equal to this. And how to create the deposit? I have to take a loan. I have to take a loan. Be a little cautious when you do import analysis, because you may think that you have the money in hand. You don't have the money in hand. You have to buy that money and then create the deposit. Then create the deposit. We have two types of exposure: transaction exposure and operating exposure. Transaction exposure is variation in profit due to changes in exchange rate. Operating exposure, variation profit due to all factors other than exchange rate. So first I just change the exchange rate, 80 become 82. What is the variation? Then I change selling price, I change cost price, I change number of units, and see what is the variation in profit. Price elasticity of demand basically says that if there is an increase in price, demand will go down. If there's a decrease in price, demand will go up. If elasticity is more than 1, it will have a magnifying effect. If price changes by 2% and your elasticity is 1.5 times, demand will change by 1.5 into 2. 1.5 into 2. We have three types of bank accounts: Nostro account, Vostro account, and Loro account. Nostro is your account with, our account with you. Vostro is your account with us, and Loro is an interim account which I create for doing a third party transfer or third bank transfer. Exchange position versus cash position analysis is only from a banker point of view. This is not a currency account, it is a raw material account. It is a raw material account. Cash position, raw material came into the company, recorded. Raw material went out of the company, recorded. Exchange position, record whether raw material comes in or not comes in. If you have purchased the raw material, record purchase. If you have sold the raw material, record the sale. Purchase, record the purchase. Sold the raw material, record the sale. Whereas in cash position, what I have to do is I can record it only when the whatever you purchased came inside and whatever you sold went outside. These are the transaction in purchase: purchase of bill, cancellation of DD, spot purchase, DD purchase, purchase of check. All these are purchase in exchange position. Sale, so many transactions: forward sale, cancellation of DD, remittance. Some of this, like spot purchase, will also come in the other book. It will also come in the other book, because in the other book, if money is coming, if the raw material is coming in, raw material is going out, I'll record. So there, spot purchase, spot sale, earlier forward purchase settlement, earlier bill purchase settlement, all this will get recorded. Now question will say, I want a specific balance. When you want a specific balance, first you will have to do the cash position, then you have to do the exchange position. Cash position can be changed by spot purchase or sale. When you do this, exchange position will also change. Exchange position will also change. So first change the cash position value, then do the exchange position value, and for exchange position final number you want, do forward purchase or sale. Do forward. Spot will impact both. Forward will impact only exchange. Forward will impact only exchange. Currency futures. First, the format for number of contract, write the amount of exposure in one currency, write it in the second currency, which you are dividing check, and whatever currency is the size of one contract. Importer does not mean buy, exporter does not mean sell. Look at the exposure. If exposure is 10 lakh dollar and you're dividing by 1 lakh dollar, see what are you doing with dollar. If exposure is 10 lakh dollar, you're converting into 5 lakh GBP and dividing by 1 lakh GBP. See what are you doing with GBP, what you are doing with GBP, what you're doing with product currency, what you're doing with product currency. So just check that and then decide pay, then decide number of contracts, then decide the number of contract. After you decide the number of contract, you put it on a usual format, buy button and sell button, date, spot rate, futures rate, one buy button, one sell button, net settlement will happen. Net settlement will happen, and after that net settled amount, original amount, both put together at the spot rate. Both put together at the spot rate. The realization will ultimately happen only at the spot rate. So finally, what is my realization here is, in case of futures, payment at spot rate, which is a receipt at spot rate, net settlement, and in case any margin money is there, interest on margin money, interest on margin money. What do I decide, buy or sell? All depends on product currency. Don't look at import or export and decide. Just see what is being done with the product currency. What is being done with the product currency? Which contract do I take for hedging? If you want March 31, take March 31, exact date if available. If exact date is not available, I wanted it for March 15, you give me three options: March 10, March 31, April 30. March 10 cannot be used because by March 15 it has expired. So I will go with March 31, closest available live contract. Closest available live contract. Next comes, what option do I take? Call option or put option? Again, see what are you doing with the product currency. If you're buying the product currency, call option. If you're selling the product currency, put option. Don't look at import or export. And what is in a call option? I will have outflow. In a put option, I'll have minimum inflow. Inflow can be more also. Minimum inflow, maximum outflow. Outflow is strike rate outflow, call premium outflow, interest on call premium outflow. All the outflows are added. Strike rate inflow, put premium outflow, interest on put premium outflow. So I net off the amount and write it. Why do we take interest on premium? Because premium is paid on day zero. Settlement happens on the maturity date. So in this gap, I have to consider interest to give effect to time value of money. What interest rate? Deficit, you take a borrowing rate. Surplus, take the investment rate. Ignore if no information is given in the question. Total outflow in an Forex option. Multiple things will happen. One is premium. Second is interest on premium. If the contract is in decimal, then there will be a hedged component which will happen at the strike rate. Unhedged component, this will happen if the contract is in decimal, can be paid at forward rate or the future actual spot rate given in the question. Unhedged at the actual spot rate given in the question. Most beneficial investment currency. What is most beneficial investment currency is, if there are multiple options, I make investments in those currencies and I convert back the money to the original currency in which the money was available. We saw a problem where USD 5 lakh was there. We invested in USD, Euro, GBP, return this 5 lakh along with the interest. Leftover is the profit, and this profit convert to a common currency given in the question. The common currency is the one which is making the investment. Which country is making the investment? We saw a problem where Australia, Sydney branch was making, so Australian dollar. London branch was making GBP. Final profit will be calculated to the nearest pound. I did all this calculation. I got same gain in two currency. Not in this question, but some other question. Same gain in two currency. If you get same gain, indifferent from return point of view, but from a risk angle, I'll prefer investing in fixed income security as compared to making investment in equity. Investment in a fixed income security as compared to what? Making investment in equity. Spot rate, if they give it like this, 1.998 plus or minus 0.002, bid rate deducted, ask rate added. And last point we had is exchange exposure risk. What is exchange exposure risk? Is I anticipated that I'll collect money at some rate. In reality, it can be higher or lower. So realization using the actual spot rate and compared with realization using the expected spot rate or forward rate, the gap is called as your profit or loss. The gap is called as your profit or loss. Clear? Any doubts in this? This area is in fact lesser than your derivatives, but in the revision I took more time for forex and less time for derivative because of the main challenge was bid and ask. Main challenge here is bid and ask, division, multiplication. If you have clarity on that, you'll be in a position to manage this easily. Clear? I'll take a 5-minute break. After break, we will do international financial management. I'll also do business valuation. IRRM, I have a doubt whether I'll be able to do it. If not, then you see the earlier video. Okay, 5 minutes break. Okay, I move to international financial management, a relatively easier area, very limited information is there. It has 3 4 issues which we need to tackle. First issue is some cash flows could be given in INR currency and some could be given in non INR currency. If all cash flows are in one currency, no problem. If some are in INR, some are in non INR, use interest rate parity theory or purchasing power parity theory, forecast the exchange rate and convert the rates. When you are doing this forecasting, RHS price currency, RFS product currency. In international capital budgeting, we have a home currency and a foreign currency. Home currency refers to the country which is making the investment. Foreign currency refers to the country where the investment is being made. Foreign currency are host currency. Foreign currency are host currency. If the question gives you some discount rate, please take it as home currency discount rate. Take it as home currency discount rate. That's the assumption we will follow. Home currency discount rate. And rule is if you have INR cash flow, discount at INR discount rate. If you have non-INR cash flow, discount at non-INR discount rate. So how do I convert one discount rate to another discount rate? 1 plus MDR is equal to 1 plus RDR into 1 plus inflation. Same logic. 1 plus risky rate is equal to 1 plus risk free rate into 1 plus risk premium. Calculate the risk premium using one currency. The same risk premium will work in the other currency also. The same risk premium is going to work in the other currency as well. Issue 3, withholding tax. What is withholding tax? Is extra expenditure which can reduce the inflow of the project. If they just say withholding tax, reduce it from PV of cash inflow. If they say withholding tax is not eligible and eligible for tax credit and they give income statement, not eligible for tax credit, reduce it from PAT. This will reduce my CF80 number. Eligible for tax credit, reduce it from PBT, profit before tax, reduce it from PBT number, and after reducing it from PBT number, this withholding tax is reduced from the normal tax and lower normal tax, and ultimately this has no impact. If it's eligible for tax credit, no impact. What should be the rate? Lower of DTAA rate and the applicable tax rate. Lower of DTAA rate and the applicable tax rate is to be used. Just give me. Lower of DTAA and the applicable tax rate. If there are any exchange conversion of NPV of one currency to another currency, if you calculate NPV in one currency into the spot rate is the NPV of the other currency. If there are any exchange restriction, no exchange restriction, no problem. If there are restriction, whatever is repatriated to India will only become the inflow of the project. Non-repatriated amount will be invested. On that you may earn something, and all of this together along with the last year inflow will come back, and there can be a withholding tax on both of it. And if there is any salvage value or recapture of working capital, no withholding tax on that. Average loan maturity, this is a shortcut to calculate the interest cost. It's just a shortcut to calculate the interest cost, which is similar to average due date concept. Total interest expense of a loan is equal to loan amount into the average loan maturity into the interest rate of interest. Rather than doing 1 2 year calculation, directly we use the formula and calculate the overall interest for a 5-year period using the average loan life or average loan maturity. When we do our asset beta and equity beta, debt beta uses debt into 1 minus tax rate. Here we have two countries and the tax rate can be different for both the country. So in this case, take the tax rate of the country from where the loan is taken. Take the tax rate of the country from where the loan is taken for the purpose of computing, the equity beta. Clear? It's a very simple topic. Just took me 5 minutes to revise this. This is a very simple area. Just understand the crux alone. Only 3 points. The first point is some cash flows can be in INR, some can be non-INR. You'll have to convert into a common currency using IRPT or PPT. Second is what discount rate? INR cash flow, INR discount rate, non-INR cash flow, non-INR discount rate. And the third part is to convert this discount rate 1 plus risky rate is equal to 1 plus risk free rate into 1 plus risk premium. And okay, a third issue is withholding tax, eligible for tax credit, not eligible for tax credit, eligible for tax credit, charge it on PBT, not an expense, not eligible for tax credit, charge it on PAT and it becomes an expense. Any doubts on this? The interest rate risk management part, you please see it on your own. You can see the charts or you can go through the earlier revision lectures which are of 2 hours. If you see that 2 hours concept video uploaded in YouTube, you may get clarity on even the problem based areas which we did not do. So instead of looking at the regular video for those problem based area, even if you see that video, you will get clarity. You still need more clarity, then go through the regular video. During the last day revision and all, you manage on your own because 2 hour video and all, you'll not be able to see interest rate risk management. So you see on your own. Now comes the last chapter which I want to revise, which is business valuation. This is a sub part of the security valuation topic. Security valuation focuses on equity valuation. This focuses on valuing the business as a whole or valuing the company. First, we learned here economic value added. What is economic value added? It is a measure of economic profit of an organization or real profit of an organization. It measures the company's performance and the effectiveness of the management. Effectiveness of the management. How much extra are we generating in excess of the capital employed, in excess of the capital employed. Now, how do I calculate EVA? Item 1 minus item 2. Item 1 is EBIT into 1 minus tax, or you can also call it as NOPAT, net operating profit after tax. Item 2 is invested capital into WACC. The rule says is that you can do revaluation of asset, liability, revaluation, replacement cost basis. So investment capital or capital employed should be based on economic value or replacement cost basis. EVA is the excess generation for 1 year. MVA is the excess generation for so many future years. So MVA is equal to market value of firm minus the book value of firm. In market value of firm, I'll have equity, debt, preference. Here equity and reserves. Equity and reserves. In book value separately reserves will be there. Market doesn't have a separate value for reserves. So reserves will come, book value of debt, book value of preference. Next, EVA dividend. What is EVA dividend? Is EVA refers to the excess generation by a business. This is something which I can freely give to the shareholder. Normally, when we give dividend, share price goes down by the amount of dividend. EVA dividend, if you pay, no impact on share price. If you don't pay, share price will go up. Share price will go up by the amount of EVA dividend. Share price will go up by the amount of EVA dividend per share. WACC calculation. For WACC, I need cost of equity, which you can either calculate using Gordon's model or CAPM model are given in question. Cost of debt, interest rate into 1 minus tax or interest into 1 minus tax by value of debt. If they give some cost of debt, it can be pre-tax, post-tax, pre-tax into 1 minus tax rate, post-tax directly use it. Then put it in the format source, cost, weight, product, and here my WACC sum of product by sum of weights. Be little cautious if they use the word debt by equity, debt by asset. If they say debt equity, debt is 1, equity is 1, overall is 2. And if they say debt by asset is 0.2, debt is 0.2, equity is 0.8. If they say debt by equity, debt is 0.2, equity is 1. Equity is 1. If the cost of debt is given in the question, if they give clarity that it is pre-tax, post-tax, no problem. But if clarity is not there, I can assume. But before making assumption, let's just do a small calculation. What is the calculation? Interest by debt. Compute interest by debt. If the computed number is closer to the value given in the question, it is pre-tax cost of debt. If it's not closer, it is post-tax cost of debt. Logic is very simple. If interest paid by the amount of debt is matching with debt given in the question, that is a pre-tax cost of debt. P multiple of any company should be equal to P multiple of the industry. But if you carry more risk, if you carry less risk, you can have a higher P multiple or a lower P multiple. One way of measuring the risk is debt by equity ratio or debt by assets ratio, debt by equity ratio or debt by assets ratio. High debt equity, low risk, high debt equity, high risk, low P multiple, low debt equity, low risk and high P multiple. This is an adjustment I can do it on the P multiple side. Then certain EVA adjustments are there. If advertising is there, R&D is there, staff training is there, all these are treated as asset and not as an expense. So add it in the EBIT number, add it to the capital employed number, add it to the EBIT, add it to the capital employed. Depreciation, if you have, add back accounting depreciation, deduct economic depreciation for 1 year in EBIT calculation, last 10 years in capital employed, cumulative 10, 15, 20, whatever data, cumulative data for so many years in case of capital employed. If you have non-cash expense like provision for bad and doubtful debt, ignore it. It is ignored. So just add it back to profit, add it back to capital employed. Tax charge, if there's any tax which is given in the question, please add back that, because it will have a current tax and a deferred tax. What you need to deduct is only cash taxes paid. There one more challenge is there. What I really pay as tax is on the lower side because of interest. Interest is a tax deductible item. So what concept says is, interest cannot be subtracted, then how can tax on interest be considered? So when I do the calculation, I can either do EBIT into 1 minus tax rate, or EBIT minus the cash taxes minus the tax saving lost on interest, or you can go to PAT plus interest net of tax, PAT plus interest net of tax. All this will give same answer, but after doing all this, there can be a non-cash item or something where you have to take a call whether it is tax adjustable or not. We had a problem on bad debt, we just added this number finally without any tax adjustment, if a question gives you financial leverage is CA inter formula. If you remember that, you'll be able to calculate the EBIT. After calculating EBIT, then only I can do EVA. So financial leverage is equal to EBIT divided by EBT minus preference dividend divided by 1 minus tax rate. EVA is the excess value generated for my shareholder. So one way of valuing the company is today the capital employed plus present value of all future EVA. Present value of all future EVA is the value of the company. Now comes the valuation approach, where we have cash flow based approach, relative valuation, breakup valuation, the FMP based valuation, net assets method, earnings capitalization method. We'll go step by step. First is cash flow based valuation. This is already discussed at many places. We have two types of cash flow: FCFF, FCFE. FCFF belongs to all the shareholders, debenture holders, your preference shareholder, and FCFE belongs only to the equity shareholder. So when you calculate FCFF, ignore all cash flow between the company and debt guy, preference guy, equity guy. FC guy, ignore only between the company and the equity guy. Once you calculate FCFF, this is the preferred approach. In FCFF, discounted cost of capital, get value of firm. FCFE, discounted cost of equity, get value of equity. We will always prefer approach 1, get the value of firm, deduct the value of debt, get value of equity, deduct value of debt and get value of equity. But in some case, it is not possible to do, where WACC and all this cannot be calculated. I may do approach 2, which is FCFE approach. Now, this is type of cash flow I've already discussed. Two types of capex is there. One is called gross capex and second is net capex. Gross capex means increase in the gross block, which is written as addition in the fixed asset schedule. And net capex is addition adjusted for depreciation. So when I do my calculation of cash flow, I can add back depreciation and deduct gross capex, or just deduct net capex. Just deduct net capex. No need to calculate depreciation itself. Just find out the net increase in fixed asset and just deduct that. Just deduct that. If some questions say fixed asset figure will remain same in future, then capex is offset by depreciation. Capex is offset by depreciation. Working capital, increase in working capital is outflow, decreases inflow, but we'll have to be little cautious whenever there's a change in growth rate. Whenever there is a change in growth rate, I'll have to be little cautious about the working capital part. You cannot just keep adding numbers and do it. Initial outflow of an acquisition. When I'm doing an acquisition, This initial outflow, treat it like a capital budgeting problem. Treat it like a capital budgeting problem. So there will be an initial outflow. What is the initial outflow? Consideration paid in cash, other than cash, to all the liabilities. Could be to equity, could be to preference, could be to debenture, could be to creditor, could be dissolution expenses, everything paid minus sale value of all asset except fixed asset. Fixed asset you will continue and earn out of it. What will you sell? Debtor, inventory and cash, subtract that also. This is my initial outflow. This is my initial outflow. I earn something out of it. Terminal inflow, NPV positive, go ahead with acquisition. NPV negative, reject the acquisition. Breakup value approaches. Reliance Industries Limited, multiple businesses are there. Break the businesses into 2 3 parts, value every business using some appropriate approach and add up all the value together, and that becomes the value of the company. Relative valuation approach is commonly used method of valuation where I use the TCS data to value Infosys. I use industry data of IT companies to value TCS. So first find out what is the basis. Basis can be PAT, basis can be sales, basis can be EBITDA, basis can be book value, and you have to calculate a multiple. The multiple you'll have to check. Sometimes they may give MV to sales. MV to sales means sales into MV by sales is MV, but sometimes they may give sales by MV. Then you have to divide. Then you have to divide. So ensure what is the multiple given and accordingly do. It can be multiple. Some rare scenario it can be division as well. Whatever multiple is given, take the multiple, take an average for 3 4 companies and complete the valuation. If you have multiple approaches, value under all the approaches and take a simple average finally. FMP based valuation. FMP is future maintainable profit. Future maintainable profit. First calculate FMPBT. What is FMPBT? Is today's PAT, convert into PBT, add all extraordinary item which have happened. That is whatever should not have been subtracted. If you have subtracted, add back. Whatever should not have been considered in profit, deduct it. And till this, if you do, it is called profit from existing operation. Existing profit from old operation, and then add the profit from the new product. After PBT, get the PAT, divide by the capitalization rate. Divide by the capitalization rate. There's another alternative approach also. Get the FMPAT. From the FMPAT, deduct preference dividend. Get something called as EAES. Divide by number of equity share. Get EPS. Multiply with PE multiple and complete the valuation of share. Complete. This is valuation of the business. For share valuation, you will have to go ahead and deduct preference dividend and get the EAES, divide by number of equity share, get EPS, multiply with PE multiple, get the MPS number. Net assets method. This is nothing but NAV calculation. What is NAV calculation? Do asset adjustment, do liability adjustment, and divide by number of share. In this case, if there is a contingent liability, you take a call whether this contingent liability will crystallize into a real liability or not. Will crystallize into a real liability or not. Clear? Earnings capitalization method, which is nothing but this method only. FMP by capitalization rate is the value of the company. The capitalization rate could be given in the question, or you take inverse of P multiple. It is inverse of P multiple. Inverse of P multiple. Share price by EPS inverse. Share price. Why inverse of P multiple? At one place I had told you that inverse of P multiple can become cost of equity. Can become cost of equity. Value per share is value of the company divided by number of share. We saw one question where they said NCF and book value approach. NCF and book value approach with a floor value. With a floor value. What is NCF approach? Is cash flow divided by KE minus G. Book value approach, you know, share capital plus reserves minus fictitious asset. Once you get 2 3 valuation, minimum price will be asked. What is minimum price? Is lower of the two approaches. Maximum price is the formula in M&A. What is the formula in M&A? Is value post merger minus value before merger divided by number of share. And in all this, there is a floor price. Floor price is the current market price. Floor price is the current market price. Below that, no discussion. Below the floor price, there is no discussion at all. Impact of wrong WACC on valuation. The question would say that we have done the valuation, but we have used book value weight or maybe market value weight, and it is wrong. So first you have the value. From the value, you use the formula, you'll get wrong WACC. It's directly not cash flow by value of firm. There should be a growth rate adjustment also. There should be a growth rate adjustment as well in this calculation. That is, your W value is equal to cash flow by WACC minus growth rate. So ideally just add here plus growth rate, plus the growth rate should come in the formula cash flow by value of firm plus the growth rate, or D1 by P naught plus growth rate. This is the wrong WACC. From the wrong WACC, get the wrong weights. After you get the wrong weights, how will you get the wrong weights? Using the weighted average format, source, cost, weight, product. Alter the weights, get the correct weights, get the correct WACC, and get the correct value of firm. Get the correct WACC and get the correct value of firm. Earning value of a company and per share earning value. This is there in ICA material, not very logical. Earning value of company is enterprise value, EBITDA by capitalization rate. But per share earning value, nothing like this is there. You can just go through the concept day before exam. I have anyway mentioned not a logical item. Funding required for growth. Whenever an organization is growing, it will need extra funding. Normally, if the problem is silent, percentage increase in revenues is equal to percentage increase in fixed asset, and current liability. In short, percentage increase in capital employed, percentage increase in capital, growth in fixed assets and net working capital. So funding needed is what is the new capital employed minus the old capital employed. How will I solve this? By preparing a balance sheet. I'll prepare a balance sheet. In the balance sheet, I'll automatically know where the money is going to come from. In the balance sheet, we will know where the money is going to come from. So fixed assets plus current asset minus operating current liability. What is operating? A short-term loan will not form part of the liability because that is where the money is going to be raised. Intrinsic value of equity. What is intrinsic value of equity? It's sub part of a shareholder value added approach. You have arrived at the value of the firm. From the value of the firm, deduct the value of debt. But there could be some non-core assets in the company which is not considered in the valuation. Add it because equity guy will enjoy that. Equity guy will enjoy that. He will get the benefit of market value of non-core assets. Distressed company are those which are not able to meet their fixed commitment. It could be inability to pay fixed cost, operation issue, inability to pay interest, financing issue. Because of this, going concern is a problem. Going concern is a problem. And if a company is not a going concern, perpetuity valuation is a question mark. So lower value, cash flow goes down, discount rate goes up. So lot of valuation down will happen for a distressed company. We have four approaches of valuation. First approach is modified discounted cash flow approach. Here, first you can do scenario based valuation. What is scenario based valuation? Optimistic scenario, one value. Pessimistic scenario, one value. Most likely scenario, one value, and do a weighted average. Three scenarios not possible, then just arrive at one cash flow scenario, and every year cash flow modify them. How do you modify? By adding something called as normal cash flow into 1 minus the probability of distress. 1 minus the probability of distress. This will reduce the cash flow. Automatically the value will go down. Method 2, liquidation value plus going concern value. It is a value is sum of two parts. Value is sum of two parts. Going concern value, company is continuing. This you multiply with probability of survival. Liquidation, company sold today. This you multiply with probability of distress. This you multiply with probability of distress. One you multiply with probability of survival. Second you multiply with probability of distress, and you get a weighted average value which is called liquidation value plus going concern, or discounted cash flow plus distress value. Third is APV approach. In APV approach, I have to consider additionally the earlier approach only. Additionally, you have to consider debt benefit. What is debt benefit? Discounted at pre-tax cost of debt. If it's a redeemable debt, calculate interest every year. Discounted at pre-tax. Irredeemable, Modigliani Miller. Debt into tax rate. Irredeemable, debt into tax rate. Value of unlevered firm, first you calculate. There are multiple things which they are talking about, but real formula is what you see earlier, plus what? The tax benefit on debt. What ICI does is it calculates a going concern value, which is this, and then you do a liquidation value, which is what you do in the earlier approach. Going concern minus the liquidation is called probability of distress. Is called probability of distress. Going concern minus the liquidation values, probability of distress is called what? Your bankruptcy cost. If question is not asking bankruptcy cost and all, do the earlier approach and just add what? The tax benefit of debt. Just add the tax benefit of debt. And relative valuation approach is very simple, same as the concept 14 which we saw. Valuation is relevant basis into the multiple, but the multiple may have to be adjusted downwards because the company is under distress. The company is under distress. The next part is startup valuation. Startup has 2 3 problems. Most of the startup do not make profits. If they're not making profits, cash flow based approach fails. Many startup comparable company will not be there. Relative valuation is difficult. So because of all these challenges, we have a lot of subjective method. First subjective method is Berkus approach. He says there are 5 important parameter. Put a value for every parameter. Put a value for every parameter, and final value is the sum of all these factors. Sum of all these factors. He said each parameter is 500,000. So he said if you are earning revenue, all 5 parameter 2.5. Not earning revenue, only 4 parameter 2 million. This is his approach. Can be altered according to the requirements. Cost to duplicate approaches, value of startup is equal to all cost incurred in the startup operations, website, everything, all cost put together. Comparable transaction method is nothing but relative valuation approach. It is nothing but relative valuation approach. See some transaction which has happened. WhatsApp got acquired at a value of $10 per user. Similar to WhatsApp, if any other company is there, you can use this $10 and this value, that is the transaction, can be adjusted upwards or downwards on the basis of risk. We did a question where WhatsApp was there and a similar company chat app was there. 95% discount we had to do on that valuation. Scorecard valuation is similar to Berkus approach. Berkus approach, when we do comparison only of that startup. In scorecard, Ola is compared with Uber. I put a score against every parameter, arrive at a weighted average score. If I'm better, score could be more than 100. Weaker, score could be less than 100. After the final score is done, value of my startup is equal to other startup into the multiple. Other startup into the multiple. Then comes first Chicago method. What is first Chicago method? Is modified discounted cash flow scenario based. Arrive at 3 scenario: best case, worst case, and normal case, and do a weighted average. Do a weighted average of the possible values. Venture capital method says no, it is very difficult to estimate today valuation. You arrive at the exit value. Arrive at the exit value. From the exit value, discount and bring it to today value, or divide by some multiple and bring it to today value. That is called post money valuation. That is called post money valuation. From this, deduct what amount is getting invested. You will get the pre money valuation. Pre money valuation. Digital platform is nothing but something like a search engine, Amazon, which is helping transactions to happen. Here the approach remains the same. Income approaches present value of future cash flows discounted at investor required rate of return. Market approaches valuation by multiple. What is valuation by multiple? To value Amazon, use the multiple of Flipkart. To value Flipkart, use the multiple of Amazon. And cost approaches, value of all the cost incurred. When I do this income approach for estimation, I have a top down approach of estimation and a bottom up approach of estimation. Top means from India's population, you keep going downwards and do the estimation, and bottom up is based on my resources, I do the estimation. Professional firm like a chartered accountancy firm, if I have to do valuation, rule remains same. Present value of future cash flow, but this valuation can be adjusted upwards or downwards based on key performance indicator. If my performance is good, higher value. If my performance is bad on a KPI, lower value. And last part is impact of ESG on valuation. ESG is environmental, social, and governance factor. All these factors will have to be considered in cash flows or in the discount rate. Clear? I'm kind of done with whatever I wanted to cover. One chapter alone, you'll have to manage it. I have lost full energy to talk now. So anyway, I spoke 30 minutes earlier what you need to do. From my side, only one thing is best wishes. Do really well in your exam. Be confident. The most important factor is be confident. You'll be able to do really well. Thank you, guys.